This is going to be the financial management revision for CA Inter May 24 exams and November 24 or September attempt, whatever it is there. Getting it? So the new scheme related financial management marathon. Now, this is paper 6 part number A, which is having 50 marks weightage with choice. 20% we have choice, so 60 marks would be the weightage. And this marathon revision is going to be handled by our faculty, Ganesh Bharadwaj, and believe me, you are going to witness the best, you are going to experience the financial management subject like never before. So just listen to this in the same order, watch this particular lecture at standard speed only. So below in the description for the video, description is there, right? So there we have even provided timestamps as well. Now this marathon is going to be uploaded in 3 parts. Okay, part 1 we are going to upload it for 8 hours approximately, where 3 important topics are covered: cost of capital, leverage analysis, and capital structure. Whereas part 2 is approximately 5 hours, investment decisions and working capital management. And whereas part 3, MCQ revision, like some MCQ videos we have recorded. So that MCQ videos you will be getting. So these are the 3 parts in which we are going to use this. We are going to cover the syllabus that we have. Getting it? So technically speaking, typically speaking, the faculty is covering 80% of the financial management syllabus. Getting it? So these are the topics which occupy at least 35 to 40 marks of the paper for sure. Next, now coming to the material, the faculty has used, Ganesh Bharadwaj sir has used a material in this marathon, and that material can be downloaded by you from rest of a CSEMA website. Just open rest of a CSEMA website. So PDF resources, inside that you click on CA Inter, inside that you click on group 2, and you will find paper 6. Inside this paper 6, you see here P6A FM revision marathon material. You just click download, you will get the marathon. Getting it? So that's the material which the faculty has used. Watch at standard speed. Look at the Ganesh Bharadwaj sir introduction, like entire the paper analysis, everything is going to cover, and then you start watching the concept. Don't directly pick any random topic and then start watching it. No, watch in the order. You will learn, you will get a very good comprehensive learning, comprehensive understanding on the FM. For sure, from your exam point of view, you will have lots of advantage by watching this revision class. Okay, why late? Continue. All the very best. And by the way, we have a Play Store. Just open CA Caramharsha YouTube channel. Inside that, open the playlist. You will find all our CA Inter, all the 6 subjects related marathons. Getting it? So we are uploading for the May attempt. All the marathons already. Audit is uploaded, other loss is uploaded, GST is uploaded, FM is now uploaded, costing will be uploaded. Getting it? So you will be finding all the marathons. You will also find all the RTPs, MTP videos in the same. You just find the playlist of CA Caramharsha YouTube channel. You will find all these kinds of playlist. Getting it? You will have a one-stop solution here. You will get RTP, MTP, MCQ, marathons, all that. Getting it? So make use of these resources and do well. All the very best. Okay, continue watching.
Hey folks, welcome you all to a new session. This is CA Ganesh Bharadwaj, and in this session we are going to get started with the much awaited revision batch for the subject financial management, which is paper 6A of your CA intermediate course. Now before we get into the revision, so first I would like to take a few minutes to give you an introduction and the background as to what you can expect from this particular revision batch. So I know you might be having a lot of questions like, sir, what will be the coverage? What are the chapters you're going to cover? So what is going to be the approximate duration, the marks that is going to get covered, the weightage that is going to get covered in this particular revision batch? I'm going to tell you each and every one of that before we get into the actual revision of this particular subject. Right, guys? Fine. So now first, in your paper 6A financial management, by the way, this revision batch is as per the new syllabus. This is as per the new syllabus which was introduced in the year 2023. Right, applicable from May 2024 exams and onwards. Right, fine. So now if you look at it now in your paper 6A FM, this paper carries a total of 50 marks. Your paper 6 is part A, financial management, part B, strategic management. So in this revision batch is going to be for financial management alone. And in financial management, so you have a total of 9 chapters. Out of this, the first two chapters are purely theory chapters, scope and objectives of FM and types of financing. And the remaining 7 chapters are your practical, that is numerical driven chapters, right? So you have ratio analysis, cost of capital, capital structure decisions, leverages, investment decisions. Investment decisions is also popularly called as capital budgeting. Then you have dividend decisions and management of working capital. These are the 9 chapters, 2 theory and 7 practical chapters. Now in this particular revision batch, right? So what we are going to cover, we are going to cover the 5 core chapters, the most important chapters. That is, we are going to cover cost of capital, leverages, capital structure decisions, investment decisions, that is your capital budgeting. Then we are also going to cover the working capital management. And apart from that, we are going to cover 130 plus MCQs, right? And these MCQs are going to be from all the 9 chapters of your entire syllabus. Clear with this? So with respect to this 5 chapters, we are going to see the concepts or limited numerical problems will be doing it. So these 5 chapters, we will be revising it in depth. And apart from that, with respect to the MCQ part, we will be doing 130 plus MCQs, right? So encompassing all the 9 chapters of your institute study material. Clear? So entire institute study materials MCQs will be covered in our revision batch itself, right? Clear with this? Now as you all may know, in our FM paper, right, which is for 50 marks. Now MCQs carry 15 marks and your descriptive portion will carry a total of 35 marks, right? So this is going to be the composition. Now here we are going to cover the MCQs of all the chapters including the theory chapters, all the 9 chapters MCQ we are going to cover. And with respect to the descriptive portion, we are going to cover the 5 core and the most important chapters. So in the descriptive portion, sir, which are the chapters we are not going to cover in our particular revision batch? We are not going to cover this ratio analysis chapter and dividend decisions chapter. These 2 chapters, except that all the other numerical chapters we are going to cover, revise in depth. Are you clear with this? Right. Now, sir, what is going to be the coverage? First, with respect to the duration part, this revision batch is planned for approximately 15 hours. That is, this 15 hours is for the 50 mark component of financial management, right? And we are going to cover all these areas that I have just mentioned to you. Now, sir, this particular revision batch, how many marks will it cover in my exam? It covers a total of 40 marks. Sir, how is it? Now, the FM paper gets printed for 60 marks. Out of this, you need to write for 50 marks. And out of this revision batch covers 40 marks. This is what I am saying, because in this exam paper, you will be having some choice also. So the exam paper gets printed for 60 marks, out of which you need to attempt for 50 marks, and out of which we are going to revise for 40 marks. These are the core chapters. And of course, 1 month from now, that is 1 month before your exam, you need to focus, give a lot of weightage with respect to the chapters that are core and very important. And that is exactly what we are doing right now. Are you clear with this? Right? And that is the reason why I'm only taking up the core chapters right now and doing it. Those 2 chapters, I have deliberately left it for a simple reason that right now the focus should be on the main chapters, right? If you still have time, then you can do the revision of those 2 chapters by yourself. This is the overall intention, right? Clear with this? Next, sir, in this particular revision batch, will you only just read line by line or do only the concept, 2 numerical problems? Many students will be having this doubt as well. First, we will be doing the conceptual revision, right? And when I say revision, you will see it by yourself. We will be exploring the formulas with the logics. So I am a kind of person who doesn't believe in mugging up formulas. So whatever is it that we are going to do, we will be seeing it logically and the concepts will be revised. And as the name of the batch suggests, this is a revision batch. Now, again, many students will be having this question also. Sir, I have not touched FM in my life. Now, 1 month from now, the exams are going to get started. If I watch this revision batch, is it 100% sufficient for my exam? Now, let me clarify this. This is a revision batch. Our FM regular batch is for a total of 100 hours, right? Now, this revision is for 15 hours. Obviously, this revision batch of 15 hours is not going to be a substitute for our regular batch. So if you're learning the subject for the first time, obviously you should watch the regular batch, right? This 15 hours of revision batch is exclusively done to recapitulate whatever we have learned till now. So now, for you to attend this particular revision batch, the prerequisite is you should have definitely covered this entire financial management at least once, right? Sir, only if I attend your regular batch will I be able to revise this, attend this particular revision batch. Nothing of that sort. You could have either attended my original, my regular batch or some other faculty's regular batch, or you could have either done your self-study. Anything is fine, but the only precondition is that you should have at least done the subject once to sit for a revision batch. As the name suggests, this is revision, right? Fine. And now here I will not just be doing only the concepts. Now we will also be doing some numerical problems, limited numerical problems. I will handpick a few numerical problems which covers most of the concepts in a particular chapter. So a few numerical problems. Obviously, we will not be doing everything. A few numerical problems that will help you to recapitulate the entire chapters, the most important concepts inside an entire chapter. Clear with this? And apart from that, as I just mentioned you, we will also be doing 130 plus MCQs. That is basically your entire MCQs mentioned in the institute study material. Clear with this? Now, as on date, the case study based MCQs compilation is not that much. It's not, it is not present in the institute study material and all that. So the case study based MCQs, ideally as on date, is there in your mock test paper, and it is there, 1 or 2 case studies are there in your RTP. This I will be doing it separately. In our revision batch, the MCQs that we are going to do is as per the study material. These are non-case study based. These are all conceptual based. Clear with this? So that is something that we are going to do. So I wanted to make it very clear regarding the coverage that you can expect, right? Are you clear with this? And one more thing, for those who have a feeling that I have not touched FM till now, so can I watch this particular revision batch? Yes, you can watch, because if you are just a few weeks or 1 month away from the exam, it is not practically possible for you to start with a regular batch right now. So the maximum that you can do is you can only attend a revision batch. So definitely there will be a value addition for those people who have not touched FM till now, but directly watching this regular batch, there will be some value addition. But for those who have already studied FM once, this is going to be even more effective. That is what I'm trying to convey here. So this is the overall background about the revision batch that has been scheduled, and I hope all your doubts are now clarified. And one more important thing, while you are watching this particular revision batch, please take a dedicated notebook, right? Catch up running notes as far as possible. Catch up running notes. Try doing the sums along with me. participate as if I am standing in front of you and teaching. Though this is happening on a digital mode, you assume as if I'm standing in front of you and you answer back to me. You answer back to me. You talk to me. It's okay. It's okay, right? Even if you're watching the screen, assume that I'm standing in front of you and teaching. Now, this will make your learning much, much, much effective. Are you clear with this, right? And trust me, this is going to be a game changer in your revision, in your preparation for the upcoming exams, for a simple reason that we have tried to cover all the important concepts. I am again saying all the important concepts. You cannot expect every single concept to be covered, because you know that our regular batch is 100 hours. That's where we cover everything, right? But predominantly from an examination perspective, I have taken into account all the major concepts inside every chapter that we are covering here, and I have presented in a certain way that it's quite easy to understand. This is what we are planning to do here, right? And one more thing, you will be having a dedicated revision batch book. That is, I have made a book dedicatedly for this particular revision batch. So the link to download that will be present in our description. So you can click on that link and download, and please follow the lecture along with that particular material. Clear with this, guys? So with this, let us get started with this beautiful subject of financial management. So let's start with the revision of our first chapter in discussion, which is cost of capital. Now, what is this chapter all about? Now, we saw earlier that in our subject, financial management, there are broadly three objectives to be achieved. What are the three objectives to be achieved? Financing decisions, investment decisions, and dividend decisions. Correct? Financing decisions are nothing but decisions relating to the fundraising activity. Correct or not? Yes. Investment decisions are nothing but decisions taken with respect to how these funds are deployed, whether I should invest my money in project A or in project B, which is better. These kind of decisions are taken in investment decision. And finally, there is something called as dividend decisions. So after the money is being deployed in projects and the company earns profit, it has to pay the debenture holders, the preference dividend, all these things it has to pay, and balance money, whatever is left with them, is belonging to whom? The equity shareholders. Now, whatever is the money that is pertaining to the equity shareholders, it is not necessary for the company to pay it immediately right now. So it can decide how much amount to pay to the equity shareholders now and how much amount to be retained for future purposes. Are you clear with this? And this decision is called as dividend decisions. And in this subject, each and every chapter goes on towards achieving any one of these three objectives. Now, in this context, this chapter, cost of capital, comes under the first objective, which is financing decision. So this chapter, cost of capital, goes on to achieve the objective of financing decisions. Now, sir, what is this financing decisions, or basically what is this chapter, cost of capital? Now, let me just give you an introduction here. Now, let us assume this is the balance sheet of a company. Now, obviously, a company, when they want money, there will be many sources of finance for the company. Yes. So what will be the multiple sources of finance? The popular sources of finance for the company: equity share capital. Yes. Then preference share capital. Yes. Then debentures could be there. Yes. Or term loans could be there. Yes. And then even retained earnings, your whatever is the profit that the company has made till now, the accumulated profit that is not distributed as dividend, that is also a source of finance for the company. Yes. Now you tell me, each of these source of finance, now the company will not get free of cost. So each of these sources of finance will have some cost associated with that. So, and that is what we are going to study in this chapter, called as cost of capital. So the cost associated with each source of finance is only called as cost of capital. This is point number one, the basic introduction. Point number two, This cost of capital that we are seeing here is always a percentage. It is always a percentage. It is not an absolute amount. The cost of capital is always expressed as a percentage. Sir, why is it expressed as a percentage? Let me give you an example. Let us say there are two people. Let us say there are two people, Mr. A and Mr. B. Correct? Now, both of them have gone to a bank and they have actually taken loan. Are you clear with this? Now, let us say Mr. A pays 10 rupees of interest. Correct? Let us say Mr. B pays 15 rupees of interest. Mr. A pays how much? 10 rupees of interest. Mr. B pays how much? 15 rupees of interest. Now, out of these two people, which one has a lower cost? Now, you will say that Mr. A has lower cost. Why? Because he is paying only 10 rupees, whereas B is paying 15 rupees. Now, wait. Now, let me add one more part to it. Now, let me also tell you how much was the loan amount. Mr. A took a loan of 100 rupees, while Mr. B took a loan of how much? Let's say 200 rupees. Now, technically speaking, the cost as a percentage for A is how much? He is paying 10 rupees for every 100 rupees that is being borrowed by him. Or in other words, Mr. A is incurring a cost of 10%. Whereas if you look at B, he is paying 15 rupees. So in absolute amount, it might be more, but this 15 rupees is a cost pertaining to 200 rupees of the finance that he has got. So, or in other words, 15 upon 200, this is nothing but 7.5%. So now you tell me who, A or B, which one of these two people has got the finance, which one of these two has a lower cost of capital? Obviously, now you will say Mr. B. Now, why am I introducing this concept? Why am I discussing this particular example? Very simple reason. Cost cannot be compared in absolute terms because the capital pertaining to which the cost is being given might be different. So that is why if you always establish cost as a percentage, it is readily comparable. Are you clear with this? And in this chapter, whenever we use the word cost of capital, it is always expressed in terms of percentage. Are you clear with this? This is number one. Then, now before we get into the technicalities of this chapter, there is a prerequisite that you need to know. So the prerequisite for this chapter, that is a pre-requirement to enter into this chapter, is a chapter called as time value of money. Time value of money. Now in this marathon, I am not covering time value of money because time value of money is not a separate chapter mentioned in the institute study material. However, this time value of money, the basic concept, is being covered already in a separate video that has been uploaded in our channel. So you can watch that first and then come to this particular marathon. In case you have not attended my lecture before, then you watch the time value of money concept first and then you can just come to this, so that whatever we are discussing in this particular chapter will be mindful and you will be able to understand the logics easily. If you have already attended my regular lectures, then you can directly continue with this particular marathon. You can directly enter into this cost of capital lecture. Are you clear with this? So now let's get started. So now what we are saying here is every source of finance has a cost associated with it, right? So now if you see, different sources of finance that we just saw right now are debt, preference shares, equity, retained earnings, and predominantly these are the sources of finance. Now, the cost associated with debt is called as cost of debt, or in other words, it is properly known as KD. K stands for cost, D stands for debt. Are you clear with this? The cost associated with preference shares is called as KP. And the cost associated with equity shares is called as KE. And the cost associated with retained earnings is called as KR. Are you clear with this? So now, each of these sources of finance, if you see, they have some cost associated with them. And I told you the cost of capital, we are going to compute it as a percentage. So obviously, each source of capital is given a separate name. So KE for cost of equity, KP for cost of preference shares, KD for cost of debt, KR for cost of retained earnings, and so on. Are you clear with this? Popularly, these four are there. Then for term loan, it is called as KT. It is called as KT. This is not there in the study material, but anyways, we will be doing a sum regarding this. Anyways, KT, T stands for what? Term loan. That's about it. I will explain what it is. It's all very simple, right? Now, we need to compute the cost associated with each sources of finance. Now, let us say a company has raised equity share capital of 10 crores, right? Preference share capital of, let's say, 6 crores, and a debt of how much? Debentures of, let us say, 4 crores. So a total finance raised by the company is how much? 20 crores. Now, the cost associated with this 10 crores is called as KE, that is cost of equity. How to compute that we'll be seeing later. Now, the cost associated with 6 crores is called as KP, that is cost of preference shares. The cost associated with this 4 crores is called as KD, correct? That is cost of debentures. Now, a person says, look, I don't want all these breakup. Now, overall, you have raised how much? 20 crores. Out of this 20 crores, for 10 crores, there is one cost. For 6 crores, there is a different cost. For 4 crores, there is a different cost altogether. Now, I don't want all this breakup. For this entire 20 crores, you tell me what is your overall cost of capital, and that is called as KO. Cost of overall cost of capital. How to compute? We have not entered into it. We will enter into it now. Are you clear with this? So these are certain terminologies that you need to understand before we get into revising this particular chapter. So KE stands for cost of equity. KP stands for cost of preference. KD stands for cost of debentures. KO stands for what? Overall cost of capital. Of course, I told you KR stands for cost of retained earnings and KT stands for cost of term loans. Every single thing logically we will be seeing. You need not mug up any formulas. If you want to learn this logically, first you need to know this concept of time value of money. I will link everything to that, and automatically you can revise everything. Some students, what they do, they prepare one full they prepare one sheet and write all the formulas, they mug up, and then they go to exam. It is not at all required. Definitely it is not at all required. You can, if you know the subject logically, at any given point of time, you can do wonders. That's about it. Are you clear with this? Fine. So now this is about the introduction. So the combination of cost and weights of each source of finance is called as overall cost of capital. It is popularly known as weighted average cost of capital. How to compute this and all we will be seeing. So first we will enter into this chapter. We will be seeing the logic for every single formulas that is there. And then we will be doing 2 comprehensive questions, and with that the revision of this entire chapter will get over. Are you clear with this? Yes. So now, yes, the meaning of cost of capital, just now I just explained. You can just go through it once. Basically, cost of capital is always expressed as what? It is expressed as a percentage. And one more thing, this is the difference between accounts and finance. Now we are in financial management. In accounts, what you do, you record whatever you have paid, correct? So in accounts, what we do is, so if I am paying 5 rupees of dividend, if I am paying 6 rupees of dividend, only that will be considered as a cost. Whereas in financial management, there is a concept of opportunity cost, meaning what? The expectation of the shareholders, not just the shareholders, the expectation of the investors should also be considered as the cost for the company. Sir, what is this, sir? Why you are saying? Let us say there is a bank, okay, and there is a customer. Let us say there is a bank and there is a customer, correct? Now, let us say that this customer, he has placed some fixed deposit with the bank, correct? Now, this bank, what they are doing is they are paying interest. Let us say at the rate of 7%. Just an example. They are paying interest at the rate of 7%. Now, you tell me, from the viewpoint of the customer, this 7% is his return, correct or not? Because he is receiving it. And from the viewpoint of the bank, the same 7% will be considered as the cost. Are you clear with this? Yes. Or in other words, whatever is the return of the customer, or in this case, the investor, the person who has invested money is called as an investor. The popular name, the common name known for all these instruments is called as investor. So whatever is the return to the investor can be considered as the cost to company. Yes, are you clear with this? But this is subject to a few exceptions which we will be seeing as we enter into this chapter. But for the time being, you just remember this. So the the return for the investor is actually the cost for the company. And based on this concept, we will actually be moving into this particular chapter. Now, look at this. Now, determination of cost of capital. Now, in our time value of money concept itself, we have seen basically we were matching cash flows, cash inflows and outflows and all that. Let me just quickly walk you through this. The cost of any source of finance is expressed as percentage per annum. I told you why percentage makes sense and absolute figure doesn't make sense. We just saw that example of Mr. A and Mr. B with the bank loan. To calculate the cost, first of all, we need to identify the various cash flows. So when we are talking about cost of equity or cost of debentures or cost of preference shares, first you should identify what are all the cash flows associated with each of these instruments. Inflow received at the beginning. Yes. Now let us say I am raising debentures. I am raising money through debentures. So first is what? You will receive some money as the debenture capital from the investors, correct? So what is the overall inflow received that you need to determine? These are some ingredients that you have. Then outflows of interest, dividend, redemption amount, etc. So if you are raising money through debentures, every year you need to pay something called as interest. Yes, suppose if you are raising money through equity or equity shares or preference shares, every year you will be paying something called as dividend, correct? And of course, in case of redeemable preference shares, redeemable debentures and all, there will be something called as redemption amount. You have to repay back the money. So these are all some outflow of payments. So outflow of payments typically will consist of what? It will consist of your interest or dividend, and at the end of the period you will have to repay back the capital, which is called as redemption amount. Then inflow of tax benefits on interest and outflow of payment of dividend tax. Right now dividend tax is not there, it has been abolished. Tax benefit on interest, what it is, I will discuss in a few minutes from now. So now what you have the inflow followed by a series of outflow, correct? Yes, or technically this is nothing but, so if you look at this, let us say I have issued debentures worth 100 rupees, correct? So in the initial year I receive how much? 100 rupees. Every year, let us say I have to pay 10% on this 100 as what? As my interest, and for a period of 5 years. So for the first 5 years, I will be having an outflow of 10, 10, 10, 10, and at the end of the 5th year, I will not just pay the 10 rupees, but I will also have to repay what? I will also have to repay my entire principal. Are you clear with this? Let us assume that I am redeeming at a premium. So redemption can be at a par or a premium. We know that, right? It is in accounts, we have seen it. Yes. So this is going to be, let us assume that the redemption happens at 105 rupees. So now you have all the cash flows with you right now. Are you clear with this? Yes. So for the first year, the cash outflow will be 10 rupees. Second year, 10. Third year, 10. Fourth year, 10. Fifth year, 10 plus I will have to repay back my capital. In this case, we have assumed a premium also at 105 rupees. Correct or not? Yes. So now in our cash flow equation, we saw that the rate that equates your present value of inflow with your present value of outflow is called as what? Is called as your IRR, the rate at which my present value of inflow and my present value of outflow matches is called as IRR. Or in other words, the first year will be discounted at 1 plus R to the power 1. The second year will be discounted at 1 plus R to the power 2. Third year at 1 plus R to the power 3. Fourth year at 1 plus R to the power 4. And fifth year at 1 plus R to the power 5. Yes or not? So in this case, we have the inflows, we have the outflows, we just need to calculate R. How will you calculate R? Using that IRR, trial and error method, correct or not? You will take one trial, it will show a negative NPV. You will take one more trial, it will give you a positive NPV. Then you will interpolate the two and arrive at the rate, the internal rate of return. That rate in this chapter is called as cost. Are you clear with this? So now in this example, whatever I gave you, this was pertaining to what? A debt model, a debenture model. I just gave you an example. So here what we have is we have the inflows, we have the outflows. So whatever R that we need to find out, this rate is only called as what? This rate is only called as our cost of capital. In this case, it is called as KD, that is cost of debenture. If you do a similar thing, if all the cash flows are pertaining to equity shares, then it will be called as what? KE, cost of equity. If you are matching the cash flows of preference shares, then this R, the rate that you get, is called as cost of preference shares, KP. Are you clear with this? So basically, this is nothing but this IRR, whatever we have studied in the basic concepts, that IRR, if you match your inflows with your outflows, so whatever is the rate at which your inflows and outflows matches, or in other words, the rate that makes your NPV equal to 0 is actually IRR, and that IRR is only the respective cost of every source of finance in this chapter. Are you clear with this? So now just quickly read this. So thereafter, we can use trial and error method to arrive at the rate where the present value of outflows is equal to the present value of inflows, and this rate is basically called as IRR. In investment decisions, okay, in this chapter, investment decisions, in a later chapter which we will be seeing, capital budgeting, this IRR indicates income because we have an initial outflow followed by a series of inflow. In this cost of capital, IRR represents cost because here we have initial inflow. First, we will receive money from whom? First, we will receive money from the investor, followed by a series of payments. We will have to, every year we need to pay them interest, and finally we will also have to repay back the principal. So here, when you have an inflow followed by a series of outflow, whatever you get is actually called as a cost. And alternatively, we can use shortcut formulas. Sir, so in this chapter, you mean to say that for every component of finance, for every source of finance, so we should use IRR method to calculate the costs pertaining to KE, KD, KP, KO and all? Ideally, yes, but we also have something called as shortcut formulas which are mentioned. Though these shortcut formulas are easy to use, they only give an approximate answer and not the exact answer, and we will discuss about all these things in this particular chapter. Are you clear with this? So overall, in this chapter, what we are going to see, we are going to see the cost pertaining to each sources of finance, and finally the overall cost of capital, popularly known as weighted average cost of capital, or WACC. This is what we are going to see. And before we enter into this chapter, there are a few important points that we need to remember. First, securities can be issued at par or at discount or at premium. We know this. Yes. So now let us say I'm going to issue debentures. Debentures can be issued at 100 rupees, or at a discount, let's say 90 rupees, or at a premium, say 110 rupees, correct? These are some basics that we already know. Similarly, the redemption can also happen at par, discount, or premium. It can also be redeemed at the same 100 rupees, or at the time of redemption, it is enough if the company pays 90 rupees, that is redemption at discount, or at the time of redemption, the company has to pay more than the face value, that is, let us say 110 rupees premium. Are you clear with this? Or in other words, to put it simply, so the issue and the redemption can happen at par, discount, or premium. Are you clear with this? Yes. Next, there is something called as flotation cost or issue cost. What do you mean by flotation cost or issue cost? Let us say the company wants to raise 1 crore rupees by way of issuing new equity shares. Now, for the company to issue this equity shares, so the moment they issue this entire 1 crore, that will not be automatically credited to the bank account. For this fundraising activity, there will be some costs incurred. There will be some cost associated with it. Sir, what could be the cost? Example, the company has to issue something called as prospectus. Yes, then they will have to pay something called as underwriter commission. Underwriter commission, correct? There will be some issue related expenses. Are you clear with this? So basically, at the time when the company receives the money, it will receive not this entire 1 crore minus all this flotation cost. Are you clear with this? And in this chapter, we are matching cash flows, and the initial cash inflow will not be the entire issue value. It will not be the entire issue value. Some costs, issue cost or flotation cost, will be incurred by the company, which will have to be adjusted, and only the net proceeds will be received by the company. Or in other words, whatever is the issue value minus the flotation cost is called as net proceeds. Net proceeds means what? The net amount that the company receives in its bank account. Are you clear with this? These are the costs associated with the issue of new security. Always remember, only when I'm issuing new securities, I will be having flotation cost. Or to put it simple, in case of retained earnings, there is no concept of flotation cost. Are you clear with this? Why? Because the money is already with me. The money is already with me. So retained earnings is nothing but my past profits that I have accumulated, correct? Reserves and surplus. So there is no extra cost that I need to incur to receive this amount. It is already lying in my bank account. Are you clear with this? Fine. A few examples are brokerage, commission, underwriting expenses, etc. It should be noted that these costs apply only to new securities and not to existing securities. Flotation cost is an outflow and should be deducted from the issue price to arrive at net proceeds. So net proceeds means what? The net amount of cash inflow that I receive at the beginning of the period. Are you clear with this? Net proceeds means the issue price less the issue expenses. Issue expenses is called as flotation cost. If the issue price is not given, suppose in exam, the issue price is not given, then the students can assume it to be equal to the current market price. So this is given in your institute study material. So if the issue price is not given, then take the issue price as equal to current market price. Sir, how can you take this? Obviously, you will be able to raise money only that is equal to the current market price, correct? Suppose the company share is currently quoting at, let us say, 25 rupees. The face value is 10 rupees, the market value is 25 rupees, which means you can definitely issue this as at a premium of 15 rupees, correct? The company has a face value of which is 10 rupees and the market price is 25 rupees, correct? So now what will happen here? The 10 rupee share can be issued at 25 rupees. How do you know? Because readily in the market, people are ready to pay 25 rupees for this 10 rupee share, which means when the company is going for a fresh issue also, what they can do is they can actually raise it at 25 rupees, or in other words, 10 plus 15 they can have as a premium, correct? So if the issue price is not given, you take the current market price as the issue price. Are you clear with this? These are some ground rules that have been mentioned here. And if the issue expenses, flotation cost, if it is not given, then you can assume it to be equal to 0. Now, one more popular doubt that I get from students. Now, what happens? Let us say in this case, issue price is how much? 25 rupees. That is, every share is issued at 25. The price at which the issue is happening is called as issue price. Issue price is 25 rupees. Let us say the face value is rupees 10. Okay. Now, in this question, let us say in a particular question, they have given flotation cost has been given as, let us say, 5%. They have just mentioned 5%. Flotation cost is given as 5%. Now, many students have a confusion as to whether the flotation cost should be applied as a percentage on the issue price or as a percentage on face value. Now, this is again a controversial area. In the institute study material, certain sums they have applied the flotation cost as a percentage on issue price. In certain questions, they have applied this flotation cost on face value. Sir, what should I follow? You can follow any one of these two methods. That is, you can apply this flotation cost as a percentage of issue price or as a percentage of face value. But understand one thing, whichever method you do, you just write a note in exam saying that in the absence of information. What is the absence of information? They have just given flotation cost is 5%. On what is not mentioned. So you can just write down, in the absence of information, flotation cost is applied as a percentage on issue price, or it is applied on a percentage of face value, and do. So if you do it like this, for the given assumption, your answer is correct. If you don't write this assumption, then the institute can penalize you for this. So let's be very clear. Whenever you look at flotation cost, if they have mentioned it as a percentage on what is not given, you write a note stating your attention and do it. Now, in my opinion, ideally, logically speaking, flotation cost should be applied on the issue price only. If you ask me, I would say flotation cost should be a percentage on issue price. Why? Because I am raising how much rupees now? Every share I am raising how much? 25 rupees. So this flotation cost is actually incurred on the amount that I am actually raising only, no? So technically speaking, your flotation cost should be a percentage on your issue price, but in certain questions, institute has also applied this flotation cost on face value. So this has confused many students. So students have been asking me this doubt. So what you can do is you can either apply it on issue price or on face value. You just write a note for it and leave it there. Suppose in the exam they've clearly given flotation cost is 5% on issue price, then they themselves have given it is on issue price, then there is no question of writing note and all. You can automatically apply it on issue price. Or in the exam they've given it as 5% on face value, you apply it on face value. There is no question of writing a note because there is no doubt here. Are you clear with this? Yes. So now, concept of tax saving on interest. This is one more very important basic item in this particular chapter. What do you mean by this? Let me just give you an example. Let us say we have two companies, A Limited and B Limited. Now, EBIT stands for what? Earnings before interest and tax. For the two companies is going to be 100 rupees. Just an example. So both the companies are earning the same amount of profit, right? EBIT minus interest. Let us say A Limited has borrowed fully, hypothetical example. A Limited has borrowed full money from debenture channel, and for this they are paying a total interest cost of 30 rupees. Just an example. Okay. So let us say the A Limited has borrowed some money through the debt channel, the debenture channel, for which they are paying 30 rupees every year. Whereas B Limited, they have not raised money through debentures, but the same amount they are raising it through preference shares, let us assume. So minus interest for A Limited 30 rupees, for B Limited no interest cost. So EBIT minus interest gives you what? Earnings before tax 70, and here it is 100, right? Now minus tax at the rate of, let us say, 30%. Now tax is calculated on what? Earnings before interest. So 30% on the 70 rupees, how much is that going to be? 21 rupees. Whereas for B Limited, the tax will be 30% on 100, it is going to be 30 rupees, correct? So you get what? Earnings after tax, you get how much? So 70 minus 21, you get 49, and here you get 100 minus 30, which is equal to 70. Now minus preference dividend. Now B Limited has borrowed the same amount for which they also pay the same 30 rupees. But this 30 rupees is not interest. The 30 rupees is actually a dividend. So they pay dividend. Are you clear with this? Now A Limited, do they have to pay any dividend? No. Why? They have actually borrowed money through the debt channel, for which the cost is interest. Whereas B Limited, they have borrowed the same amount on which they are paying 30 rupees, but they are paying it as dividend. So dividend is being reduced here as 30. Are you clear with this? So now the net profit available to equity shareholders. So whatever is the remaining amount, it is pertaining to whom? The equity shareholders, correct? So net profit available to equity shareholders is how much? A Limited is 49, whereas for B Limited, it is only 40 rupees. Now, the question here is, look, both the companies earned the same EBIT, correct? Both the companies raised money, the same amount of money, on which the cost was 30 rupees here, 30 rupees there also. Both the companies were paying the same cost, but still if you see, A Limited is making more profit, whereas B Limited is making lesser profit. What is the reason for this? So what is the reason for more profit being reported by A Limited, whereas relatively a lesser profit being reported by B Limited? This is because of the tax savings available on interest as a source of finance. What is this, sir? What is this, sir? If you see, interest is a tax deductible expense. Interest is a tax deductible expense. Meaning what? Now this tax amount of 30% is paid on what? On EBIT. So the base on which the tax is computed is what? The base on which the tax is computed is EBT, correct or not? Yes. Now, for the purpose of arriving EBT, my interest was allowed as a deduction, whereas my preference dividend was not allowed as a deduction. So here, in case of A Limited, they need to pay a tax only on 70 rupees as a base, whereas B Limited needs to pay tax on the entire 100 rupees. Are you clear with this? Or in other words, basically, the tax outflow of A Limited was how much? 21 rupees. The tax outflow of B Limited was how much? 30 rupees. Or in other words, A Limited was able to save 7 rupees of tax. Are you clear with this? And that 9 rupees of tax. Correct? So 30 minus 21 is 9 rupees, and that savings has only resulted in 9 rupees of more profit for A Limited. Are you clear with this? Or in other words, if you see here, this 9 rupees, what is this 9 rupees? So on this 30 rupees of interest that is being paid, the company need not pay any tax. Why? It was allowed as a deduction from the base on which tax got computed. Or in other words, if you see, this 9 rupees is nothing but interest amount into tax rate. Interest amount of 30 rupees into tax rate of how much? 30%. Are you clear with this? This 30 is nothing but what? This 30 is nothing but interest amount, and this 30% is nothing but tax rate. Are you clear with this? So now can I say, if I am raising money through the debenture channel, how much I have to incur? I will have to pay 30 rupees, but wait, parallelly, I am saving 9 rupees of cost, correct or not? Why? Because I am paying it as an interest, it is allowed for the purpose of income tax, and I can get some savings in tax. Or can I say the net cost for me, if I raise money through the debenture mode, is 30 minus 9, correct or not? Yes. So this 30 is what? So this 30 is your interest, correct? 9, can I rewrite it as 30 into 30%? We just saw it here. 30 into 30% is only 9. Or in other words, this is nothing but interest into tax rate, correct or not? Or in other words, this 30 is nothing but the interest amount. Yes, this is nothing but the interest amount, and this is nothing but the tax rate. This is nothing but the tax rate. Or can I say the net cost associated with debentures is not interest amount. Can I say it is 30 into 1 minus 30%? Correct or not? I am taking 30 common here. 30 the whole into 1 minus 30%. So what will you get here? So 30 minus 30% into 30. That is what is the meaning of this. Are you clear with this? Or in other words, can I say the net effective cost of interest is not interest amount, but interest into 1 minus t. In this case, it is going to be 30 rupees into 1 minus 0.3. So how much is this going to be? So 30 into 0.7, 21 rupees. Or in other words, we can say that I am paying 30 rupees. Parallelly, I am saving 9 rupees of tax. So the net cost for me is only 21. Are you clear with this? Whereas if I raise money through preference shares, it will be I need to pay this entire 30. There is no tax saving. So ideally speaking, you cannot compare this 30 with this 30. You can compare this net amount of 21 with this 30, and you can say, look, debt is always a cheaper source of finance as compared to preference shares. Are you clear with this? So that is why even when we are calculating, you will see KD is generally lesser than KE or KP. Are you clear with this? The cost of equity, the cost of debt is generally lesser than the cost of equity or cost of preference shares. The reason being, dividends are not allowed for the purpose of income tax, whereas interest is allowed for the purpose of income tax. Are you clear with this? Because interest is tax deductible expense, there is something called as tax savings on interest, and the effective cost of interest is only interest into 1 minus t. Are you clear with this? So every year I am paying 30 rupees, but parallelly I will be saving how much? 9 rupees. So 30 minus 9 net off is only 21 rupees. So if I am raising money through the debenture channel, I am incurring a net cost of only 21 rupees. How will you write this? Interest into 1 minus t. So every year my cash outflow will be how much? Interest into 1 minus t. Are you clear with this? And this is called the concept of tax saving on interest expense. The payment of interest to the debenture holders or lenders is allowed allowed as an expense for tax purpose, for the purpose of tax determination. Hence, the interest paid to debenture holders saves the tax liability of the company, and savings in tax liability is also known as tax shield. That's why interest amount, if you see the whatever amount that you pay as interest, that is not your actual cash flow. Interest into 1 minus t is only your cash flow. Why? Because you pay the interest, parallelly there is a reduction, there is a savings in your tax. So this net amount is only your effective outflow with respect to your debentures or with respect to your interest. Are you clear with this? These are some basic concepts. Now with this, let us get into the first area called as KD, cost of debt. Cost of debt. Now debt stands for what? In this case, debentures. Now, broadly, there are two types of debentures. What are the two types of debentures? Irredeemable debentures and redeemable debentures. Irredeemable debenture means what? So it need not be redeemed at all. So what will happen is the company will raise the money through this debenture channel, and lifelong they will have to keep paying interest. It need not be repaid at all. This concept is called as irredeemable debentures. Whereas redeemable debenture means what? So clearly the life of the debenture will be given in the question. You will say this debenture after 10 years it has to be repaid back. So for the 10 years you should keep it as a life and do all the calculation. So there are broadly two types of debenture instruments: irredeemable debentures and redeemable debentures. Now irredeemable debentures. Now what we need to do, very simple, we need to calculate KD, correct or not? Now recall the concept that we studied in time value of money chapter. Now, in time value of money chapter, we saw that in case of sum of equal annual cash flow, what is the formula? Present value is equal to annual cash flow divided by discount rate. This is what we have seen, correct? We have derived all these things. Annual cash flow divided by discount rate. If you have not seen the time value of money lecture, please see it once so that you will get crystal clear clarity on this area. So the present value of any particular instrument, the present value of any particular instrument will be annual cash flow divided by discount rate. Every year, provided what? Every year you are paying the same amount. The cash flow is same. In case of debentures, every year it is going to be the same, correct? Now, in this case, can I call the present value as net proceeds? Why? This is the amount of inflow that I'm going to get. Net proceeds stands for what? Net proceeds stands for the issue price minus all the flotation cost, correct? So can I say this is equal to annual cash flow divided by discount rate? What will be the annual cash outflow for the company? It will be interest into 1 minus t, correct or not? I am paying interest, but parallelly I am also saving tax. So interest into 1 minus t is my net cash outflow divided by discount rate. The rate that equates my inflow and outflow is only called as the cost that we saw right now, or nothing but in this case discount rate, I can write it as KD. Are you clear with this? Are you clear with this? Or in other words, can we say KD is equal to interest into 1 minus t divided by net proceeds? Are you clear with this? And that is the formula given here. Very, very simple. You need not mug this up. This is all based on time value of money concept. Annual cash flow divided by discount rate, that is going to be your present value, or discount rate is nothing but your annual cash flow by present value. Or in other words, you can also think of it like this. So in the numerator you have what? So KD, the cost, is nothing but what I pay upon what I receive. You need to understand this chapter. Cost of capital is looked at from the perspective of company. So always remember, cost is always from the viewpoint of the person who is borrowing the finance, correct or not? So the company is only raising money through this particular source of finance. So from the viewpoint of company, KD is nothing but what they pay divided by what they receive. What they pay every year? Interest into 1 minus t. Why into 1 minus t? Parallelly there is a tax saving upon what? Net proceeds. Net proceeds is what? The net cash inflow that they get. That is the issue price minus all the flotation costs. From the viewpoint of the company, we are matching cash flows. We are not talking about accounting terms. From the viewpoint of company, we are just matching the cash inflow with the outflow. So basically here, the annual outflow divided by the overall cash inflow. What I pay upon what I receive. This is the formula for What? This is the formula for irredeemable debentures. Are you clear with this? Very, very simple. KD stands for cost of debt after tax. I stands for annual interest payment. Here I is an amount. It's a rupees annual interest payment. NP stands for net proceeds and T stands for tax rate. And net proceeds means the issue price less issue expenses. If the issue price is not given, take the current market price. If issue expenses is not given, then which means there is no flotation cost. You can take it as 0. Are you clear with this? This is a standing principle for all the types of cost that we are going to see. Are you clear with this? The first one in debentures, what is it? Irredeemable debentures we have seen. What is the formula? Interest into 1 minus T divided by net proceeds. What I pay upon what I receive. As simple as that. No need to mug up even a single thing here. Next. Now, certain debentures can be redeemable. Correct? Some debentures can be redeemable. Yes, if the life of the asset is given. Don't worry, all these things we will be seeing examples. We will be solving questions. 2 broad comprehensive questions we will be solving. Fine. First, I am just revising all the concepts and then we will get into 2 numerical problems for this chapter and we are done with this. 2 comprehensive problems. Now, redeemable debentures. What is the meaning of redeemable debentures? So, it is, I raise the money now and let us say after 5 years, I need to repay it back. Correct? This is called as redeemable debentures. So let me just take an example. So example for redeemable debentures. Let me just take an example. Let us say the face value is 100. Okay. The issue price, let us say the issue price is 90 and let us say issue price is 90 and the redemption value, the value at which it is going to be redeemed, let us say is 110. That is, the face value of the debenture is how much? 100 rupees. Currently I am issuing it at a discount, that is 90 rupees, but I am redeeming it at a premium of 110 rupees. Correct? Let us assume that the life of this particular debentures is 5 years. And let us say the interest rate is 10% and the tax rate is equal to 30%. Now, we need to calculate what? We need to calculate KD. KD is nothing but the cost of debentures. Now, I told you, cost is nothing but the rate that equates my present value of inflow with my present value of outflow, or in other words, IRR calculation we need to do. If you calculate IRR, that is going to be for this particular set of cash flows. If you calculate IRR, that is going to be your cost of debt. Are you clear with this? So now, first what you need to do, prepare a cash flow equation. So the rate at which my inflow is equal to outflow. What is my inflow? So right now, the issue price is how much? It is going to be 90 rupees. That is going to be my issue. Now, in this case, let us say they have not given anything about flotation cost and all. So flotation cost is not at all there in this question. If flotation cost is not there, if flotation cost is there, you need to reduce that also and arrive at net proceeds. Are you clear with this? If it is not there, then you can take it as 0. You've seen this. So initially I receive how much? 90 rupees. Correct? Now, followed by series of outflows. Every year I need to pay interest. What is the interest amount? 10% on 100, 10 rupees. Correct? Wait, but parallelly there is a tax saving. So 10 into 1 minus 0.3. I also save 3 rupees on this. Because I am paying an interest of 10 rupees, I am saving 3 rupees of tax. The net cost, the net interest cost is only 7 rupees. Correct? Similarly, in the second year, so I don't know at what discount rate we need to calculate. Divided by 1 plus KD to the power 1. Correct? Similarly, 10 into 1 minus 0.3 divided by 1 plus KD to the power 2. Like this, it goes on. And in the last year, what will be the cash outflow? 10 into 1 minus 0.3, that is 7 rupees of interest. Plus, I need to repay the entire what? I need to repay my entire capital at a premium. Plus 110 divided by 1 plus KD to the power 5. Right? 1 plus KD to the power 5. This is going to be my cash flow equation. Right? So now the rate that equates my present value of inflow with my present value of outflow, or in other words, the rate that makes my NPV equal to 0 is called as the discount rate, IRR. In this case, that is going to be your cost of debt. Are you clear with this? So how you will do? First, you will take one trial. So detailedly, we have discussed in the basic concepts chapter. So since this is a revision video, I am asking you to refer that in detail. We have done this. So now basically what we need to do, let us assume R is equal to 10%. So you might get one NPV, you will get a negative NPV example. So then you assume R is equal to 12%, you might get a positive NPV. So now the NPV that makes the rate at which my NPV is equal to 0, that is your required rate of return. So you have one negative NPV, you have one positive NPV, you interpolate the two and you arrive at the exact KD, and that is called as the IRR technique, or it is also known as yield to maturity approach. So this yield to maturity approach can be done only when, so this IRR approach can be done only when you have this finite period. Are you clear with this? The yield to maturity approach, YTM approach, or the present value method, what you will do is cost of redeemable debt, KD, is calculated by discounting the relevant cash flows using the internal rate of return, or in other words, IRR calculation is only called as KD in case they have asked you to do it as per YTM approach, also known as present value method. Are you clear with this? Are you clear with this? You just need to identify the cash flows and the rate that equates these cash flows, or in other words, the rate that makes my NPV equal to 0 is actually the required discount rate, or it is nothing but my KD. Are you clear with this? And this is what we need to do here. Clear with this? Yes. Now, sir, now every time, so this is just one source of finance, debt. Similarly for preference shares, similarly for equity shares, for every single source of finance, IRR computation we need to keep doing, we need to just keep on doing, then it will take a lot of time. Yes, that is why there is a shortcut formula method. There is something called as a formula method. Now this formula method, so is it correct? It is not precisely correct, but it is approximate. It is approximate because till date for IRR there is no formula. IRR has to be done only through the trial and error method. Using interpolation you arrive at the answer. But here there is something called as formula method, which is generally used for academic and examination purpose. Clear with this? Because in real life IRR can be calculated in a fraction of seconds. You have so many tools. Even in Excel you can calculate IRR or not. But in exam, since you might not be having all the time, there is an alternative method called as formula method. What they are saying now, this formula method, is it exactly correct? No, it is not exactly correct. Reason is it ignores the concept of time value of money. I will explain this quickly. Fine. So now what is the formula for KD? I into 1 minus T plus RV minus NP by N, the whole by RV plus NP by 2. Sir, what is this formula? What have they mentioned here? Now, first, let us take our example. And with this example, I will explain the formula. Please don't mug it up. It is 100% logical, and I will also tell you what makes this particular formula illogical. That also I will tell you. So first, so what they have given, what is the interest? Every year they pay an interest of how much? Every year they need to pay an interest of 10 rupees. Yes, and into 1 minus T. So there will be a tax saving parallelly. So every year if you see, so I into 1 minus T. So 10 into 1 minus 0.3, correct? Yes, plus RV minus NP the whole by N. RV is what? Redemption value. How much is the redemption value? 110 rupees. 110. RV minus NP. How much is the NP? NP is the net proceeds. Today I am receiving how much? 90 rupees. Correct? The whole divided by N. So what is the life of this particular debenture? It's going to be 5 years. Correct? The whole by RV plus NP by 2. 110 plus 90 divided by 2. Sir, what is this formula? Simple. The same concept. In the numerator you have what you pay, what the company pays. In the denominator you will have what you receive. So what I pay upon what I receive. Sir, what are you saying about this? Fine. Let me just explain. This interest 10 into 1 minus 0.3. You understood this, correct? This is nothing but your an annual interest cash flow, annual interest outflow. Every year I am paying 10 rupees. Parallelly, I am saving 30% on that. So net off, it's only 70% on 10. 7 rupees is my interest outflow. Correct or no? Yes. Now, what is this RV minus NP by N? Is this also a cost? Yes. What is it, sir? How is it a cost? They are saying they are redeeming it. The company is going to redeem the debentures by paying 110 rupees. But initially they have received how much? 90 rupees. So they issued, at the time they received money from the investors, initially they received how much? 90 rupees. But when they have to repay, they have to repay how much? 110 rupees. Or technically speaking, they are paying how much more? They are paying 20 rupees more. Correct or not? They have received 90, but they are going to repay 110. So this 20 rupees they are paying more. Correct or not? Yes, but wait. So can I say this 20 rupees is a cost for the company? Yes, but this 20 rupees is a cost pertaining to this 5 years. Correct? Because this 20 rupees has to be written off over the life of the asset. Correct? This is not a cost incurred every year. It is a cost incurred for the overall life of the asset. So that's why we are doing RV minus NP. This is the overall extra amount that I am paying out of my pocket divided by N, divided by 5. So technically speaking, every year I will be amortizing 4 rupees towards that extra premium that I'm paying them. Are you clear with this? So this is also one more cost. So this cost is nothing but my interest cost. This cost is nothing but the extra amount that I pay to my investors. Are you clear with this? Divided by, so now divided by what? The debenture capital amount. Now you have two figures here. You have one something called as redemption value. You have something called as net proceeds. So now basically, so in the denominator, what you should have? The debenture capital amount. Correct? Now the problem here is, see, I receive 90 rupees, but I pay 110 rupees. Are you clear with this? So should I take this initial amount or should I take the final amount of redemption? Very simple. Take a simple average of both. So 90 plus 110 upon 2, and that is the denominator that we have got. Are you clear with this? So look at it component wise. You need not mug up anything. I into 1 minus T. What is I into 1 minus T? Annual, your interest outflow net of taxes, plus RV minus NP whole by N. What is this? The extra amount I pay, but this is for the entire year. So annually, how much is it going to be? Divided by the useful life of the asset. The whole divided by RV plus NP by 2. Which capital to take? I don't know. Take a simple average of the issue price as well as your redemption value and net it off. Issue price as in your net proceeds. Net proceeds is basically after adjusting for flotation cost, if any. Are you clear with this? That is about the logic. So now, tell me what is the formula method for this particular KD calculation. I into 1 minus T plus RV minus NP, redemption value minus net profits, the whole by N, further divided by RV plus NP by 2. Very simple, very simple. Now, sir, why are you saying that this formula is also illogical? See, I gave you the logic for you to actually know the formula. This is the logic I told you. Why is the logic, why is this illogical? Let me tell you, because this ignores time value of money concept. What are you saying, sir? How does it ignore time value of money concept? If you see here, redemption value is what? Redemption value is the value at which I am redeeming the debenture. That is 110 rupees. Net proceeds is the amount that I receive at the time of issue. Let us say in this case, it is 90 rupees. Now you tell me, this 110 rupees is a cash flow arising at the end of year 5. This 90 rupees is a cash flow arising in T0, current present date. Now, without using time value of money, you tell me, are these two figures directly subtractable? Are these two figures directly comparable? Absolutely not. But in this particular formula, they have ignored the concept of time value of money and they have directly subtracted a 5th year cash outflow with the 1st year cash inflow. This is the problem that I said. This is the reason why it does not give the exact answer, but it ignores the concept of time value of money. But we have no other option to use this. Why? Because every time you cannot keep doing IRR in your exams. That's why institute themselves have given something called as a formula method, and they have made it very clear. Look, this is also given by the institute. You look at this. One second. Yes, alternatively, we can use shortcut formulas. Though these shortcut formulas are easy to use, they only give an approximate answer and not the exact answer. Are you clear with this? So institute themselves have given this formula method. They have told that in case of comprehensive problems, or in case they want to do they want you to do some questions, calculate KD, KP and all, you can use the formula approach also. Are you clear with this? So in case of redeemable debentures, you have two methods of doing. One is IRR. The other one is a shortcut formula. So how will you calculate KD? Using the shortcut formula, I into 1 minus T plus redemption value minus net profits by N, the whole divided by redemption value plus net profits by 2. Are you clear with this? See how logical it is, and students mug this up. If you spend some time in knowing the concept, you will thank yourself for a lifetime, because it will stay with you forever. You need not mug it up. Are you clear with this? And where I stands for interest payment, NP stands for net proceeds, RV redemption value, T is the tax rate, N is the remaining life of the debentures, the life of the debentures. Fine. And the same thing, it's also given here. Net proceeds means issue price minus flotation cost. In case issue price is not given, you can take the current market price. In case flotation cost is not given, take it as 0. As simple as that. Are you clear with this? Yes. Next, what is the next source of finance? You have something called as preference shares. Now, before this, let me also finish one more part, which is called as KT. So maybe you can just write this down somewhere. KT. KT. What do you mean by KT? Cost of term loan. Cost of term loan. So what is the cost of term loan? Now, very simple. In case of a term loan, there is no concept of issue price, redemption value, and all, nothing. So you will actually borrow some money, a principal from the company, correct? Principal from the bank. The only cost associated with respect to your loan is going to be your interest. Or in other words, unlike your debentures, RV minus NP, this will not have a difference at all. This is not at all a cost for you. Are you clear with this? So directly we can say, in case of term loans, the cost of term loans is nothing but interest rate into 1 minus T. The only cost associated with respect to my term loans is what? Interest. Let us say the interest rate is 10%. Correct? So I'm paying 10%. That is my cost. But wait, on this 10%, I can also save some tax. So 10% into 1 minus 0.3, or in other words, this is going to be the net KT is going to be how much? 7%. Are you clear with this? So why this simple a formula in case of term loans? Because there is no concept of issue price, redemption value, and all these hangama in case of loans. In case of loans, principal has to be repaid. It cannot be repaid at discount, issued at par, nothing of that sort. Principal, interest, that's about it. The only outflow, the only expense that you have, the only cost associated with term loan is going to be interest. Are you clear with this? So here it's going to be interest rate into 1 minus T. As simple as that. In case they are asking for cost of term loan, it's going to be interest rate into 1 minus T. Now let's go to the next one, which is cost of preference shares. Now tell me, in case of preference shares, what happens? So the company, if they are raising money through preference shares, they need to pay something called as dividend. And remember, dividend is not allowed for the purpose of income tax, which means there will not be any tax shield or tax savings on debentures. Correct? So now, in case of preference shares also, I'm sorry, I was talking about preference shares, not debentures. So there is no concept of tax saving on preference shares. No, in case of preference shares also, there can be two types. What are the two types? Irredeemable preference shares and redeemable preference shares. Irredeemable preference shares means what? So it doesn't have a finite life. It doesn't have a finite life. So you need to use the concept of what? Sum of infinite equal cash flows. Correct or not? The time value of money concept. In case of redeemable preference shares, yes, it has a finite life. Every year you will know the exact amount of dividend that will be paid. Correct or not? Yes, exact amount of dividend will be known in advance. Yes. So now, in case of irredeemable preference shares, what is going to be the formula? Exactly same as what we studied in KD. So KP is going to be what? So the PD upon P0. So what is this PD upon P0? PD stands for what? Preference dividend. And P0 stands for what? P0 stands for net proceeds from issue of preference share. That is, or in other words, what I pay upon what I receive. Whereas in case of debentures, what we saw, I into 1 minus T, interest amount into 1 minus T. Whereas preference dividend, there is no 1 minus T. Reason, there is no tax saving here. Are you clear with this? So can we say KP is equal to preference dividend divided by P0. P0 is nothing but the present value of your preference shares, or in other words, the current market price, or in other words, the net proceeds. Are you clear with this? Yes, are you clear with this? Very, very simple. The same logic you can apply here. So now same similar thing for net proceeds. So issue price less flotation cost. If the issue price is not given, take it as current market price. If the issue expenses are not given, take it as equal to 0. Are you clear with this? Yes. Next, cost of redeemable preference shares. Cost of redeemable preference shares. Again, two methods are there. The first method is IRR method. IRR method. So what will you do in IRR method? So initially I will receive something. Net proceeds is equal to, so preference dividend 1 plus preference dividend 2 plus preference dividend at the end of year 3, so on, so on, so on. Plus finally, let's say it is 4 years. Sorry, let's say it's 5 years. Preference dividend at the end of year 4 plus the redemption value, correct? And every year I need to discount it. So you need to have every year's cash outflow and the first initial cash inflows. The rate that matches my inflows with the outflows is called as the discount rate, and in this case we call it as KP. Are you clear with this? And in case of preference shares, the preference dividend every year will be the same, or in other words, it is going to be what? It is going to be for a finite life. So what you can do, you can prepare a cash flow equation, and just like exactly like what we did for debentures, we need to do it here for preference shares. The only difference is what? There the annual cash flow was I into 1 minus T. Correct? Why 1 minus T? There was a parallel tax saving. Whereas in case of preference, there is no concept of tax saving. The annual cash flow will just be preference dividend. So here, every year, you will just be having the preference dividend amount as your cash outflow, and the rate that makes your net present value 0 here is called as your KP. Are you clear with this? Very, very simple. Now, alternatively, there is a formula approach. Yes, there is a formula approach. So what is the formula for that? Yes. So now in the numerator, you will have the cost. In the denominator, you will have the capital amount. Fine. In the denominator, the capital, what is it? RV or NP, take a simple average redemption value plus net proceeds upon 2. Correct? Very simple. Now, in case of numerator, now first, what is the cost? Every year I need to pay something called as preference dividend. Correct? Preference dividend every year has to be paid. Preference dividend plus RV minus NP the whole by N. Let us say it is redeemed at a premium of 110 rupees, but I'm issuing it at a par of 100 rupees. So overall for the and life of the asset, life of this particular instrument is 10 years. So can we say, and every year I am paying a dividend of 9 rupees. Can we say that, look, RV, I have to redeem it. At the time of redemption, I need to pay 110 rupees, but at the time of issue, I received only 100. Overall, for this entire life of the debenture, I have paid how much? 10 rupees more. So annually, 10 upon 10. So every year, my annual amortized cost is how much? 1 rupee pertaining to that extra amount that I am repaying. Plus every year, I am also paying this 9 rupees of preference dividend. Correct? So in the numerator, I have this 9 plus 1. Divided by denominator, what will I have? Should I take the issue value or should I take the redemption value? There is always a doubt. Take a simple average. Redemption value plus net proceeds upon 2. Are you clear with this? Exactly same as your KD formula. Only difference is there I into 1 minus T came. Here there is simply preference dividend. 1 minus T will not come. Reason being that preference dividend is not eligible for income tax deduction. Are you clear with this? And that's about it. That's about it. Are you clear with this? Yes. So now let's move into the next source of finance, which is equity. So cost of equity. Now, in case of cost of equity, so equity is a very unique instrument. Sir, what is unique about this? Now, in case of preference and in case of debentures, the amount that they have to pay as interest or dividend is known in advance. That is, there is a fixed payout every year. Whereas in case of equity, there is no obligation on part of the company to pay a fixed dividend, or at times they need not even pay any dividend at all. So there is one aspect that is unique. This is one aspect that is unique about equity. That is, there is no contractual obligation on part of the company to pay any dividend. Are you clear with this? And number two, as we all know, equity doesn't have any finite life. There is no finite life in case of equity. Are you clear with this? So there is no finite life in case of equity. These are the two unique characteristics of equity, because of which to compute cost of equity, there are different methods by itself. Are you clear with this? So these two are unique characteristics of equity. What are the two unique characteristics? Number one, there is no contractual obligation on part of the company to pay any dividend. 1 year, if they want, they can pay dividend. Another year, for the next 2-3 years, they need not pay any dividend. And later on, from the 5th year, they can continue paying dividend and so on. Are you clear? There is no contractual obligation to pay dividend. And number two, in case of equity instruments, there is no finite life. Obviously, there is no question of redeemable or irredeemable equity. No, in case of equity share capital, so the shareholders will get back their money only when the company is winding up. Are you clear with this? So during the life of the company, the equity shareholders are not paid back. Are you clear with this? Yes, of course. There is parallelly a secondary market. There is a secondary market. So in the secondary market, so you would have heard some people, they trade in shares and all. Yes, in their demat account. So in this NSE or BSE, they can trade and they can sell the shares, but that is in a secondary market. That is, there will be a buyer and you will be the seller. But the company anyways is not going to repay anyone. Are you clear with this? So the company is not going to redeem back. From the viewpoint of company, equity shares stays with them forever till the time of dissolution. Are you clear with this? Yes. Now, because of all these things, because of these unique features, there is not a single method to calculate cost of equity, but we have multiple approaches. We have multiple approaches. So broadly, there are 5 methods to compute the cost of equity: dividend price model, earning price model, growth model, popularly known as Gordon's model, under Gordon's model, dividend growth approach, earnings growth approach. There are 2 approaches. Then there is something called as realized yield approach, and finally you have something called as CAPM method, capital asset pricing method. Broadly, there are 5 different methods to calculate equity. So let us see one by one, and once again, all these predominantly, these are all some time value of money concepts. Now let us see this particular, the first approach, dividend price approach. What is this method? What is this approach? In this approach, they are saying, the present value of equity, is nothing. The value of equity is nothing but the present value of all the dividends received by the company, received by the shareholders. I'm repeating. So the present value of the shares, the present value of equity shares is nothing but present value of all the dividend received during the life of the particular equity asset. So what is this? What are they saying? Now, very simple. In case of sum of infinite cash flows, equal cash flows, what is the formula? Annual cash flow divided by discount rate. Correct or not? Gives you the present value of this particular instrument. Are you clear with this? So the present market price or the present value of equity share is nothing but dividend, annual dividend divided by KE, discount rate. Now, when can you use this model? You can use this model only when the company pays constant dividend throughout the life of the throughout the life of the company. Are you clear with this? So in case of dividend price model, this is applicable only in case of constant dividend. If the same amount of dividend is paid for the entire life of the company, only then you can use this model. Sir, 1 year they are paying something, another year they are not paying at all. If this is the scenario, then you cannot use this model at all. So first, dividend price approach, when can you use it? When the dividend amount is equal for the entire life of the company. There is no life of this equity and all for this entire company. Are you clear with this? So what will be the formula to calculate the present value of our equity shares? Annual cash flow, that is dividend divided by discount rate KE, or if you cross multiply, KE is equal to D divided by P0, or in other words, D is nothing but annual dividend, P is nothing, P0 is nothing but the current market price, or you can even call it as net proceeds. So today, what is the value of the share? Are you clear with this? Yes, or in other ways, you can also remember this as what the company pays divided by what the company receives. So today, if they issue the shares, from now onwards, they need to pay dividend every year, and today they will receive this P0, present market price, they will be able to realize it. Are you clear with this? This concept is called as dividend price approach, and in this method, what they are saying, the value of equity can be derived by discounting all the dividend cash flows. Are you clear with this? That is called as dividend price approach. Now, the next approach is earnings price approach. It is exactly same as dividend price approach. Now, what they are saying, instead of discounting the dividend, what we need to do is we need to discount the earnings itself. Let us say the company has earned the earnings per share, let us say, is 10 rupees. For every share the company has earned, let us say 10 rupees. Now, out of this 10 rupees, the company has decided to pay 8 rupees to the shareholders as dividend per share, and 2 rupees per share, they are deciding to retain it as their reserves. Now, you tell me, Now, the first method, what they are saying is only this 8 rupees is being considered and they are discounting this 8 rupees to arrive at the present value of the share. Correct or not? In this method, earnings price approach, they are saying, no, not only this 8 rupees, even this 2 rupees also belongs to the shareholder. But the company has not paid, that's all. But this also belongs to the shareholder. So instead of using dividend as the parameter, take the earnings itself as the parameter, because the entire earnings belongs to the shareholder of the company. So now you tell me, in this case, what they are saying, the present value of the dividend, the present value of the equity is nothing but annual cash flow. That is earnings per share divided by what? So earnings per share divided by discount rate, which is KE. Are you clear with this? Sum of infinite equal cash flows is annual cash flow divided by discount rate. If you cross multiply this, KE is equal to EPS divided by P0. Are you clear with this? So when can we use this formula? We can use this formula when the company makes the same earnings every year throughout its life. Are you clear with this? Yes. So the first method is called as dividend price model. What is the formula? Dividend, DPS, dividend per share divided by P0, that is the present value of share. Next, in case of earnings price model, it's going to be EPS divided by P0. EPS stands for current earnings per share, and P stands for what? P0, or P stands for the market price per share. Are you clear with this? Now, the third approach is called as growth approach, also popularly known as Gordon's model. So what does Gordon's model say? In the basic concepts we have studied, Gordon's model, when we can use Gordon's model can be used when the cash flows will grow evenly over a period of years. That is, when there is a constant growth in the cash flows, then we can use this formula, then we can use this particular model called as Gordon's model. Now, the growth can be applied keeping your dividend as the base, or the growth can be applied keeping your earnings as the base. Correct or not? So, in the previous two methods, what we saw, constant dividend, constant earnings. Now we can see growing dividend and growing earnings. That does it make sense? Yes. So, Gordon's model or the growth approach has two subdivisions inside it. What grows? Dividend growth approach, that is the first model. The second one is earnings growth approach. As simple as that. Now we have seen in the time value of money concept, we have seen in case of constant growth in cash flows, we have seen the present value is nothing but cash flow at the end of year 1 divided by discount rate minus growth rate. Yes or no? Sum of infinite growing cash flows geometric progression. Sum of infinite geometric progression series, we have seen this cash flow at the end of year 1 divided by discount rate minus growth rate. This is the formula that we have saw. This is the present value. Correct? So now in this case, you tell me, so P0 is equal to the cash flow at the end of year 1. In case of dividend growth model, D1, can I say D1 is nothing but dividend paid at the end of year 1 minus R, the discount rate stands for KE divided by KE minus G. Or in other words, so if you cross multiply this, what will you get? So KE minus G is equal to D1 upon P0, or KE is equal to D1 by P0 plus G. Yes or no? We get this formula. Yes or no? So D1, KE is equal to D1 upon P0 plus G. Are you clear with this? So K is equal to D1 by P0 plus D. This is nothing but application of Gordon's formula. Sir, how did this formula come in? We've already seen in time value of money concept, sum of infinite growing cash flows in geometric progression. Are you clear with this? Yes. So now he's saying, now in this case, suppose they have given D1 is what? Dividend payable at the end of year 1. Sir, they have given only D0, that is the past dividend paid. Very simple. We know that past dividend D0 into 1 plus G gives you D1. That is, the past dividend into 1 plus growth rate will give you the dividend payable at the end of year 1. That is next expected dividend. Are you clear with this? P0 stands for the current market price and G stands for the constant growth rate of dividend. Are you clear with this? Now, in case of earnings growth approach, every single thing is the same. Instead of D1, you should use E1. So in case of earnings growth approach, replace D1 with E1. So in case of earnings growth approach, the formula will be K is equal to E1 by P0 plus G. Are you clear with this? E1 by P0 plus G. This is all based on the concept of time value of money that we have seen. So till now what we have seen? So dividend, so normal constant dividend model, that is dividend price approach. What is dividend price approach formula? So annual cash flow, that is dividend divided by annual dividend divided by what? P0, D divided by P0. Sir, here D1, D2, everything will be the same because the assumption is the same dividend gets paid for the entire life of the company. Are you clear with this? So D divided by P0, that is the first formula for dividend price approach. In case of earnings price approach, what is the formula? E divided by P0, that is what I pay divided by what I receive. Very simple. Next, in case of dividend growth model, what will be the formula? K is equal to D1 by P0 plus G. In case of earnings growth formula, the formula will be E1 by P0 plus G. Are you clear with this? As simple as that. That's about it. That's about it. Next, in case there is a fourth method called as realized yield approach. So what is this? What is this? Now, this method is done from the viewpoint of investor. It is normally followed when the equity shares are sold by the equity shareholders after a few years. The KE is calculated by discounting the relevant cash flows using internal rate of return. Sir, what is the meaning of this? Now, just now we saw, a few minutes before, we saw that now what is the return? What is the return from the viewpoint of the investor can be called, what is the return from the viewpoint of investor can be called as the cost from the viewpoint of the company. Yes or no? Yes or no? So this particular formula is based on the assumption that the equity shareholders return is the cost of equity from the company's point of view. So how will we compute this? Now, let us just take a small example. I will just illustrate this, how this works out. Let us say Mr. A, what he does is he purchases shares of, let us say, a company, ITC Limited. He purchases the shares of ITC Limited by paying 100 rupees, right? Now, after 5 years, he is going to sell the share for 105 rupees, right? And during the course of 5 years, he has received the dividend as follows: year 1, year 2, year 3, year 4 and year 5. So during the course of 5 years, he has received the dividend as follows. In the first year, he received 7 rupees dividend. Second year, 8 rupees dividend. Third year, 6 rupees dividend. Fourth year, 5 rupees dividend. And in the fifth year, he has received 10 rupees dividend, some random dividend. Now, what we can do is, in the first year, he has actually paid 100 rupees to buy the share, correct? And what has happened? In the T0, in the immediately current present day, he has paid 100 rupees to buy the share. Yes, fine. Now what he has done, during the course of the 5 years, he has received the following cash flow: 7, 8, 6, 5 and 10, and at the end of the fifth year, he has also got back his money by how much? 105. It has appreciated. He has got it back. 105 rupees. Who will pay? Company will pay? No. He has sold it in the secondary market. There is a ready share market, correct or not? There he has sold it and he has realized 105 rupees. Now this, when he sells, some other investor will come and purchase it from him. The company is no way involved in transactions happening in the secondary market. Are you clear with this? So now you have framed the cash flows. So basically 1 plus KE to the power 1, 1 plus KE to the power 2, 1 plus KE to the power 3, 1 plus KE to the power 4 and 1 plus KE to the power 5. So KE here is the rate that equates my present value of cash outflow with my present value of cash inflow, or in other words, K is the rate that makes my NPV equal to 0. So using trial and error method, let K is equal to 10%, you calculate, you get a negative or positive NPV. Then let K is equal to 12 or 13%, again you get a positive or negative NPV. You can interpolate and you will get the answer. A typical IRR method, but whatever IRR you get, that is actually what the return, that is the return for the shareholder. And in this case, they are taking an assumption that whatever is the return of the shareholder will be the cost from the viewpoint of the company. Now you read this. This method is done from the viewpoint of investor. But remember, this entire chapter is done from the viewpoint of the company. Are you clear? Cost means what? It cost is always from the person who raises the finance, and here the company only raises finance. But this method is done. This is normally followed when equity shares are sold by the equity shareholders after a few years. Now, from the perspective of equity shareholders, now they can buy today, sell it after 4 years or 5 years. From their viewpoint, it can have a finite life, correct or not? Yes. So what we are doing is, from the investor's viewpoint, you calculate the IRR, and that is only called as the KE from the viewpoint of company. Reason, the logic they are doing this is, they are saying that whatever is the return to the shareholder is assumed to be the cost from the viewpoint of the company. Are you clear with this? So the KE is calculated by discounting the relevant cash flows using the IRR model. So in case data is given from the investor perspective, can we still calculate KE? Yes, we can calculate KE. Nothing but IRR from the viewpoint of investor is the KE of the company. This is where I said, sir, here what the company has not actually paid anything, how can you call it? No, this is where I said KE and all this cost is expectation of return from the viewpoint of the investors. So the investors' expectation is only called as cost. Here we use the concept of opportunity cost and all. You need not actually pay dividend to actually, or you need not pay actually something to be calling it as a cost. Are you clear with this? This concept is called as opportunity cost, and this entire concept, this entire chapter is built around the concept of opportunity cost. So in this case, basically, if they have given you this particular approach, realized yield approach, things will be given from the viewpoint of the investors, and what you need to do is you just need to discount it, arrive at the cash flow equation and find the IRR using the trials interpolation technique, and that is your KE. Are you clear with this? Yes. Now finally, there is one more thing, there is one more method called as CAPM, capital asset pricing model. So what is this model? First of all, understand this is actually a CA final concept. So in your intermediate, generally each of these ingredients of the formula will be given. You just need to plug the formula and write it down and arrive at KE. As simple as that. Still, I will give you the logic, but overall, if you see, this entire concept is covered in detail in your CA final. Now, what is this? K is equal to RF plus beta times RM minus RF. So this stands for beta. Okay, this stands for beta coefficient. K is your cost of equity. RF stands for risk-free rate of return. Beta, I told you. RM stands for rate of return on market portfolio. And this RM minus RF is called as market risk premium. I'll tell you what this is. Now, you have some money. Let's say you have some 100 rupees, right? Now, if you go and invest it in, if you open an FD in bank, now they will pay you 6% or 7%, correct or not? Yes. Now, why do you invest in equity market? Because you expect that the market will give a more return, yes or no? So that is the reason why you actually invest in the markets. Are you clear with this? Now, what is the flip side to this? When you invest in the market, you get more return, but you also have more risk, because you can also tend to lose money in the market. Yes or no? Fine. The risk is only given as beta. So beta coefficient is nothing but an indication of risk. How to calculate beta? It is a subject matter of discussion in CA final. It's a very big discussion. It's actually a statistical tool that you need to compute using standard deviation and all that. All that is not required right now. You just understand what it is. Beta and all will be given in the question. If this kind of question comes in, they will give you RF, beta and RM. So you can just plug the figures and do it. But you should know the reason for this formula. So what is the meaning of this formula? Let me just give you an example. Let us say if I invest money in my banks, let us say I will be getting 7%. This is called as risk-free rate of return. There is no risk. If you put some money in the bank, there is no risk. Or this can also be given in the question as GOI, bond rate. GOI means what? Government of India. Government of India bond rate is 7%. If they give like this in the question, it means they are referring to the risk-free rate of return. Are you clear with this? Yes. Now, RM stands for the return that the market generates. Generally, the market, let us say, gives 12%. That's why people are willing to take the risk. Correct or not? Yes. Now, RM minus RF, if I do, RF is what? RF is risk-free rate of return. So tell me how much more than the risk-free rate of return is my market giving 12 minus 7. Can I say the market is willing to give me how much? 5% more as compared to my risk-free rate of return. Correct or not? And this is what the market generally gives. Now, every company has its own risk. If you see Tata Motors and if you take ITC, these two companies will be different in terms of risk. Are you clear with this? That risk coefficient is only given in terms of beta, and beta is generally a decimal. They will give it as 1.5 or 2, 2.5 or 2.4, 2.43, whatever it is. Now, beta denotes what? Risk. So basically what they are saying is cost of equity. Cost of equity is nothing but the cost from the viewpoint of the company or the return expectation from the viewpoint of the investor. So how much return will the investor expect? RF, 7% definitely he will expect, plus beta times RM minus RF. Let us say for this company, the beta is 2 times. So 2 times of 5%. What extra the generally market gives? Generally market gives 5% more. Since I'm taking twice the risk, I want 2 times the market risk premium. The market risk premium means what? RM minus RF. That is the rate that the market gives in excess of the risk-free rate is called as RM minus RF. This is called as market risk premium. So into 5%. So technically, if you see, this is nothing but 7% plus 10%. It will be 17%. Are you clear with this? See, all the ingredients will be given in the question, but you just need to know the logic for this formula. You need not mug it up. So cost of equity in case of CAPM formula will be RF stands for risk-free rate of return, plus beta times RM minus RF. RM minus RF stands for market risk premium. How much extra the market gives as compared to the risk-free rate of return. Are you clear with this? And I want beta times that extra amount. Why? Because I am taking that much amount of risk. More the risk, more the return, and beta stands for risk. For intermediate, this level of understanding is definitely sufficient. How to calculate beta, statistical tool, standard deviation, all we will see it in final. Are you clear with this? Yes. So under the CAPM formula, so now what is going to CAPM method? So your K is equal to RF plus beta times RM minus RF. Are you clear with this? And with this, we have finished all the models. With this, we have finished all the models in this particular segment called as KE. So what is the first model? K, dividend price approach. When will you use this model? When the company pays the same equal amount of dividend throughout its life. So now what will be the formula? KE is equal to D divided by P0, annual dividend divided by present value, present current market value, or you can also call it as net proceeds. Are you clear with this? Yes. Then your yes, earnings price approach. Here the formula is going to be E by P0, that is annual earnings divided by P0, that is the net proceeds or the present market price. Then dividend growth model, what will be the formula? D1 by P0 plus D. KE is equal to dividend by P0 plus D. This is derived from the sum of infinite growing cash flows of a geometric progression model, which we saw in our time value of money area. Yes, and then in case of earnings growth model, it is going to be E1 by P0 plus G. Are you clear with this? And then the fourth one, KE, that is realized yield method. Realized yield method is nothing but calculation of IRR from the investor's perspective when they can sell the shares in the secondary market. And finally, you have CAPM model wherein K is equal to RF plus beta times RM minus RF. And that's about it. So now let's move to the final one, KR. Cost of retained earnings. Now, sir, retained earnings is something the company already has in its balance sheet. Sir, what is the cost associated with this? Wait. Now, this amount of retained earnings belongs to whom? It belongs to the equity shareholders. So, technically speaking, this retained earnings is also not free of cost because it has to be paid back to the shareholders at some point of time. Yes or no? Else no one will be interested in your company. You will not get new investors and all. So, technically speaking, the shareholders expect this amount also to be paid to them some way or the other. Yes. And hence there is even a cost associated with what? Retained earnings. Very simple. KR is equal to KE. Are you clear with this? So cost of retained earnings is always equal to cost of equity. Are you clear with this? Yes, because it belongs to the equity shareholders, but this is subject to two exceptions. KR is equal to KE. This formula holds good always, except for two situations. And what are those two situations is what we are going to see right now. Are you clear with it? So let's see the two exceptions. KR is equal to KE. So KR is equal to KE, but there are two exceptions. Exception number 1. What is the first exception? KR is equal to KE of existing equity share. Existing equity share. Or in other words, KR is not equal to KE of a new equity share. That is a fresh issue of equity share. Sir, what are you saying, sir? Very simple. The only difference is while calculating the net proceeds, in case of calculating KE, what we do? Issue price minus flotation cost we do. Correct or not? So, technically speaking, flotation cost will arise only when the company goes for fresh issue of shares. Yes, in case of retained earnings, I told you at the beginning, there is no flotation cost and all incurred with respect to retained earnings. Why? The money is already in their bank account. Are you clear with this? Hence, that is why we are saying if there is any flotation cost given in the question, it should be ignored for the purpose of calculating KR. Are you clear with this? So, K is equal to KR? Yes. So, in case they have given flotation cost in the question, that flotation cost should be considered. With the flotation cost, you should find out KE, that is for KE calculation. Once again, you should calculate this KE calculation without this particular flotation cost, and that will be called as KR. Or in other words, KR is equal to KE calculation without considering what? Without considering your flotation cost. Are you clear with this? Why? Because this is not a fresh issue. This is an amount that the company already has with them. Are you clear with this? Yes. Exception number 2. The second exception we are going to see right now. Now, this is actually, again, this is not a very good exception, but anyways. Now, in the question they have given, the personal income tax and personal brokerage of this particular investors. Now, what we need to do is KE is equal to 1 minus tax rate, personal income tax rate of investor into 1 minus brokerage of investor. Sir, what is this? Now, KR is equal to KE. Yes. Suppose in the question, they have given the personal income tax, not the company's income tax, personal income tax. They have given the personal brokerage and all. Now, the entire return, they will not be able to enjoy. The entire, whatever is the KE is nothing but cost from the viewpoint of the company, return from the viewpoint of the investor. Correct? He will not be able to enjoy this entire return because there could be some tax. Correct? Let us say tax rate is 30%. So 1 minus 30, only 70% of this he can enjoy. But wait, there is one more thing called as brokerage. If you see in your demat account and all, if you want to buy and sell shares, you need to definitely pay some brokerage. That is also another cost. Let's say 5% is a brokerage. So basically on this KE, only 95% he gets, and on that also 70% goes by way of tax. 30% goes by way of tax, and only what you retain is 70%. Are you clear with this? So KE into 1 minus personal income tax rate into 1 minus brokerage. This is going to be your formula when the personal income tax and personal brokerage are given. Are you clear with this? So right now, what is the formula for KR? KR is equal to KE. Two exceptions. Exception number 1. When the flotation cost is given, do not consider it for calculating KR. Number 2, when the personal income tax rate and brokerage rate of the investor is given, KR is equal to KE into 1 minus tax rate, personal income tax rate of the investor into 1 minus brokerage of the investor. Are you clear with this? In case these data is given, you can follow it. As simple as that. Fine. So now with this, we have learned each and every source of finance. We have learned the cost associated with each and every source of finance, KD, KP, KE, and KR. In fact, in KE only we had multiple models and all because of the uniqueness of that instrument, right? Now, individually, I have the cost associated with each source of finance. Let us say let us say equity share capital is 20 lakhs. Fine. Your preference share capital is, let's say, 30 lakhs. Then your debentures is, let's say, 50 lakhs. Now, for equity share capital 20 lakhs, let us say KE is 10 percentage, right? For preference share capital, let us say KE is 9 percentage. For debentures, let us say the KD is going to be 7 percentage. So let's say KE is 10%, KP is 7%, and your KD is equal to 7%. In this case, now overall, how much money the company has raised? They have raised 100 lakh rupees, correct? Now for this entire finance, for this entire 100 lakh rupees, now what is the overall cost of capital is what we are going to find out right now. So we will do this, we will learn this concept of weighted average cost of capital or overall cost of capital using a numerical example, right? So let's get started with a numerical example. So now let's solve the first problem, question number 1. So please take question number 1. Yes. So this is a comprehensive question where we will be calculating the cost of each components of finance, that is KE, KP, KD, all of this, KR, all of this we will compute, and finally we will also compute the overall cost of capital, KO. So here we will also see how to compute the overall cost of capital. I told you with this numerical example we will learn that as well. So let's get started. Let me read out the question for you. The following is the capital structure of a company. Equity shares at the rate of 100 each. The book value for that is 80 lakhs. Book value means what? The amount that is recorded in the books, that is lying in your balance sheet. Parallelly, there is a market value also. There is a ready market. Yes, as per the market, the value of this equity share is how much? 1 crore and 60 lakhs. Similarly, 9% cumulative preference shares, the rate of 100 each. Book value is 20 lakhs. The market value is given as 24 lakhs. 11% debentures, 60 lakhs and 66 lakhs. Retained earnings, 40 lakhs and nil. Now, very important. Sir, why for this retained earnings alone? In the book value, we have 40 lakhs, but in the market value, it is nil. Now, understand, this is very important. Now, equity shares, when I say equity, not equity shares. When I say equity generally means the amount that belongs to whom? The equity shareholders, correct? So the market considers 1.6 crores as the value of equity. That is, this 1.6 crores as a market value includes the value of equity share capital as well as of the retained earnings. Always remember this. When they give the market value of equity shares, basically it means that the market value of equity shares as well as the retained earnings has been considered, because separately for retained earnings you cannot have a market value. Are you clear with this? So basically in this case, this 1.6 crores considers the value of equity share capital as well as the value of retained earnings. This should be your understanding. Now, why we are taking this book value, market value, why we are doing all these things is, as we proceed into the question, automatically I will let you know, I will tell you what is this. There are two methods of computing the overall cost of capital. One is to the book value route, the other one is to the market value route. I will walk you through. Now, further data is given. The current market price of the company's equity share is 200. For the last year, the company has paid an equity dividend at the rate of 25%, and its dividend is likely to grow by 5% every year. So basically, why they have given all this data? So they have given this data to calculate KE using what? Dividend growth model. Under Gordon model, we saw dividend growth model and earnings growth model. In this case, we need to use dividend growth model to calculate KE. Then the corporate income tax rate is 30% and the shareholders personal income tax is 20%. Now shareholders personal income tax, why have they given? So generally KE is equal to KR. However, in case of two exceptions, we saw that KE will not be equal to KR. The first exception is what? KE will be equal, KR is equal to KE of the existing share capital, or in other words, if flotation cost is given in the question, that needs to be ignored for the purpose of computing KR. And number two, when the personal income tax and brokerage and all is given, KR will be equal to KE into 1 minus personal income tax into 1 minus brokerage. We saw all these things, correct or not? So for that reason, they have given. Then with respect to preference and debentures, nothing has been given. So life of debentures or life of preference shares is not given. So if the life is not given, assume it to be perpetual, that is irredeemable. So we will use the formulas of irredeemable debentures and irredeemable preference shares. Are you clear with this? Yes. So now what they have asked, you are required to calculate, number one, the cost of capital for each source of finance, that is KE, KP, KD and KR, we need to compute. Fine. Then the weighted average cost of capital, that is overall KO on the basis of book value weights, KO on the basis of market value weights. Now first let us do this segment 1. Segment 2 and segment 3 is very simple. Automatically you will understand. So let's get started. Now, sir, how do we know in this case KE? We saw that for KE calculation we had so many formulas, right? We had your constant dividend model, your constant earnings model, your dividend growth model, earnings growth model, CAPM model, yield model. So we had multiple models. Sir, how do I know which formula to use? You should know which formula to apply based on the data given in the question. In this case, they have clearly given the current market price, that is P0 is given for equity shares 200. Last year, the company paid a dividend of 25%, which means 25%, always remember, dividend, interest and all is calculated on the par value, on the face value. So which means last year they have paid 25 rupees, 25% on 100. Last year the dividend paid was 25 and the dividend is likely to grow by 5% every year. So very clearly, by reading the words of the question, you can find out that this is a dividend growth model, and accordingly you should incorporate the dividend growth, that is the Gordon model, under the dividend you need to approach, you need to use. Are you clear with this? So what is the formula under Gordon's model? Recall this. So KE is equal to D1 by P0 plus D. All the derivations we have seen, correct? KE is equal to D1 by P0 plus D. D1 means what? Dividend at the end of year 1. Now look at this very carefully. Students make a mistake here. What have they given? For the last year, the company has paid an equity dividend at the rate of 25%, which means this 25% on 100, that is 25 rupees, is the dividend that was paid previously. This is D0. This is not D1, but we need to calculate D1, which means what? Dividend at the end of year 1. So how will you compute? They have given the growth rate also. They have said every year the dividend grows by how much? 5%. Last year they paid 25. So next year they will pay how much? 1 plus 0.05. So 25 into 1 plus G, correct or not? Last year they had paid 25 rupees. Now the next year they will pay 5% more. Are you clear with this? So D1 will be equal to D0 into 1 plus G. That is last year dividend into 1 plus growth rate. So 25 into 1 plus 0.05. How did you get 25? This is 25% on the face value 100. They had given the dividend rate was 25% on the face value. So how much is this? So 25 into 1.05, it is going to be 26.25. Are you clear with this? So now you got this D1 value. So now incorporate all these things here. D1 is equal to 26.25. What is P0? P0 is the present market price. They have given this in the question, 200 rupees. So present market, you put it here. D1 by P0. P0 is 200 plus G. G is how much? 5%. So 26.25 upon 200 plus 0.05 gives you how much? 18.125%, and KE is equal to 18.125%. As simple as that. You should know. So in this case, what you need to know is, in this chapter basically, first, you should have a complete control over each of the formulas. How will you have control over each of the formulas? By knowing it conceptually. Don't mug up, but know it conceptually using the time value of money techniques. Predominantly, it is all based on time value of money techniques. And once you know that, especially for KE, KR and all, once you know that, then read the wordings given in the question and use the appropriate formula. Once you do that, life is simple. You can crack any kind of question in this chapter. You should have that much level of confidence. Next, calculation of KP. Now, look at this, KP. So now, what have they given? 9% cumulative preference shares at the rate of rupees 100 each. Now, in this question, life of the preference shares is not given. That is, they have not given what? They have not given the tenure or life of the preference shares. If tenure has not been given, you can definitely assume it to be irredeemable. You cannot say, I am assuming the life to be 10 years and all. You cannot do it. So if life is not given, assume it to be irredeemable preference shares, correct? In case of irredeemable preference shares, so what is the formula? So KP is equal to PD, preference dividend divided by yes, preference dividend divided by P0. That is the value of preference shares on the current date. Correct or not? So this is annual cash flow divided by what I pay upon what I receive. So this PO also is called as NP, net proceeds. Correct or not? Yes. So now you tell me, in this case, every year the company pays per share how much? 9% on 100 rupees. Correct? So 9 rupees they pay. Correct? Upon present value, or this is nothing but P0, the current market price or the net proceeds as on date. Have they given in the question? The current market price of the preference shares is not given in the question. If it is not given in the question, you can assume it to be as 100. So how can you assume? Because it's not given. So you will assume that the market price is quoting at 100 rupees, or the net proceeds. If I issue today, I will issue it at 100 rupees only. I will be issuing it at par. So it's going to be 9 upon 100. So this is going to be 9%. As simple as that. As simple as that. So basically it is going to be KP is equal to preference dividend upon net proceeds, or preference dividend upon P0. Fine. And this is going to be 9 upon 100, 9 upon 100, which is going to be 9%. Are you clear with this? As simple as that. This is an irredeemable model. How do we know it's irredeemable? Life of the preference shares is not given in the question. Look at this. That's why they have directly given. It is going to be 9%. Are you clear with this? Next. Your 11% debentures. Now, again, for debentures, you tell me, is there, have they given the life of the debentures when it is redeemable and all? Nothing is given, which means what? It is irredeemable debenture. So, irredeemable debentures, how will you calculate the KD formula? So, how will you calculate? KD is equal to interest into 1 minus T divided by net proceeds. Correct or not? What I pay divided by what I receive. From the viewpoint of company, every year I pay how much? Every year I pay 11%. So debentures face value is 100 rupees. If not given, we can definitely assume 100 rupees. Not a problem at all. So 11% on 100 is 11 rupees. Correct? Into 1 minus T. What is the tax rate? Corporate tax rate is 30%. Don't take personal income tax. Take corporate tax rate, because personal income tax is the tax rate applicable for the shareholders, that is used for calculating your KR, cost of retained earnings, whereas this corporate tax is used for calculating your KD. Fine. So 11 into 1 minus 0.3. Why do we do 1 minus 0.3 here? Because I will pay 11 rupees every year, but parallelly there is a savings of 30% on that 11 rupees. So net of my cost is only 70% on this 11 rupees. Are you clear with this? Divided by net proceeds. If I issue today, how much I will get? They have not mentioned anything. You assume it to be at the face value of 100 rupees. So now this is nothing but what? 11 into 0.3, which is 11 into 0.7 divided by 100. This is going to be nothing but 7.7%. And look, that is what has been mentioned here. Interest into 1 minus T upon net proceeds. Since the net proceeds is 100, they have directly applied it on percentage. You can also do this, or you follow whatever we have seen in the formulas. Are you clear with this? So 11 upon 100 into 1 minus 0.3, that's going to be 7.7%. So this is what? This is also irredeemable debentures. Are you clear with this? Yes. So now we have calculated KE, we have calculated KP, we have calculated KD. Now let's go to retained earnings. Retained earnings, very simple. Always KR is equal to what? KE, correct? Yes, but wait, in this question, they have given personal income tax. I told you KR is always equal to KE. Two exceptions. Exception number 1, KR is equal to KE of existing share capital, or in other words, in case in the question they have given you, this flotation cost and all, it needs to be ignored while computing your KR. Are you clear with this? That is number 1. Number 2, in case personal income tax or brokerage, or both personal income tax and brokerage is given, then KR is equal to KE into 1 minus personal income tax into 1 minus your brokerage. Are you clear with this? In this question, they have given personal income tax, brokerage is not given. Are you clear with this? So now, how will you calculate KR here? Very simple. KR is equal to, the base is KE, correct? KR is equal to KE into 1 minus brokerage rate into 1 minus personal income tax rate. So now you tell me, how much is brokerage? So 18.125, this is your KE, into 1 minus brokerage. Brokerage is not there, 1 minus 0, it's 1. into personal income tax is given as 1 minus 0.2. Are you clear with this? Is given as 0.2. So technically speaking, 18.125, correct? That should be the return that the equity shareholders should get, correct or not? Yes, but out of this they need to pay 20% to the income tax department, which means technically they will receive only 80% of this particular KE. So 18.125 into 1 into 0.8, how much is that? 14.5%. Are you clear with this? So now we have got all the sources of finance, and we have got the cost for every component of finance. So here KE is equal to 18.125%. So I'll just write it down here. KE is equal to 18.125%. Then KP is equal to 9%. Remember, for KP, there is no tax shield and all. There is no tax saving because it is a dividend. Dividend is below the line item. Below the line means what? It comes after payment of your taxes. Are you clear with this? So it is not an expense allowable for the purpose of income tax. Then KD is equal to 7.7% and KR is equal to 14.5%. So these are the four sources of finance that we have got. Now we have computed what? The first part of the question, calculation of cost of capital for each source of finance. This is done. Next, part 2, weighted average cost of capital on the basis of book value weights. So what is this? Now this is where we are going to calculate what? The weighted average cost of capital, overall cost of capital. First we will do it under book value weights. I will explain what this is. Now, what are the different sources of finance? Equity, preference, debentures, retained earnings. We have four sources of finance, correct? Now, book values, that is, the values are given in the question: 80 lakhs, 20 lakhs, 60 lakhs, and 40 lakhs, correct? Just copy, paste, and write these figures here: 80 lakhs, 20 lakhs, 60 lakhs, 40 lakhs. Yes? Then, what is the cost for each source of finance? We just found out. Now only we found out. For KE, it is 18.125%, correct? Then KP is 9%. We calculated this 9%. KD is 7.7% and retained earnings KR is 14.5%. Correct or not? Yes. Or in other words, can I say, for 80 lakh rupees of capital means generally a source of finance. For 80 lakh rupees of funds, the cost is 18.125. Correct? Then for the next 20 lakh rupees, the cost is 9%. Then for the next 60 lakhs, the cost is 7.7%. And for the balance 40 lakhs, the cost is 14.5%. Correct or not? This is the meaning of the component-wise cost that we saw. Overall, the company has raised how much? 200 lakhs or 2 crores. Correct? Now, I want to calculate. See, component-wise, you told me for 80 lakhs, the cost is 18.125%. 20 lakhs, the cost is 9%, and so on. I want to know what is the overall cost of this 200 lakh rupees of capital. This is what I need to find out. Are you clear with this? So how will we find out? Very simple. Very simple. Now look at this. Look at this. 80 lakhs divided by 200 lakhs. How much is this? 80 divided by 200. How much is this? 0.4. This is the weight of equity. Correct or not? Yes. So the weight of equity, the proportion of equity in the capital structure is how much? 0.4. Then similarly, 20 upon 200 lakhs, 20 divided by 200, how much is this? 0.1. The proportion of preference to the entire capital, the entire source of finance is how much? 0.1. Similarly, debentures is going to be 60 divided by 200 lakhs, which is going to be what? 0.3. And your retained earnings, 40 divided by 200, it's going to be 0.2. So what we did was, we have calculated the component-wise proportion, the proportion of every component of capital to the overall capital, that is 80 upon 200 is going to be 0.4. Correct? So equity is 40% of the total funds raised. Then your preference is 10% of the overall funds raised. Debentures is 30% of the overall funds raised, and retained earnings is 20% of the overall funds raised. Are you clear with this? Now we have the overall, we have the component-wise cost. Do we have the component-wise cost? Yes. We know that KE is equal to how much? 18.125%. Now, KE accounts to only 40% of the entire capital. Are you clear with this? So what we will do is we will multiply this weight with the respective cost. So weight into cost will give you how much? 18.125 into 0.4. So 18.125 into 0.4. How much is this? 7.25. Similarly, 9% is the cost of preference shares, but this accounts to only 0.1 of the total capital. So 0.1 into 9% gives you 0.9%. Similarly, 7.7% is what? The cost of debentures, but this accounts to only 30%, 0.3 of the overall capital. So 0.3 into 7.7, this gives you 2.31. And finally, you have KR of 14.5%, which accounts to 0.2, that is 20% of your overall capital. 0.2 into 14.5% gives you how much? So 14.5 into 0.2, that gives you 2.9%. Now you add up all these things, 7.25 plus 0.9 plus 2.31 plus 2.9, this gives you 13.36. So the overall cost of capital is how much? 13.36. That is, for 80 lakhs, the cost is 18.125%. For 20 lakhs, the cost is 9%. For 60 lakhs, the cost is 7.7%. For 40 lakhs, the cost is 14.5%. For overall 200 lakhs, the overall cost after averaging out is going to be 13.36. This 13.36 is what? The weighted average of each component of cost of capital. This is weighted to the weights of the proportion multiplied with the respective cost. And if you do this for this overall 200 lakhs, I will say the cost is 13.36%. Are you clear with this? So this weighted average cost of capital is very, very simple. What you need to do is you need to arrive at the weights into your respective cost. If you just add it up, you get your overall cost of capital. Are you clear with this? Are you clear with this? Yes. Now this weights, in this case, what we did, this weights of 0.4, 0.1, 0.3, 0.2, we arrived using what? Book values, correct or not? We arrived using book value weights. Yes. Now, alternatively, instead of using the book value to arrive at the weights, we can also use the market value to arrive at the weights. That's why they have given in the question, calculate the weighted average cost of capital taking book value as the weights, calculate the weighted average cost of capital taking the market value as the weights. So you can do it on either of the basis. So it is given in the question. Sir, if the question is silent, they have just asked us to calculate weighted average cost of capital, what you can do? You can do any of the two. You can either do it based on book value weights, you can either do it on market value base. Please write a note saying that this question has been solved using book value or market value weights, since the question is silent. Are you clear with this? As simple as that. But in this question, they have specifically given do it under book value as well as under market value. So once again, you need to redo the computation, this time under market value weights. Sir, then once again, should we calculate KE, KP, KD, KR? No. The cost components will not. The cost of the respective sources of finance will not change. Just the weights will change. So final answer will change. That's all. Each and every ingredient of cost will not change. Are you clear with this? So now look at this. Very interesting. So now again, list out the four sources of finance: equity, preference, debentures, and retained earnings. Are you clear with this? Yes. Now this is not book value. This is market value. Market value. So what is the market value given in the question? So go to the question. So 160 lakhs, 24 lakhs, 66 lakhs, and dash 0. Yes. So write down here 160 lakhs, 24 lakhs, 66 lakhs, 0. So this gives a total of how much? 250 lakhs. Are you clear with this? Now, look at this. The value of equity, the market value of equity includes what? The market value of equity share capital as well as retained earnings. That's why under retained earnings, we have put it as 0. Are you clear with this? Are you clear with this? Yes, because retained earnings is not separately computed here. So why? Because the market values equity as a whole. So they don't say market value of equity share capital, market value of retained earnings. They just call it as market value of equity, which means what? This is the overall market value for whatever is the amount that is owed to the equity shareholders. That's how the market values. Are you clear with this? So now what we have done, 160 lakhs, 24 lakhs, 66 lakhs and 0. Are you clear with this? There is an alternative way of doing this. There is an alternative way of doing this. So what is the alternative way of doing this? So in this question, what they have done, 160 lakhs, 24 lakhs, 66 lakhs and 0. Correct? So let me just do it here. So in this question, what they have done, so they have taken equity, right, preference, then debentures, and then they have taken retained earnings, correct? Now in this question, what they have done, market value, they have taken 160 lakhs, then 24 lakhs, then 66 lakhs, and then 0. They have taken total of how much? 250 lakhs, correct or not? Yes, this is what they have done in the question. So the entire value of equity, market value of equity, was considered against what? Was considered against the equity share capital. Are you clear with this? Alternatively, what you can do is, instead of doing it like this, alternatively, you can also, there is one more method which is allowed as per the institute study material. So equity, preference, debentures, and retained earnings. So there is no problem with respect to preference and debentures. It's going to be 24 lakhs and 66 lakhs respectively. Now go to the question. What have they given? They have given that 160 lakhs is the market value of equity, or in other words, this value includes the value of equity share capital as well as the value of retained earnings, correct? So now there is another method where this market value can be apportioned between your equity share capital and your retained earnings using the book value proportion. Sir, what are you saying? That is, this 160 lakhs is the market value of equity, correct? So we took it as the value of equity share capital and put retained earnings market value as 0, correct? Or second method, alternatively, what you can do is take this 160 lakhs, correct? This is the market value of equity share capital plus market value of retained earnings. What we can do is split this between the equity share capital and retained earnings in the ratio of 80:40. That is in the proportion of their book value. Are you clear with this? So basically, this 160 lakhs of equity is there, no? This 160 lakhs of equity, what we can do is we can distribute it between the equity share capital and retained earnings in what ratio? In the ratio of book value. That is in the ratio of 80:40, right? 80:40, or this is nothing but 2:1. Are you clear with this? 2:1. You can actually divide it in this ratio. So 160 divided by 3 into 2. So how much is this going to be? So this is going to be 106.66667 lakhs, and this is going to be how much? This is going to be 53.3333 lakhs. Are you clear with this? So basically, the market value of equity is being apportioned between the equity share capital and retained earnings in the ratio of their book value weights. Are you clear with this? So now here, instead of writing 160 against equity share capital and putting 0 against the retained earnings, what you can do is you can write down 106.67 lakhs against the equity share capital, and you can write down 53.33 lakhs against the retained earnings. The total will not change. The total will be the same, 250 lakhs. Are you clear with this? So what we have done in the first method, the market value of equity was fully taken as the market value of equity share capital, and retained earnings was taken as 0. In the second method, what we can do, alternative method, is you can take the market value of equity and apportion it between the equity share capital and your retained earnings using its book value proportions in the ratio of 80:40. Are you clear with this? In the ratio of 80:40, in this case, it was what? 2:1, correct or not? Yes, and in the ratio of 2:1, if you split it, now you get the market value of equity share capital, you get the market value of retained earnings. So in this case, so the overall is going to be 250 lakhs, but the internal weights will change. Are you clear with this? So if I take this as weight, then RE, the retained earnings, will be 0. It will not be given any share of cost. Are you clear with this? And in this question, KR and KE is not the same. Why? Because of some personal income tax given in the question. So the answer will also change because of this. Yes, sir, then how will I know which method to follow? You can follow any of the method and the institute is fine with it. Are you clear with this? If you want, you split it. If you don't want, you don't split it. Put the entire value of equity against the equity share capital. Are you clear with this? Any which ways you can do. Sir, because of this, how will the answer change? The answer will change because the component wise proportions will change. Are you clear with this? And hence your weighted average cost of capital will also change accordingly. Yes, but this answer will not change if KE and KR are equal. If KE is equal to KR, then whatever you do, this answer will not change. But when KE is not equal to KR, then the answer will definitely change because of the method that you pick. Are you clear with this? Are you having clarity? An institute is fine with taking any of the methods because in certain sums they have used this method, in certain sums they have used this method. So any which ways you can do it. Are you clear with this? It is just a matter of calculating the weights, as simple as that. So now we've got 160, 24, 660. So the overall is going to be 250 lakhs. So 160 upon 250, how much is the weight? It's going to be 0.64. Then 24 upon 250, it's going to be 0.096. Then 66 upon 250, that's going to be 0.264, and retained earnings is going to be 0. Are you clear with this? Suppose if we do it in alternative 2, these two will remain the same, but the equity and retained earnings, the proportion will change, because of which the overall answer might change. Are you clear with this? So now cost of equity 18.125%, KP is 9%, KD is going to be 7.7%, retained earnings, since we have not taken anything, we have not given any share, we are putting it as 0. Are you clear with this? So you multiply the weights with the respective cost and you will get the overall cost of capital using market value weights. Are you clear with this? And remember, this is also alternative 1. Are you clear with this? Once again, if you want, you can also compute the weighted average cost of capital using the market value weights by using the alternative 2. What is alternative 2? Splitting the value of equity between equity, share capital and retained earnings. Will the answer change? Yes, the answer will change, because in this case, KE is not equal to KR. KE and KR are having different values. So the proportion that each component gets will be different. Are you clear with this? And as simple as that, this is the overall concept of your weighted average cost of capital and all the components of your finance, that is KE, KD, KP, KR and all these things. Are you clear with this? As simple as that. Get the logic, get a complete control of this particular chapter. First, what you need to do, component wise, learn how to calculate the cost of every component. KE, KD, KP, KR. You just know how to calculate all of this. Learn it logically. In case of KD and KP, there are two things: redeemable, irredeemable option. Correct or not? Yes. So KD, KP, yes, there are redeemable and irredeemable option. That's about it. That's about it. Fine. And in case of redeemable option, you have further two formulas. One is IRR method. The other one is a shortcut method. Are you clear with this? Everything you learn it conceptually. At any given point of time, whatever question they ask, you will be in a position to handle it. And once you compute the component wise cost, you either use the book values as the basis or the market value as the basis to arrive at the weights and calculate the weighted average cost of capital. And when the market value weights are given, always remember, the market value will be given only for that equity share capital component. So there will not be a separate market value for retained earnings, because this 160 lakhs is the market value of equity, that is equity shares as well as the retained earnings. So method 1, keep this 160 lakhs while computing the market value weights. Take this 160 lakhs under equity share capital. This is alternative 1. Or alternative number 2, take this 160 lakhs and split it between the equity share capital and retained earnings, the ratio of 80:40, and you proceed with the question. Are you clear with this? And with this, we have finished the first question, which is question number 1. Clear with this? Yes. So now let's go to the next question. The next question is interesting, and we have an incremental learning also. We will see a concept called as weighted marginal cost of capital. What it is now, we will see. And apart from that, we will also see component wise cost calculation. So all of this we will be seeing in the next question. Now, question number 2. XYZ Limited has the following book value capital structure. Capital structure means what? Basically, the components of capital is called as capital structure. Equity capital in shares of 10 each, fully paid up at par, 15 crore rupees, right? Then 11% preference share capital in shares of rupees 100 each, fully paid up at par, 1 crore rupees. Retained earnings 20 crores, 13.5% debentures of 100 each, 10 crores, 15% term loans, 12.5 crores. So in this question, term loans is also there. So term loans, I told you it is KT, correct? Cost of term loans, very simple. It is interest rate into 1 minus T. There is no concept of redemption value, net proceeds and all. It is always principal repayment. That's about it. The only cost is your interest cost. We have seen all these things. Then one paragraph is given below. What for they have given this paragraph? Generally, they give this in this paragraph, they will give you a lot of hints to use the right method to apply the formula for KE, KD, KP calculation and all. Are you clear with this? The next expected dividend on equity shares per share is going to be 3.6. Read the words very carefully. Next expected dividend, which means what? D1 is going to be 3.6. The dividend per share is expected to grow at the rate of 7%. Very clear. And the present market price per share is 40. What method they are saying? This is for KE calculation under what? Dividend growth model. That is KE is equal to D1 by P0 plus G. D1 is there 3.6, P0 is 40 plus G 7%. That's all. One look at the question, you have calculated KE. As simple as that. Remember, this is not D0, this is D1. Why? Because they have given next expected dividend. Annual cash flow at the end of year 1. Are you clear? Cash flow at the end of year 1. That is what we saw in the time value of money concept. D1. Are you clear with this? And this D1 figure is ready-madely given. Don't do this into 1 plus D. No, the answer will be wrong. This itself is the next year dividend only. Then, preference stock is redeemable after 10 years and is currently selling at 95 rupees per share. So with respect to preference shares, what they have given? They have given the life of the preference shares. Yes, life, which means redeemable preference shares. Correct or not? Yes. Now, what are they given? The currently it is selling at how much? 75 rupees, which means today if I raise the money through the preference share board, I will get a net proceed of how much? 75 rupees. Any flotation cost given? Nothing has been given. Are you clear with this? Then I also need the redemption value in the absence of information. Nothing is mentioned. You can assume it as redeemable at par. And what is the par value? 100 rupees. Are you clear with this? So if I issue today, I will be getting 75 rupees, which is the net proceeds. Redemption value is going to be how much? 100 rupees. Preference dividend, we know it is how much percentage? Preference dividend is 11%. All this data we have. So with this, we can easily calculate it. Are you clear with this? Then debentures redeemable after 6 years are selling at 80 rupees per debenture. So now for debentures also they have given the life. What is the life? 6%, which means what? Finite life, redeemable debentures. So now net proceeds for debentures is going to be 80. What is the redemption value, redeemable or redemption value? Nothing has been mentioned. Assume that it is going to be redeemed at par. Are you clear with this? Don't question the question further. Whatever is the data given, that alone you use. Any other data not given, you can take a fair assumption. And in this chapter, these are the fair assumptions that are allowed. Are you clear with this? Learn the rules of the game. Next, the income tax rate for the company is given as 40%. This is what they have given. Income tax rate for the company is only given, which means there is no personal income tax rate. Are you clear with this? So in this case, retained earnings and all, KR is equal to KE directly you can do. Are you clear with this? So this is what is the present data given in the question. Required. Calculate the weighted average cost of capital using book value proportions and market value proportions. Sir, in this question, market value is not given. Who said it is not given? For respective, they have given you the market price per share. Equity shares they have given, preference shares also they have given, debentures also they have given. So multiply the market price per equity share into number of shares, market price per preference shares into number of preference shares, then market value of debentures into number of debentures. You will get the market value and use that as a weight to again compute your weighted average cost of capital. Are you clear with this? So it need not be separately given in the tabular format. Using this also you can compute the market value weights. Are you clear with this? Yes. Then the second part of the question is what? We are going to learn something new here in this question. We are going to see something new in this question. Of course, we have learned all these things in our regular classes, but yes, we are going to revise it for the first time in this marathon. Now, define the weighted marginal cost of capital schedule for the company if it raises 10 crores in the next year, given the following information. Now, what they are saying, this additional information is not for this data. They are saying the company currently has 15 crores equity, 1 crore preference, 20 crores retained earnings, 10 crores debentures, 12.5 crores term loans. Correct. This is what the company has. For this, you compute weighted average cost of capital. Right? That's about it. Now they are saying the company is planning to raise 10 crore rupees more. Further, they are going to raise how much? 10 crore rupees. Correct. They are going to raise 10 crores. And this 10 crores, how it will be raising this, given the information, the amount will be raised by equity and debt in equal proportion. This amount is not there in the books. Newly they are going to raise. Are you clear with this? So for the 10 crores they are going to raise, they have given the following data. Amount will be raised by equity and debt in equal proportion. The company expects to retain 1.5 crores earnings next year. The additional issue of equity shares will result in a net price of share being fixed at 32. So for the purpose of fresh issue, the
cost, that is the market value of equity share will be taken as, the P0 will be taken as 32. The debt capital raised by way of term loans will cost 15% for the first 2.5 crores and 16% for the next 2.5 crores. Define the weighted marginal cost of capital. Meaning what? Marginal. What does this word marginal stand for? Marginal means incremental. Marginal costing. Yes. So marginal means what? Incremental. So for this extra 10 lakhs, the 10 crores that I'm going to raise, what is going to be my weighted marginal cost of capital? Is this entire 10 crores going to come from one source, like equity or debt? No. Equity, debt, there are so many combinations there. So for this extra 10 crores, what is the weighted marginal cost of capital is the calculation that is done in the second part of the question. Are you clear with this? First, let us do the first part. For the second part, you should use all this data. Now, first, forget the second part. Using this data, let's do the first part of the question. And once we are done with that, we can move to the second part of the question. Are you clear with this? So broadly, this is a chapter all about calculation of WACC and weighted marginal cost of capital and each of the components calculation. This is the overall chapter's entire concepts involved here. So now let's get started with the first part of the question, wherein they've asked us to calculate the weighted average cost of capital using the book value weights, market value weights. Now, when we have to compute the weighted average cost of capital, you can't jump to the question directly. What you need to do, component wise cost we need to calculate. Correct or not? Yes. So now first, part 1 is weighted average cost of capital. Part 2 is what? Weighted marginal cost of capital. We will come to that in a few minutes from now. First, calculation of KE and KR. Why have they merged KE as well as KR? Because KR is always equal to KE. Only if those two exceptions apply, KR calculation should be done separately. In this case, you tell me, for KE calculation, do we use any flotation cost and all? Nothing we are using. Correct? It is not a fresh issue. It is a present equity share only. Correct? And is there any personal income tax or brokerage given in the question? No. In this case, automatically KR will be equal to KE. Yes. So automatically, once you calculate KE, you can use that also for saying, you can use that and say that that is also your KR. Are you clear with this? Yes. Now, KE, how will you calculate which formula? There are so many formulas like CAPM formulas, you have your IRR formula, you have your constant dividend formula, your constant earnings formula, dividend growth rate, constant your dividend growth rate, earning growth rate. There's so many formulas here. Which formula we are going to use here? Very clear with the wordings of the question. So they have given the next expected dividend growth rate and all, and the present value, the present market price per share. So it's clearly your dividend growth rate model, Gordon's model in that dividend growth rate. So basically the formula that we'll be using is K is equal to D1 by P0 plus G. Correct or not? Yes, D1 by P0 plus G. Yes. Now this is for the present equity shares that we have. Yes, guys, are you clear with this? So now what is D1? 3.6. Correct. What is P0? 40. And what is G? 7%. Correct or not? So 3.6 upon 40 plus 0.07. 3.6 upon 40 is equal to 9% plus 7%. That gives you how much? 16%. So KE is equal to KR is equal to 16%. And in this case, KE is equal to KR because those two exceptions are not applicable here. If they had given flotation cost and all these things, or if they had given that for fresh equity shares that newly issued and all these things, then yes, KR calculation should be done separately. Or if they had given brokerage or personal income tax, then you need to do it separately. In this case, no such thing is given. So basically, the cost KR is equal to the cost of existing equity shares. We know that. Are you clear with this? So automatically, you can take this. Why the logic and all we saw? Because KR is nothing but cost of retained earnings. Retained earnings also belongs to the equity shareholders. So KR is equal to KE. Next, calculation of KP. Now, look at this. Calculation of KP. Now, what is it they have given in preference shares? The preference stock is redeemable after 10 years and is currently selling at 75 rupees per share. This is what? Redeemable preference shares, which means redeemable preference shares or redeemable debentures, redeemable preference shares and all. You have two ways of arriving at the answer. First method is IRR method. So what you will do, frame the cash flow equation, take randomly, you should take two trials. 10%, 12% or 10%, 15% or whatever it is, you will take two trials. One will have a positive NPV, one will have a negative NPV, interpolate and get the answer. That is a trial and error method, IRR method. Or the second method is what? Shortcut method. Correct? The formula approach. Yes. Now, what is the formula to calculate your KP? So, come on. You tell along with me. Logically think and you tell along with me. In case of preference, so in the numerator, you should have the cost, right? So what is the cost you have? preference dividend plus RV minus NP divided by N, the whole by RV plus NP divided by 2. Yes or no? Yes or no? Yes. So now preference dividend. How much is preference dividend per share? How much is it? So preference dividend is given as how much? So it is going to be 11%. Correct or not? So 11% on 100. So every share, the dividend amount is going to be 11 rupees. Correct? It's going to be 11 rupees. Plus redemption value. Redemption value, how much is it? It is not given the question. See, it is redeemable after 10 years, currently selling at 75 rupees. So the net proceeds is how much? 75. That is, if I raise today, I will get 75 and I need to redeem it at what? Nothing is given. So you will redeem it at par. Are you clear with this? So RV is 100 and NP is going to be 75 rupees. So look at this. RV is 100 redemption value minus NP net proceeds is 75 divided by the life of this particular preference shares divided by 10, the whole divided by RV plus NP by 2. So 100 plus 75 by 2. Are you clear with this? So I am issuing it at 75, redeeming it at 100, which means I'm paying 25 rupees more. That is the cost I incur extra. Yes, but that is a cost pertaining to 10 years. How much is the cost pertaining to 1 year? That's why we have done. So 25 divided by 10. Are you clear with this? Because this 11 is also an annual cost. So you should only have an amortized annual cost for this redemption extra amount that you are paying. Are you clear with this? And then will you take the redemption value or the net proceeds? Take a simple average of 2. So now tell me how much is this going to be? So this is going to be 13.5 in the numerator. So 175 by 2, that's going to be 87.5. So 87.5. So this is going to be 15.4285%, rounded off to 15.43%. Are you clear with this? Yes. Now rounding off again, many students have some doubt. Sir, how can I round off? As in, so should I stop at 2 decimals or should I retain all the decimals? I would suggest you at least have 4 decimals generally in this sum. Yes, it is solved like this. Generally, it is better to have 4 decimals. It is always better to have. It's a global policy. That's what people generally follow in the world of finance. They take 4 decimals. So generally take 4 decimals. 3 or 4, preferably 4 decimals you take. Yes, and then you can actually calculate. But rounding off should be done. Even this 4 decimals round off. I'm telling you to stop at 4 decimals. That can be done only the final step. That is at the time of calculating the cost of that particular source of finance. In between and on, you don't round off anything. Finally, for KP or KD, the final step, yes, you can round off and keep it as 4 decimals. Are you clear with this? So if you round off, if you take only 2 decimals or if you take 4 decimals, between these two answers, there will be a slight difference in the overall answer. Weighted average cost of capital, yes, rounding off issue will always be there. So don't worry about it. Don't worry about it. For that, marks will not be reduced. Understand, this is more to do with conceptual clarity and the way you solve it. So the decimals and all, I'm telling you, you take a policy. You tell yourself that for all the sums I'm going to take 4 decimals. You follow it. Throughout the exam paper, you follow 4 decimals. It's absolutely fine. In certain questions, they themselves will give you, stop at 3 decimals. Then you follow whatever is given in the question. If nothing is given, you can take 4 decimals and you can leave it there. Are you clear with this? Yes. Next, calculation of KD. Now, look at this KD. Debentures are redeemable after 6 years. So this is also what? This is also a redeemable debentures. So in case of redeemable debentures, there are 2 ways of computing the KD. One is your IRR method. The other one is a shortcut formula method. So what is the formula for calculating KD? Now look at this. They are redeemable after 6 years and are selling at 80 rupees per debenture. So if I raise today, the net proceeds will be 80 rupees. No flotation cost and all. Nothing has been given. Why? Because nothing is given, so you can take it as 0. Then redemption value silent, so you will assume that it is redeemed at par. Are you clear with this? And what is the interest rate on debentures? It is going to be 13.5%. Are you clear with this? So now, what is going to be the formula for calculating KD? Come on, guys, tell me. So KD is equal to, yes, I into 1 minus T. Correct? Always remember, interest outflow is when I pay interest, I will get a parallel savings of tax. So the net outflow will only be I into 1 minus T, correct? Plus RV minus NP divided by N. In this case, the life is 6 years. The whole divided by RV plus NP divided by 2. Are you clear with this? Logically understand, and as simple as that, you need not do anything else. You just need to remember this conceptually. Any kind of sum you can tackle by yourself. So now, tell me what is the interest here? 13.5 rupees into 1 minus 0.4. So the tax rate is given as 40%. So 1 second, where is it? Yes, the tax rate is given as 40%. Correct? So now look at this. So 13.5 rupees into 1 minus 0.4 plus redemption value 100 minus net proceeds 80. So extra I'm paying them how much? 20 rupees. 20 divided by 6, correct? Life of the asset, the whole divided by 180 plus 80 divided by 2. So finally you get how much? You get 12.7 percentage as your KD calculation. Are you clear with this? Are you clear with this? Yes. So now this is also done. So KE is done, KP is done. Yes, K is equal to KR. So KR is also done. KD is done. And finally, KT we need to calculate. What is KT? Cost of term loans. Very simple. There is no concept of your net proceeds or redemption value or not. Always, when it comes to term loans, it is just a question of your principal and repayment of interest. The only cost associated to it is interest. But wait, this interest is also tax deductible. So KT is equal to interest rate into 1 minus T. Directly you can do. So 15% into 1 minus 0.4. Are you clear with this? So KT is going to be 15% into 1 minus 0.4. That is going to be 9%. Yes. So now we have all the figures with us. We have all the sources of finance, all the costs of each and every source of finance. So now let's directly jump to what? Calculation of weighted average cost of capital using book value weights. So if this sum comes, it will come for a 10-mark question because it's a completely comprehensive question. Even the previous question, if it comes, it will come only for 10 marks. Even if this comes, it can come for 10 marks. Are you clear with this? Yes. So now look at this. Look at this. Now, so cost of equity, preference, debentures, retained earnings, and loan. Now, first, let us take the book value of each and every component. Book value is a given, yes. 15 crore, 1 crore, 20 crore, 10 crore, and 12.5 crores. Correct? So you just put it here. 15 crore, 1 crore, yes. 10 crore, 20 crore. So debentures and then retained earnings and then loan they have given 12.5 crores. Overall, if you do, it's going to be 58.5. Calculate the weights. 15 divided by 58.5, it's going to be 0.256. 1 by 58.5, 0.017. Then 10 by 58.5 is going to be 0.171. 20 upon 58.5 is going to be 0.342. Then 12.5 upon 58.5 is going to be 0.214. And this is overall weights. If you add up, it will obviously equal to 1. Are you clear with this? Now, component wise, we have the cost, correct? What is KE? So KE is going to be how much? K is going to be 60%, 16%, correct? So 16% is the cost KE, and remember the same KE is equal to KR in this question. So KR also you can fill up the 16%. Next, KP. What is KP here? So KP we have calculated it 15.43%. KP is going to be 15.43%. Then debentures KD 12.7%, 12.7%, and KT, the cost of term loan, is going to be 9%. Are you clear with this? So multiply the weights with the respective cost. So 0.256 into 16% plus 0.017 into 15.43% and so on. You multiply the weights with the cost. Overall, you get 13.928. This is your overall cost of capital under the book value weights. Are you clear with this? Are you clear with this? Yes. Now, similarly, you need to redo this calculation of WACC using market value weights. Now, can we do this? Yes. Again, equity, preference, debentures, loan. I told you, there are two ways in which you can do this. So the market value of equity, you can just take it as market value of equity, and under retained earnings, you can put it as 0, or the market value of equity can be split between the equity share capital and retained earnings in their book value proportions. Are you clear with this? In this sum, just like the previous sum, we have taken the entire value of equity. We have taken the entire market value of equity and put it under the equity share capital only. Are you clear with this? Yes. So now, first let us compute the market value of every source of finance. The first one, the market price per share is how much? It's given as 40 rupees, correct? Now, how many shares are there? So look at this, 15 crore divided by 10. So 1.5 crore shares are there into 1.5 crores into 40. So 1.5 crores into 40, how much is that? 60 crores is the market value of equity. Are you clear with this? 60 crores is the market value of equity. All these rupees are in crores. They are in crores. Are you clear with this? Second, let's go for preference shares. So what is the market price of preference shares? 75 rupees. Are you clear with this? They have given it as 75 rupees. Now, how many preference shares are there? So the preference share capital, currently the value is 1 crore divided by 100. So 1 crore divided by 100, 1 crore divided by 100 into that is 0.01 crores into into, so what is the current preference share value? It is going to be 75, correct or not? Yes, into 75, it's going to be 0.75 crores is the market value. So this is what? This is the number of preference shares. So how can it be in decimal? Wait, this is not decimal. 0.01 crores, which means 1 lakh. Are you clear with this? 0.01 crore is nothing but 1 lakh. 1 lakh preference shares into 75 rupees per share, 75 lakhs. That's why you get an overall of 0.75 crores. 0.75 crores is nothing but 75 lakhs. Are you clear with this? So you get a market value of how much? 0.75 crores. Are you clear with this? Yes. Then debentures. What is the market value of debentures? The market value of debentures, look at this. Currently the debentures are selling at how much? 80 rupees per debenture. So what is the total number of debentures? 10 crores divided by 100. So 10 crores divided by 100. Currently you have 0.1 crore, that is 10 lakh debentures you have. And every debenture is having a market value of 80. Are you clear with this? So overall, the market value of debentures is going to be 8 crores. Guys, are you all able to understand? 0.1 crores means what? 10 lakhs. 10 lakh is the number of debentures. Every debenture has a market value of 80 rupees. 10 lakh into 80 is how much? 800 lakhs, or in other words, it is 8 crores. Are you clear with this? And the market value of debentures is how much? 8 crores. Are you clear with this? Yes. Then finally, the market value of loan. Now, loan does not have a separate market value and all. Whatever is the book value, that is only the market value. Because if you see, there is a debt market in which debentures will be traded. Are you clear with this? There is an equity market in which your equity shares can be traded. Even preference shares are listed and they can also be traded. Whereas term loans cannot be traded separately and all. It is between the bank and the particular company that has borrowed the money. That's about it. It does not have a ready market value. Always remember, for term loan, the book value is equal to market value. Market value separately is not there. Whatever is the book value is the market value. So take it as 12.5 crores. Are you clear with this? Take it as 12.5 crores. So now this totals up to how much? 60 plus 0.75 plus 8 plus 12.5, that gives you how much? 81.25. Calculate the proportions. 60 upon 81.25 gives you 0.738. 0.75 divided by 81.25 gives you 0.009. 8 upon 81.25 gives you 0.098. 12.5 upon 81.25 gives you 0.155. That gives a total weight of 1. Now, what is the respective cost of capital? Yes, the respective cost we already know. Equity 16%, preference 15.43. Yes, you can copy paste the figures from here. Debentures 12.7. Then retained earnings, not a separate line item because it is already included in the value of equity. Are you clear with this? Because we have taken market value weights here. So market value of equity includes what? The market value of equity share capital plus the market value of retained earnings. Are you clear with this? Then loan is 9%. So you multiply the weights with the respective cost. So if you compute the weighted average cost of capital from the market value weights perspective, you will get KO as equal to 14.587%. Are you clear with this? And with this, we have finished the first part of the question, that is calculation of weighted average cost of capital using book value weights and using market value weights. Are you clear with this? Yes. Now, let's go to the second part of the question. And in the second part of the question, remember, for the second part, the first part was what? The company already has the sources of finance for which they have given all the figures and they have computed. Now they are saying define the weighted marginal cost of capital schedule. So define the weighted marginal cost of capital schedule means what? Define means it is not a definition. They are asking you for the schedule. What is the schedule? I will tell you now. If it raises 10 crores next year, following is the information given below. The amount will be raised by equity and debt in equal proportions. Now wait, the company is going to raise how much? Now let me just put it here. Yes, the weighted marginal cost of capital. The company is going to raise how much? 10 crores. Correct? Yes. Read line by line. The amount will be raised by equity and debt in equal proportion. So the company is going to raise 10 crores. So which means out of this, from the equity channel, the company is going to raise how much? 5 crores. And from the debt channel, the company is going to raise 5 crores. How do we know? Exactly 50-50. That is what is given here. Correct or not? Yes. Now, the company expects to retain 1.5 crores earnings next year. So what they are saying is retained earnings, which will be used for funding this extra 10 crores is how much? So they are saying the retained earnings that will be used for this particular funding is how much? It is going to be 1.5 crores. So retained earnings comes under the equity component only, correct or not? So which means what? Which means what? The remaining 3.5 crores of the equity component will come from new equity shares. So new equity shares will have to be issued to the tune of 3.5 crores. How do we know this? This is the balancing figure. Pencil circle balancing figure. Out of the 5 crores equity component, 1.5 crores will come from retained earnings, which means the balance 3.5 crores will be coming from what is the source of finance? Equity only. So obviously retained earnings to the extent of 1.5 only it is available, which means the balance 3.5 will have to be necessarily issued as a fresh equity capital. Are you clear with this? Yes, then. The additional issue of equity shares will result in the net price of share being fixed at 32. So for this fresh issue, the share price will be fixed at 32 rupees. Then the debt capital raised by way of term loans will cost 15% for the first 2.5 crores and 16% for the next 2.5 crores. Interesting. So this debt of 5 crores is given in the question, right? This debt also, it is not like entire debt of 5 crores is having one cost. They are saying there are two different types of debt. Here if you see, there is 15%. What is this? A debt model they have said term loans. So 15% term loans will be 2.5 crores and the balance 2.5 crores will be having how much percentage? Will be having 16%. This is what is given in the question. So basically the next 10 crores, what is the source of finance? 1.5 crores from your retained earnings, 3.5 crores from issue of fresh equity share. This is not existing equity share, fresh equity share, which means what? You need to recalculate for the fresh equity shares. You need to calculate the KE once again. Are you clear with this? That KE was for the current equity share. This is for what new equity shares you're going to issue. For this, the market price is different. So once again, you need to recompute the KE for the purpose of this fresh issue. Then there is 15% term loan for 2.5 crores, 15% term loan for 15% term loan for first 2.5 crores, 16% term loans for the next 2.5 crores. Are you clear with this? This is what we need to compute. So what we need to do here, for each of these source of finance, we should now compute the cost and then multiply it with the respective weights. You will get the weighted marginal cost of capital. That is, we are computing the cost of this extra 10 crore rupees. We are not at all talking about the current cost of capital. Extra, for the extra 10 crores, overall what is the cost? See, to the extent of 1.5 crores, the cost is different. For this 3.5 crores, the cost is different. For 2.5 crores, the cost is different. The next 2.5 crores, the cost is different. Overall, for the 10 crores, what is the weighted marginal cost of capital? Why marginal? Because it's a new amount that you're going to raise. Fresh amount you're going to raise. Are you clear with this? Yes. So now, let's get started with this. So now, look at this. So first, this is what they have given. And this question they have asked you, right? Define the schedule they have given. Correct? So read the question. Define the weighted marginal cost of capital schedule. This is only called as the weighted marginal cost of capital schedule. So what is the schedule in which, how are they going to raise the funds? This is how they are going to raise the funds, and this is only called as schedule. Are you clear with this? Or you can also put it in a line by line format as given in the question. Equity is 5. So from this equity share capital is 3.5, retained earnings 1.5. That is what we did. 1.5 crores is retained earnings, 3.5 crores is equity shares, new equity shares. Then debt is 5. In that 15% term loan, 2.5 crores, 16% term loan is 2.5 crores. Sir, in exam, can I put it in this flowchart format? Absolutely yes. No problem at all. You can definitely do it like this. They will not reduce any marks. Are you clear with this? But make sure that you're writing TL and all. You don't write it as term loan. Just make sure that you're writing it fully. That's about it. But definitely you can use this. Yes, you will have complete grip over this particular area. Now, what we need to calculate first, for this new equity shares, we need to calculate what? We need to calculate KE. Correct? Yes. So now, what formula will you use? Now, look at this. Look at this. The additional issue of equity share will result in the net price of share being fixed at 32 rupees. Now, in this question, they have given initially itself the dividends are growing. Correct? So, KE is equal to D1 by P0 plus G. Correct or not? Yes. Now, in this question, do we have D1? The next year's expected dividend is 3.6. Yes. Can we use that? Yes, because for all the equity shares, the present as well as for the new equity shares, the dividend rate will be the same. 3.6 divided by P0, the amount that I'm going to raise today, the present value of all the equity shares is going to be how much? 32. With respect to the fresh equity, it's going to be 32. This is different. Are you clear with this? For this equity shares. Plus G, yes, the growth rate will be same for all the equity shares issued by the company, which is 7%. Are you clear with this? 0.07. So in this case, PO alone changes, and because of that, KE for the fresh equity shares will change. Are you clear with this? Are you clear with this? So that means 3.6 divided by 32 is going to be 11.25% plus 0.07, right? 0.07. Yes, it's going to be 18.25% is going to be the cost of fresh equity shares. Are you clear with this? And that is what is being done here in this area. Look at this. D1 by P0 plus G, 3.6 upon 32. This 32 is the your P0 or the present market price, the net proceeds of the fresh issue. Are you clear with this? Plus 0.07, it's going to be 18.25. So this D1 and G we have taken from the first data. Sir, how we can take from the first data this alone? Yes, because for all the equity shares, the dividend will be paid alike. I cannot say, okay, now I have issued fresh equity shares. For this equity shares, I will not pay dividend. For the existing shares alone, I will pay dividend. No, you cannot do this. Your company law does not allow it. For the existing or the new equity shares, the dividend has to be alike. There cannot be any discrimination between the shareholders. Are you clear with this? So that is the reason we are doing it. So the growth rate and dividend and all will be the same, whereas what changes is only P0. Are you clear with this? Yes, because of the change in PO, the KE for the new capital is going to be different. It's going to be 18.25%. Now, very interesting. What will be KR? What will be KR? I said KR will be equal to KE of existing share capital, of existing equity shares, and I told you KR is not equal to KE of new equity shares. Correct or not? Now in this case, KR is equal to how much? It is not 18.25. Why? Because 18.25 is the KE of the new equity shares, whereas for the purpose of taking KR, I will go to my first part calculation. I will take it as 16%. Sir, why is it 16%? Because with respect to KR, it is only the KE. KR is equal to KE of existing equity shares. I am not issuing anything afresh. I already have the money in my bank account. Are you clear with this? So here the fresh price or the flotation cost and all should not be considered. So it continues to be 16%. Very, very important. Again, time and again students make a mistake here. So KR is equal to 16%. Are you clear with this? As simple as that. So now new KE is going how much? So now 18.25, correct? So now the new KE is going to be how much? KE is equal to 18.25. We just calculated. KR is equal to how much? 16%. We just saw 16%. Yes, 16%. Now KT is going to be how much? Cost of term loan. Very simple. The interest rate into 1 minus T. So for the first 2.5 crores, 15% into 1 minus 0.4, which is equal to 9%. So for this, the KT is going to be 9%, and here it's going to be 16 into 1 minus 0.4, which is going to be 9.6%. It is going to be KT is equal to 9.6%. So now for the extra capital of 10 crores, you know what is the amount from each source, and you also know the respective costs associated with it. You just need to weight it average, and whatever answer you get is the weighted marginal cost of capital. This is the new capital, marginal, incremental capital. Are you clear with this? Yes. So directly now you can go and compute the weighted marginal cost of capital. Equity, retained earnings, 15% term loan and 16% term loan. Equity is how much? 3.5 crores. Retained earnings, 1.5 crores. Term loan is going to be 2.5, and 15% term loan is 2.5, 16% term loan is 2.5. The weights will be 0.35, 0.15, 0.25 and 0.25. Cost will be what? Equity, cost of equity is 18.25. Very, very important. That's why I marked it in red ink. Cost of retained earnings, KR is equal to KE of existing equity shares. I told you the two exceptions. You remember? See how beautifully they have applied it and asked in this question. It is going to be 16%, not 18.25%. 16% is what the KE of the existing equity shares. Are you clear with this? Term loans is going to be 9%. 16% term loans is going to be 9.6%. So multiply the weights with the cost. 0.35 into 18.25 gives you 6.3875%. 0.15 for 16% gives you 2.4%. 0.25 into 9 gives you 2.25. 0.25 into 9.6 gives you 2.4 percentage. So for this extra 10 crores that you are going to raise, overall weighted marginal cost of capital is going to be how much? 13.4375 percentage. So basically for the extra capital that I'm going to raise, this is the overall cost for the next 10 crores. Then, sir, what was the weighted average cost of capital? This 13.928 and this 14.587 and all. This is nothing but the cost of capital for the existing capital that I already have. Are you clear with this? That's why it's called as weighted average cost of capital. Whereas the second part is called as weighted marginal cost of capital. So marginal means the incremental. So for the extra amount that I am going to raise, for that, whatever is the cost is what is being mentioned here. Are you clear with this? So with this, all the major and important concepts of this particular chapter are over, right? So now please revise this chapter once so that you get a conceptual clarity, and please, for God's sake, don't ever mug up any formulas. Learn it conceptually, and automatically in the exam hall, on the spot, you will be able to write the formulas all by yourself. You need not mug it up. You can automatically say the logic behind every formula. That's how you should learn this particular subject. If you mug it up, then obviously you won't know what to apply, which method to apply in which scenario. Are you clear with this? So for you to get a complete control over this subject, it is purely conceptual based understanding. That's how you need to learn the subject. And I've taken 2 comprehensive questions. And sir, is this all that is present in this particular chapter? Predominantly, yes. But there are so many other things. There are so many other concepts also in this particular chapter, like so many adjustments, small adjustments. But predominantly for the revision purpose, overall, this covers a predominant portion of this particular chapter. So with this, let us move to the next chapter. So now let's revise the second chapter. So the second chapter that we're going to revise is called leverages. Now, first of all, before we get into this, before we get into the revision of this particular chapter, first understand, what do you mean by a leverage? What do you mean by a leverage? Leverage means getting more results by putting lesser efforts. This is the meaning of leverage. Common layman word. The meaning is getting more results by putting less efforts. So something like chinna kallu pedda labam, right? So small efforts, but more, more results. That is the meaning of leverage. So can you give us an example? Yes, I can give you 2 examples. Example number 1. Now, let us say you are 60 kgs of weight. Okay, let us say you are 60 kgs of weight. Now, your friend is also approximately 60 kgs of weight. Let us assume. Now, if you want to lift your friend just like that, it will be very difficult. I'm not saying it is impossible. It will be very difficult. But even if you lift him, maybe in a span of next 5 seconds, you will just drop him back. Correct? You will have to put a lot of efforts in lifting him. It's very difficult basically to lift another human being who is of the same weight as that you are. Am I right? But now, if you see, recall your childhood days where we used to play something called as seesaw. Yeah, you know the seesaw? So it will be like this, and 2 people will sit here. So one person will be sitting on one side, the other person will be sitting on other side. Have you ever wondered if, let us assume, both these people are of the same weight, 60 kgs, just an example. Now, if I want to directly lift him, I find it very difficult. But if I use the seesaw, if I put my weight here, automatically the other guy is being lifted. Yes or no? And how is this possible? The same human being, without a seesaw, I'm finding it difficult to lift him. But with a seesaw, I just have to put little efforts, but I will get the same result. Are you clear with this? Why? Because this seesaw acts as a lever. And this is what is the meaning of leverage, and hence the name leverage. Why? Because if you have this here, the seesaw has something here in between, right? And you have some nails and all inside it. Fine. So this, if this guy goes down, this guy goes up, and vice versa. If he goes down, this guy goes up. Yes, but this is called as leverage. That is more results by putting lesser efforts, more like a smart working. This is why I said chinna kallu pedda labam, right? Something of that sort. Are you clear with this? That is the meaning of leverage. Sir, how is this related to financial management? I will connect the dots. You don't worry about it. But for the time being, you just follow whatever I'm saying. So basically, what do you mean by leverage? Lesser effort and more result. So your effort should be less, and for the lesser effort, you will get more result. Are you clear with this? One more example. Now, have you seen a well? A well, as in, it has water in it, that well. Okay. So typically now we don't have wells in cities, but yes, in rural areas, there are still wells, right? Now, if you see here in this well, okay, so a person can lift water from this well directly, he can tie a rope, yes, put a bucket, automatically he can just throw it inside, take the water, yes, he can pull. But still, have you wondered why they are using this something called as pulley? Yes, have you seen this pulley? So the thread will be, the rope will be tied to this, and from this they will actually hang this particular bucket. But why do they do that? Because now, if you have this lever or if you have this pulley, it is easy for you to draw the water from the well. Are you clear with this? In this case, this acts as a lever. Less efforts and more results. Are you clear with this? So basically, leverage stands for, this is the meaning of leverage. Leverage means getting more results by putting lesser efforts. Are you clear with this? Now, how it is concerned with financial management, I'm coming to it. Fine, are you clear? First, know the reason, know the logic, and know the conceptual background for every chapter, which is very, very important. Right. So we saw what is the meaning of leverage. Right. This is one thing. Park it aside. Now, one more thing I want to tell you. One more thing before we enter into this chapter. One more thing I want to tell you. Now, in a company, basically in any organization, fixed cost is of two types. Don't worry, I will connect all these things. First, understand a few things, and then I will connect all the dots. You need not have to worry. Fixed cost can be broadly classified into two. Fixed operating cost and fixed financial cost. Sir, what is the meaning? First of all, what do you mean by fixed cost? A cost that remains constant in total. So it will not change with your change in volume. Basically, you would have learned this in your costing. For those who have not studied costing, fine. Fixed cost means this. Common sense, it will not change no matter what. No matter what, if there is a change in sales, if you increase your volume or decrease your volume, this cost will not change. It will remain as such. Now, fixed cost, sir, you are classifying this into two: fixed operating cost, fixed financial cost. Fixed operating cost, example, if you want, fixed operating cost. In costing, you would have studied production overheads, administration overheads, selling and distribution overheads. Correct? So examples for this could be salary, rent. See, salary, your rent, etc. Salary, if it is paid for factory, it comes under POH, production overheads. If the salary is paid for administrative office, it is called as AOH. If the salary is paid for a sales staff, it is called as selling and distribution overheads. So broadly, POH, AOH, and SOH. This is what comprises of your fixed operating cost, or in other words, the fixed costs that are related to my operations is called as fixed operating cost. All the fixed costs that you have studied in your costing paper is called as fixed operating cost. So, fixed financial cost means what? The fixed costs that are associated with the fundraising activity, associated with your sources of finance, is called as fixed financial cost. What is it, sir? The first one is interest on debentures or term loans, and the second one is dividend on preference shares. These two are the fixed financial cost. And remember, in costing, any financial cost is not at all considered for the purpose of arriving at the profit. Are you clear with this? Whereas all these finance related costs are considered only in this subject called as financial management. Are you clear with this? So fixed cost can be broadly classified into fixed operating cost, fixed financial cost. Fixed operating cost means what? Any fixed cost that is incurred for your operations, broadly your production overheads, admin overheads, and selling overheads. And here fixed financial cost means what? The financial cost that is the fixed cost that is associated with your fundraising activity, source of finance, broadly your interest on debentures and term loan, and your dividend on preference shares. Are you clear with this? Yes. These two are what? These two are the fixed financial cost. Sir, dividend on equity shares, it is not a fixed financial cost. We just saw right now. Dividend, equity dividend, there is no contractual obligation for the company to pay every year. Correct? There is no contractual obligation. 1 year, if they want, they can pay. If they don't want, they cannot pay. Whereas fixed cost doesn't have that option. No matter what, you need to pay. So like that, there are only two. Broadly, there are only two fixed financial costs: interest on any of your borrowings, that is debentures or term loan, and dividend on preference shares. Are you clear with this? Yes. Now, with this backdrop, let us get into the profitability statement. Don't worry, I will connect all the dots. You need not have to worry, I will connect all the dots. Fine, even if you're watching this for the first time, you need not have to worry, I will connect the dots. First, I went on to say, what do you mean by leverage? Then I went on to say, classify fixed cost into fixed operating and fixed financial cost. And now we are seeing profitability statement. Trust me, I will link everything and then we will properly enter into this chapter. We will revise this chapter very quickly and in a very logical manner. Now, look at this. So this is your profitability statement. You ignore all these things. I'm here to explain this. First, let us look at profitability statement. So how will your profitability statement look like? Sales, that is the topmost, the first line item, sales, less variable cost gives you contribution. What do you mean by variable cost? A cost that varies with my production. Example for this is going to be direct material, direct labor, direct expenses and all. Technically, all these are a subject matter of discussion in costing. Clear? Sales minus variable cost gives you what? Contribution. Nothing but sales minus variable cost gives you variable profit. And variable profit is only called as what? Contribution. Correct? Is this the final profit? No. Why? Because fixed cost is yet to be adjusted. Are you clear with this? Sales minus variable cost gives you contribution. Contribution minus fixed cost. Here, fixed cost means what? Fixed operating cost, that is AOH, POH, SOH. I just told you, right? So contribution minus fixed operating cost gives you what? Operating profit. Correct? Operating profit, or in other words, EBIT. So technically, your costing subject stops here at EBIT level. Are you clear with this? There, in costing, the subject matter of studies, sales minus variable cost gives you contribution minus fixed operating cost. Finance cost is not considered. Fixed operating cost gives you EBIT, or operating profit is popularly known as earnings before interest and tax. Are you clear with this? Now, FM begins from here only. EBIT means what? Earnings before interest and tax. So first reduce interest, minus interest gives you what? Earnings before tax. Yes. Now, minus tax gives you what? Earnings after tax. Correct? You can also call this as EAT, PAT or EAT. Anything is fine. Correct? Earnings after tax. Now, from earnings after tax, you reduce preference dividend. You get what? Net earnings available to equity shareholders. Are you clear with this? Yes. So this amount, this is the amount available to whom? Available to the equity shareholders of the company. Yes, if you divide this by the total number of equity shares, you will get something called as EPS, meaning what? Earnings per share. Are you clear with this? First of all, understand this profitability statement. You should know this by heart, and there is nothing to mug. There is nothing to mug it up. Basically, you can learn this conceptually. So what is your profitability statement? Sales minus variable cost gives you contribution, minus fixed operating cost gives you what? Gives you EBIT, operating profit. Actually, costing stops here and FM begins. EBIT minus interest gives you what? EBT, earnings before. EBIT minus interest gives you EBT, earnings before tax. Minus tax gives you what? Earnings after tax, EAT. Then minus preference dividend gives you net profit available to equity shareholders. This divided by number of equity shares gives you EPS, that is earnings per share. Are you clear with this? This is the overall profitability statement. Are you clear with this? And if you see, fixed cost can be what? Fixed operating cost, or it can be what? It can be fixed financial cost. In this case, what is the fixed financial cost? Interest and preference dividend. These two put together is your fixed financial cost. Are you clear with this? Whereas this figure is your fixed operating cost. In this chapter, this fixed operating cost and fixed financial cost is the hero. Actually, it plays around. The entire chapter we are studying, the concept of leverage itself, we are studying only because of the presence of fixed financial and fixed operating cost. I will explain more logic. Fine. So now, first understand, in this entire statement, you can find what? Fixed operating cost here. Then less interest and preference dividend. Interest and preference dividend put together is what? Fixed financial cost. Now, one more doubt you might have. I have seen students getting this doubt. Sir, now in your operating fixed cost, you have considered your production overheads, administration overheads, selling overheads. Perfect, sir. In your fixed financial cost, you are considering interest and preference dividend. Perfect. Now, sir, there is one more line item called tax. Correct? Tax is also an expense only, no, sir? Yes, yes. Now, this tax, you tell me, this, why are we not clubbing it under fixed financial cost? Now, first of all, understand, tax is a non-operating item. Are you clear with this? So, it is definitely not a part of your fixed operating cost. Are you clear with this? Yes, it is definitely not a part of your fixed operating cost. Now, what do you mean by finance related cost? Any cost that is paid towards fundraising activity, that is to the people who have given you finance. If you are paying them something in return, that is only called as what? Financial cost. Correct? For example, interest, it is paid for what? It is paid to debenture holders. Why do you pay? Just like that you pay? No, they have given you some debenture money, capital they have given you, for that you are paying something called as interest. Preference dividend, why do you pay? Because you have raised the money through the preference channel. Now you tell me, tax is not related to finance, or in other words, tax is not a finance related cost. It is not an expense that is incurred for raising any finance. It is the law of the land that says that if you earn some profit, you pay some tax. As simple as that. So tax, if you see, it is not a fixed amount. It is actually a percentage on my EBT, earnings before tax. Are you clear with this? Sir, then you can call it as a variable cost. No, it is not variable. Variable means what? It should move in proportion with your sales. Your tax will not move in proportion with your sales. It moves in proportion with your EBT, earnings before tax. Are you clear with this? So technically, tax is neither a variable nor a fixed. Sir? Why are you saying like this? Tax I need to pay to the government. Suppose you have zero profit. EBT is zero. Let us assume. Will you pay any tax? No. Correct? Then how can you call it a fixed cost? Correct? If you have an EBT of 100 crores, let's say the tax rate is 30%, then 30 crores will be your tax amount. Correct? But this 30 crores will not move in proportion to the sales. It moves in proportion only with your EBT. So first understand that this tax is a separate line item. This is a separate animal altogether. So don't worry much about it. This is not a finance related cost. Correct? This is also not an operating related cost. Are you clear with this? Then sir, why did we consider your tax component while computing KD and all in the cost of capital chapter? That we did to compute the cash flows. Correct? If I pay interest, there is a tax deduction practically. So for the purpose of computing the tax savings we did. Are you clear with this? But this is technically, this cannot be classified as a fixed cost and all. Are you clear with this? This is what I want to tell you. Right. Now, sir, so you mean to say basically this particular profitability statement, sales minus variable cost gives you contribution minus fixed operating cost gives you EBIT minus interest, EBT minus your minus tax gives you EAT, minus preference dividend gives you your net profit available to equity shareholders divided by number of equity shares gives you what? Your EPS, means what? Earnings per share. Simple. Now, sir, more the EPS means more the earnings. Is it true or not? More EPS means the company is earning more. Is it true or not? Absolutely not. I will give you an example. Let's say there are two companies, A Limited and B Limited, right? Let's say the earnings available to equity shareholders, for A Limited, let us say is 100 crores. For B Limited, let us say there is only 10 crores. Now, you will say, sir, A Limited is performing better, sir. Why? Because they are earning 100 crore rupees. B Limited is only making 10 crore rupees. But wait. Let's say the number of equity shares, let's say the number of equity shares in case of A Limited, there is 100 crore equity shares. Whereas in case of B Limited, there is only 1 crore equity shares. Now you tell me, earnings per share, every share will generate an earnings of how much? In case of A Limited, it will generate 1 rupee. Whereas in case of B Limited, it generates 10 rupees. So if you see, for B Limited, the EPS is more. Whereas in terms of total earnings, it is more for A Limited. So please don't jump to the conclusion saying that more earnings means more EPS. No, EPS is a function of earnings and the number of shares. So earnings and number of shares both will have to be considered to arrive at your EPS. So always remember, more earnings does not equal to more EPS. Have this in your mind, because this is the general misconception that students have. I would any day prefer Bree Limited. Why? Because for every share that I am buying in this company, it earns 10 rupees. Whereas for A Limited, for every share, it generates only 1 rupee. Are you clear with this? So more earnings does not mean more EPS. So this is one important understanding that you need to have. Right. So now, sir, why are we studying all this in the concept of leverage? Why are we studying all this in the concept of leverage? Now, let us get started. Now, in this chapter, there are 3 different types of leverages: operating leverage, financial leverage, combined leverage. 3 leverages are there in this chapter. Are you clear with this? Yes. Now, what do you mean by operating leverage? It shows the relationship between sales and EBIT, and it indicates business risk. Fine. Financial leverage. It shows the relationship between EBIT and EPS and indicates financial risk. Combined leverage. It shows the relationship between sales and EPS and indicates the total risk. Over. That's all. Chapter over. Right? Look. It is not just you read one line mug up. Absolutely not. This is filled with loads and loads of concepts. Now, let me just explain this concept to you. Now, this is where our I gave you what is the meaning of leverage. That is less efforts, more results. Correct? There, let us bring that into picture. First, let us start with operating leverage. Now, operating leverage is actually something that is concerned with your business risk. This has nothing to do with your financial items. It has something to do with your business risk. Or in other words, your operating leverage is calculated in your costing area. That is the first half of this profitability statement is where you calculate your operating leverage. Sir, what is the meaning of operating leverage? Wait, I will explain this to you by way of an example. See, these are very, very important in terms of understanding the concepts. These are very, very important. So you need not mug up any formulas. It is just a very, very logical area and you can automatically get all these formulas by yourself. Now, let me just take an example for this. The first one is what? Operating leverage. And what did they say? Operating leverage talks about the relationship between, one second, the relationship between what and what? Between sales and EBIT. Sir, what is this? I will give you a superb example here. Now, with this example, you will learn this entire concept of operating leverage. Now, let me just drop a tabular column, particulars, okay, and then 3 columns I'm drawing, okay, 3 columns. Let us call this as base. Please keep following this, or I will just call this as existing, okay, existing. Let's put it as base, not a problem. And let me put this as scenario 1 and let me call this as scenario 2. So what are you doing? Wait, let me just do this and then I will explain. Don't worry about it. Now, I'm giving you the following data. Sales, existing sales in terms of units. The current sales units, let us say, is 2000 units. Okay, let us say the current sales is 2000 units. Okay, in case 1, it is what? 1000 units. In case 2, it is 3000 units. I am just giving an example, 3 scenarios, that is existing scenario, then scenario 1 and scenario 2. Just keep following this particular example. Now, selling price per unit, fine, it is rupees 10 in all the cases because selling price per unit will not change. Similarly, variable cost per unit, let's say it's going to be how much? 5 rupees. Okay, and let us say the fixed operating cost is going to be how much? Let us say it's going to be 5,000. This also does not change with the scenario. Correct? Always remember, variable cost remains constant on a per unit level, fixed cost remains constant in total level. So that's why variable cost is constant on a per unit level, even there is a change in volume, and even if there is a change in volume, fixed operating cost remains constant on a total level. Are you clear with this? These are some basic concepts. Now, let us prepare that first half of the income statement. Sir, what is the first half of the income statement? Sales minus variable cost gives you Sales minus variable cost gives you contribution minus fixed operating cost gives you EBIT, right? So let us prepare that. Now, sales minus variable cost gives you what? Contribution minus fixed operating cost gives you what? It gives you EBIT, or in other words, that's going to be your operating profit. Now, let's calculate this. Let's do this figures for each of the scenario. In scenario 1, what is the sales value? Simple, 2000 units into 10. How much is that going to be? 20,000 rupees, correct? It's going to be 20,000 rupees. Yes. What will be the variable cost? 5 rupees per unit into 2000. How much is that? 10,000 rupees, right? So what's the contribution? The contribution is going to be 10,000, right? What is the fixed operating cost? 5,000 rupees. So 10,000 minus 5,000, you get an overall operating profit, EBIT, of how much? It's going to be 5,000 rupees. Are you clear with this? Yes. Let's go to this situation 1. In situation 1, what they are saying, the total units sold is how much? 1,000 units. So the sales value is 1,000 into 10, that's going to be 10,000, right? Variable cost is 1,000 into 5, that's going to be 5,000. And your contribution is going to be 5,000 rupees. Fixed operating costs, how much is this? That's going to be 5,000. So now, what is this? What is your EBIT? EBIT is going to be 0 in this case. Correct or not? Yes. Now, let us go to the scenario number 2. The sales is 3,000 units. Okay. So, what is the sales value? 3,000 into 10, 30,000. Variable cost, 3,000 into 5, that's going to be 15,000. The contribution gives is how much? 15,000 rupees minus the same 5,000. This gives you how much EBIT? This gives you how much EBIT? EBIT of 10,000 rupees. Now, just look back and observe this particular 3 situation. Now, what happens? Presently, when my sales is 20,000 rupees, how much profit am I earning? EBIT, how much am I earning? 5,000 rupees. Now, you look at this very interesting observation. Look at this. If I increase my sales, to how much? 30,000. Or in other words, if I increase my sales by 10,000 rupees, or this 10,000 divided by 20,000, how much is this? If I increase my sales by 50%, correct or not? Here, from 20,000, the sales has gone to how much? 30,000 rupees. Or in other words, how much is the percentage change? The extra is 10,000. 10,000 upon base 20,000 is going to be how much? 50%, correct or not? Yes. So if I increase my sales by 50%, you just see what is happening to the profit. My profit increases from 5,000 rupees to how much? 10,000 rupees. Or in other words, my profit increases by how much? 5,000. 5,000 upon 5,000 is how much? 100%. Are you clear with this? See what is happening here. If I increase my sales by 50%, my EBIT increases by 100%. Chinna kallu pedda labam. Small efforts, more benefits. Are you clear with this? This magnifying effect is only called as leverage. Guys, are you all clear with this? If I increase my sales by 50%, right, my profit will increase by 100%. But wait, don't think it is always good. Similarly, what happened here? If my sales falls by 50%, what will happen to your profit? From 20,000, it became 10,000. So 20 minus 10 is how much? 10,000 fall. 10,000 divided by 20,000 is 50%. If there is a fall in your sales by 50%, your entire profit from 5,000 becomes 0. Or in other words, what is the change in profit? 5,000 rupees. 5,000 upon 5,000, it's going to be 100. Or in other words, if your sales decreases by 50%, your profit will fall by 100%. So the magnifying effect will be working both in your favor as well as it can work against you. Are you clear with this? So if you increase your sales by just 50%, your profit will increase by 100%. But remember, if your sales even drops by 50%, your profit will fall by 100%. So with lesser effort, you are able to make more profit. But if there is a lesser fall in sale, then the fall in profit will also be huge. So it is called as a double-edged sword. It is positive as well as negative. It has both advantage as well as disadvantage. Why, sir? If you just increase your profit by 50%, if you just increase your sales by 50%, your profit will increase by 100%. But if your profit falls by just 50%, the fall in profit will also be 100%. So the profit falls by 100%. Are you clear with this? Or in other words, can I say there is a magnifying effect in this particular case? What is the magnifying effect? Can I say that operating leverage is nothing but percentage change in EBIT divided by percentage change in sales? Correct or not? In this case, can I say this is nothing but 100% divided by 50%? Are you clear with this? You can say plus 100% divided by plus 50%, or you can say minus 100% divided by minus 50%. Whatever it is, how much you get? 2 times. So can I say my operating leverage is 2 times? Meaning what? If I increase my sales by 50%, my profit will increase twice this. That is, my profit will increase by 100%. But remember, this is always not good for you. It is good as long as sales is working in your favor. But if there is a drop in sales even by 1%, then your drop in profit will be 2 times the drop in your sales. That is, your profit will drop by 2%. That's why here, if you see if the sales drop by 50%, your dip in your EBIT will be twice this 50%. That is, it will be 100%. Are you clear with this? And this is called as, the study of this is called as operating leverage. Are you clear with this? Now, sir, why is this operating leverage happening? That is this magnifying effect. Why is this happening, sir? Sir, if I increase my profit, if I increase my sales by 50%, why is my profit increasing by 100%? Correct. First, I hope you understood this. How we got this 50%? From 20, it is increased to how much? 30,000. So how much is the incremental sales? 10,000. 10,000 is the increase in sales divided by the base sales of 20,000. How much is that? 50%. Similarly, here if you see, from 5,000 it has increased to 10,000. So how much is the incremental profit, extra profit? 5,000. So what is the change? 5,000 divided by the base 5,000, 100%. Are you clear with this? So if I increase my sales by 50%, my profit is EBIT is increasing by 100%. Sir, why is this happening? Why is this magnifying effect happening? This is happening purely because of the presence of fixed cost. Sir, can you prove this, sir? Absolutely. This is purely happening because of fixed cost. Now, let us assume, in the same example, assume the fixed cost is 0. Let us assume the fixed cost is 0. Are you clear with this? Let us assume the fixed cost is 0. Now, what will happen? I'm just quickly doing this. Sales minus variable cost gives you contribution minus fixed cost is equal to EBIT. Correct? EBIT. Fine. Now 3 scenarios we saw. Correct? In the first scenario, it was how much? The sales was 20. The existing scenario, scenario 1, scenario 2. Right? Fine. Now, you tell me, in the first existing scenario, the sales is how much? 20,000. Variable cost is 10,000. Right? Your contribution is 10,000. Right? And the profit and the fixed cost in all the 3 cases, now let us take it as 0. So what will be your EBIT? Your EBIT will be 10,000. Correct or not? I'm just copy pasting the figures here. From here, I'm just copy pasting it. Just that now I'm taking fixed operating cost as 0. Now, in the scenario 1, what happens? My sales is how much? 10,000. Variable cost, 5,000. Contribution becomes 5,000. Fixed cost, let us say fixed cost is 0 here. What's my EBIT? My EBIT is going to be 5,000. Right? In situation 2, my sales is going to be 30,000. Yes. Variable cost is 15,000. Contribution is how much? 15,000. Fixed cost is 0. EBIT is how much? 15,000 rupees. Now you see here, if my sales increases by 50%, if my sales increases by 50%, how 50% we got here? So 30 minus 20, how much is it? 10,000. 10,000 upon 20,000 base is going to be how much? 50%. What happens to my profit? My profit is also increasing by only 50%. How we got this 50%? What is the increase in profit? From 10, it has become 15. So 5,000 divided by 10,000. How much is it? 50%. Suppose if I reduce my sales by 50%, if my sales falls by 50%, look at this. My EBIT also falls by 50%. From 10,000, it became 5,000. So what is the change in profit? It is reduced by 5,000. 5,000 upon 10,000 is 50%. Or in other words, in this case, you calculate your operating leverage and see operating leverage is what? Percentage change in EBIT divided by percentage change in what? Sales. In this case, it is going to be 50 percentage divided by 50 percentage, it is going to be 1. Or in other words, there is no magnifying efforts. Whatever effort I put, that is also being resulted in my actions, in my results. Are you clear? So my effort, whatever I put, it is getting in my action. So why this is happening? Then in the first scenario, why did we have this leverage or this particular magnifying effect? Purely because of the presence of what? Purely because of the presence of fixed cost. Are you clear with this? Are you clear with this? And that's why I said at the time we started, fixed cost is the hero of this particular chapter. So because you have fixed cost in between, what happens? Your EBIT is not moving in proportion to your sales, so it moves in a different proportion. That is, in this case, what happens? The sale value is increasing, so the contribution is also increasing, but you just need to, the fixed cost is not changing, it remains the same. So what happens? The profit that you make will entirely be the increase in the contribution, correct? See here, if you see, from 10,000 my contribution increases to 15,000, correct? From here, if you see, this 5,000 profit will increase to 10,000, or in other words, this fixed cost does not change, it is the same fixed cost. So obviously here, since it is not moving in proportion, so beyond this point, what happens? There is a magnifying effect. And we learn this by way of what? By way of this particular example also. If you keep your fixed cost as 0, what will happen? There will not be any magnifying effect. Don't say your leverage will be 0. The leverage will be 1. That is the percentage change in EBIT divided by percentage change in sales will be what? 1 in this case. Are you clear with this? So to put it short, what do you mean by leverage? Leverage means common word leverage. Leverage means what? Leverage refers to putting lesser efforts, getting more results. Are you clear with this? Now, in case of operating leverage, it is a study of relationship between your sales and EBIT. So by how many times my EBIT will increase as compared to my increase in sale, or in other words, percentage change in EBIT divided by percentage change in sales, if I do, that is only called as operating leverage. Now, what is that to mug in this? Guys, are you clear with this? Are you clear with this? Yes. Now there is one more formula for operating leverage. First, let's just do this. So operating leverage is also known as degree of operating leverage. Both are one and the same. Don't think degree of, if they add these words, it is something else. It is exactly the same as operating leverage. Short form is DOL. So what is the formula? Percentage change in EBIT upon percentage change in sales. Alternatively, there is one more direct shortcut formula. Operating leverage is contribution divided by EBIT. Sir, what is the logic for this? This is a mathematically proven theorem. That is, if you want, I can definitely prove it. In my regular lectures, I just take little extra time and prove this formula also. But since we are in a marathon, I don't want to get into the technicalities of it. It's not, I wouldn't say it's not logical and all. But what I would suggest is, it has to be mathematically derived. The derivation will go for 1.5 pages. We will start from this percentage change in EBIT upon percentage change in sales. Very logical derivation. We will derive, and finally you will get this as contribution divided by EBIT. Now, what I would suggest is directly learn this formula. Because in exam you can't put this derivation and do it. See, in FM what happens? Unlike costing. See, costing, everything can be told logically then and there. Whereas in FM, things can be told logically, but there are certain things that has a mathematical derivation, and mathematical derivation can be known only if you solve it. So this I can solve and show it to you. It will take about 10 to 15 minutes. Of course, the derivation and all is not there for exam. But if we take that extra 10 to 15 minutes, at the end of that, you will know, okay, fine. Hence proved contribution by EBIT. But now once again, you will just think, sir, but contribution by operating leverage is contribution by EBIT. Just like that, why is the logic? I can only prove it to you mathematically. But because this is not something like automatically, logically, you can just say mathematically only it can be proven. It is like asking why is pi is equal to 3.14, right? If you want, we can prove. It runs into pages. Of course, we cannot do. Yes, some legends have done it already, but something similar to that on a lower scale. This can be proved, and I'm deliberately not doing it in a marathon because see, in our regular lectures, generally, I derive this because it takes some extra time. It's not there for exam. Just know that operating leverage is equal to contribution by EBIT. Sir, is there a way to remember this? Absolutely. I'll tell you the way to remember this. I will tell you a way to remember this, logical way to remember that I will tell you. Now, look at this. Imagine a sandwich, okay, not a sandwich, a burger. Okay. So if you see, how does a burger look like? So something will be on the top. You will have a base here. And in between, you will have what you call this patty with all the vegetables and all that, right? So yes, I am a vegetarian, so I'm taking a veg burger here. Now look at this. Look at this. Now, guys. Fun aside. Now look at this. Why does leverage happen? I told you, because of the presence of fixed cost. Operating leverage happens because of the presence of fixed operating cost. So imagine this burger. Imagine this burger. Your operating leverage is nothing but the top bun divided by lower bun. That is what your contribution divided by EBIT. So why this leverage happens? Because of the presence of fixed cost. Are you clear with this? You remember it like this. I'm not asking you to mug it up. This can be mathematically proven. But in exam, you can't do this derivation every time. So what you can do, just remember, this is nothing but why is my leverage happening? Operating leverage is happening because of my fixed operating cost. So till my contribution, the sales move proportionately, and after that there is a disproportion, and that is the reason why the operating leverage is happening. Simple, contribution divided by EBIT. Are you clear with this? This is the formula that you need to remember. Are you clear with this, guys? Imagine the sandwich or whatever you call this burger. Are you clear with this? With this you can understand this, and this is a very mathematically provable formula. Actually, if you have the time, maybe you can just try it by yourself, or in the regular lectures if you have watched, well and good, right? But it is not required for exam. Don't worry about it. Now, no one is going to ask you to derive the formula for operating leverage and all. No, nothing of that sort. Now, one more thing that you need to understand. What did I say the formula for operating leverage was? The formula for operating leverage, the other formula is going to be what? Contribution divided by EBIT. Now, this contribution and EBIT should be picked only from the base data. It should be picked only from the base data. Are you clear with this? So it is going to be base data's contribution, 10,000 divided by base data's EBIT. So it's going to be how much? 10,000 divided by 5,000. Are you clear with this? It's going to be how much? It's going to be 2 times. Are you clear with this? So you can't take the contribution divided by EBIT of any of the data. If you look at this here, 5,000 divided by 0, what will come? Nothing will come. Here, 15,000 divided by 15,000 divided by 10,000, you will get 1.5 something. No. Only on the base data from where you are seeing the change, on that base data. The base data's EBIT. So the base data's contribution. These two should only be used. So base data's contribution divided by base data's EBIT is your other formula for operating leverage. Are you clear with this, guys? Are you all clear with this? And as simple as that. So what do you mean by an operating leverage? Yes, operating leverage talks about the relationship between the change in your EBIT and the change in your sales. Are you clear with this? So what is the formula for operating leverage? Two formulas. One is a logical formula. What is it? Percentage change in EBIT divided by percentage change in sales. The second formula is a mathematically derived formula. What is this? Sandwich or the burger. Contribution divided by EBIT, and you are done with this area. Are you clear with this? Yes. And what we are seeing, it is nothing but operating leverage shows the magnifying effect. The magnifying effect that is because of the business risk. Sir, why is it called as business risk? Because here we are considering only the fixed operating cost. Are you clear with this? So generally speaking, fixed cost denotes risk. Sir, why is it risky, sir? If you have more fixed costs, it is the meaning of that is you tend to be more risky. Why is it, sir? Because irrespective of whether you make a profit or a loss, a fixed cost needs to be paid. Correct or not? So more the fixed cost generally means more the risk. So then is it bad, sir? No. More the risk also means more the return. Risk means what? Uncertainty. It can be in your favor. It can also be against your favor. So don't think risk is bad. Risk is not negative. It can be positive or it can be negative. It's a double-edged sword. Are you clear with this? So this fixed operating cost, because of that only operating leverage is coming, and that is why we are saying that the operating leverage is actually considering what? Business risk. Are you clear with this? Yes. So that is what we've seen here in this first particular data. Now, one more thing that I want to share with you in this particular area of operating leverage. Yes, other relevant formulas relating to operating leverage. Okay, so let me just come back to this after we finish financial leverage. I think that would make more sense. So let us go to financial leverage, and then we'll come back to operating leverage. We'll come to the other parts of this particular operating leverage. So all these things are very logical. In fact, These are certain things that are linked to our marginal costing chapter in our cost and management accounting. In costing paper, certain things are related to your cost and management accounting in that marginal costing. But anyways, we will see whatever this is. We will see all these things. Don't worry about it. I'm not omitting it. So let's go to the financial leverage, right? Now, what do you mean by financial leverage? What do you mean by financial leverage? Now, financial leverage studies the relationship between EBIT and EPS. Now, look at this. Look at this. Operating leverage. I'm just erasing all these things off. So, operating leverage. What was the study in operating leverage? One second. I'm just erasing this. Yes. What was the study in operating leverage? In operating leverage, we were trying to find out the relationship between this figure, the sales figure, and what? The EBIT figure, correct? And that's why here I have put it as what? Degree of operating leverage. In fact, this entire chart is picked from the ICI study material only. They have given it. So operating leverage is about what? The study of relationship between your EBIT and your sales. Are you clear? It shows the magnifying effect between the sales and EBIT. What do you mean by financial leverage? It talks about the magnifying effect that happens between EBIT and EPS. Are you clear with this? EBIT and EPS, and this entire component. Again, why it happens? Financial leverage. Financial leverage also happens because of the presence of fixed cost, but wait, not fixed operating cost. It happens because of the presence of fixed financial cost. That is the two line items. Are you clear with this? I will prove it. Don't worry. Again, we will see an example. Are you clear with this? First, what does operating leverage talk about? Relationship between sales and EBIT. What does financial leverage talk about? The relationship between EBIT and EPS. Are you clear with this? Sir, can you give us an example? Absolutely. We will take an example here. One second. Yeah, we'll take an example here. Now, financial leverage, what does it talk about? Relationship between EBIT and EPS, right? Please learn all these things conceptually. Don't mug it up. If you mug up, then automatically it's going to be very difficult. If you learn the subject like this, definitely it will be very, very interesting. I wouldn't say you'll start liking the subject, but definitely I can tell you one thing, it will at least be interesting. It will not be boring. Clear? So now, let me just take an example. It's an illustration. Now, I'm taking an existing data, that is the base data. Fine. Similarly, situation 1, scenario 1, scenario 2. Right? Fine. Now tell me that profit statement we saw starting from EBIT. So sales minus variable cost gives you contribution minus fixed operating cost gives you EBIT. Let us start from EBIT. Why are we starting from EBIT? Because this particular financing leverage, it talks about the relationship between EBIT and your EPS, correct? So basically we are concerned about the second half of the profit statement. Are you clear with this? Yes. So now look at this. EBIT, yes, tell me the format. Minus interest gives you what? EBT, earnings before tax, minus tax. Let us assume the tax rate is 30%. Okay, fine. Let's assume. So EBT minus tax is going to give you what? EAT. Yes, earnings after tax. Then minus preference dividend. Gives you what? Earnings available for equity shareholders. Let me put it as EFE, earnings for equity shareholders. Correct? Divided by number of equity shares. It gives you what? EPS. Are you clear with this? Yes. Now, first, let us fill this up, and with this we will understand. It's the same concept, but here it is happening on the other side, in the second half of the income statement. Now, let us assume the EBIT is how much? Let us say the EBIT is 1 lakh rupees. Just an example. The EBIT is how much? The EBIT is going to be 1 lakh rupees, right? Now, minus interest. Let us say the interest is going to be 20,000. Will this change? No, it's a fixed financial cost. So whether it is situation 1 or situation 2 or the existing situation, this will not change. Correct or not? Yes. So what is the current earnings before tax? 1 lakh minus 20,000. This gives you how much? 80,000. right? Minus tax at the rate of 30%. So on 80%, 80,000, calculate 30%. That's going to give you how much? 24,000, right? Yes. So 80,000 into 0.3, it's going to give you 24,000. So now 80,000 minus 24,000 gives you how much? It's going to give you 56,000. Minus preference dividend. Let us assume preference dividend is 16,000 rupees. Now this is also one more component of what? Fixed financial cost, correct? So whether it is situation 1 or situation 2 or the existing situation, this preference dividend will not change, yes or no, right? So now what is my earnings available to equity shareholders in the existing scenario? 56,000 minus 16,000 is going to be how much? 40,000, right? And let us say the total number of equity shares available in the company is 10,000 number of equity shares. And the number of equity shares is also not going to change in these situations. Are you clear with this? So now you need to divide this. 40,000 divided by 10,000. How much is going to be? The earnings per share is going to be how much? 4.00. That is, every share earns a revenue, or every share earns rupees 4 of profit. That is the earnings for equity, earnings available to equity shareholders divided by number of equity share. This gives you 4 rupees. Now, let us say your profit, your EBIT is fallen by 10%. So from 1 lakh, it has become how much? Let's say 90,000 rupees. Or in other words, your EBIT has fallen by how much? 10%. Are you clear with this? So what will be your EBT? 90,000 minus 70,000. This gives 90,000 minus 20,000. This gives you 70,000. Correct? Now, on this EBT, tax of 30% gives you how much? It gives you 21,000 rupees. Yes or no? So EBT minus tax gives you how much? So EAT, how much is that? That is going to be 49,000. Yes, 49,000. So is this entire amount available to the equity shareholders? No. Out of this, the preference dividend of 16,000 needs to be paid. So 49 minus 16, the balance amount is how much? It's going to be 33,000. So 33,000 divided by 10,000 per share. Now the EPS becomes 3.30. Now let's go to the other side. Let us assume that my EBIT is increasing by 10%. Other things remaining constant. What is changing? Only my EBIT. By how much? 10%, which means what? From 1 lakh, it is increased by 10%. That is, it has increased to 1 lakh and 10,000. So now what's going to be my EBIT? 1 second. Let me just put it properly. So now 1 lakh and 10,000. So now what's going to be my EBIT? So EBT is going to be how much? So 1 lakh 10 minus 20, that's going to be 90,000, right? Minus tax, how much is it? 30% on this. It's going to be how much? 27,000, correct? Yes. Yes. So now what is going to be your earnings after tax? That's going to be 63,000. Yes. Now is this entire amount available to the equity shareholders? No. Out of this, the preference dividend needs to be paid. So 63 minus 16, this gives you how much? 47,000 is your earnings available to equity shareholders. So what is the earnings available per share? Earnings per share. 47,000 divided by 10,000, it's going to be 4.70. Are you clear with this? Now, if you tell me, if my sales increases by 10%, correct? Please remember, leverages always has to be calculated in terms of percentage. Don't say if the sales increases by 10,000 rupees. No. It should always be calculated in proportions in terms of percentage. If my sales increases by 10%, what happens to my EPS? My EPS is increasing, correct? By how much? By how much is it increasing? The increase in EPS is how much? 0.7, correct or not? The increase in EPS is how much? 0.7. Yes, 0.7 divided by 4. How much is this? 0.7 divided by 4 into 100. So can I say my EPS increases by 17.5%? Yes or no? So how did you get 17.5? What is the increase in EPS? 0.7. 0.7 divided by the base 4 is going to give you how much? 17.5%. So can I say if I increase my EBIT by just 10%, your EPS increases by a whopping 17.5%. But wait, if your profit decreases by just 10%, your EPS will decrease by how much? 17.5%. We will see that. Look at this. So now in this case, what happens? So my profit reduces, EPS reduces from 4, it becomes how much? 3.3. So how much the reduction? Minus 0.7. So we just saw 0.7 divided by 4 is going to be how much? So it's going to be 17.5. So minus 0.7 divided by 4 is going to be minus 17.5%. Or in other words, can I say if my EBIT increases or decreases, if my EBIT changes by 10%, my EPS changes by 17.5 percentage. There is a magnifying effect here on the financial side, and hence it is called as financial leverage. What's the formula for financial leverage? Percentage change in EPS divided by percentage change in what? Percentage change in your EBIT. Are you clear with this? So percentage change in EPS is how much? It could be plus or minus 17.5 percentage divided by plus or minus. You can take yes, 10 percentage, right? So it's going to be how much? It's going to be 1.75 times. I can say 1.75 times is going to be what? It is going to be my financial leverage, or in other words, the magnifying effect is what? If my EBIT increases by 1%, my EPS will increase by 1.75 times that 1%, or in other words, 1.75%. Here what happened? My profit EBIT increased by 10%. So now EPS is increasing by how much? 1.75 times the 10%. That is 17.5%. Are you clear with this? Similarly will happen if the EBIT reduces. If the EBIT reduces by just 10%, now EPS will reduce by 17.5%. It's a double-edged sword. Are you clear with this? Are you clear with this? Now, sir, why is this effect of? Why is this financial leverage? Why is this happening? This financial leverage, why is this happening? Now, very simple. Let me just take the same figures here. 1 second. I think I can just copy paste it. One second. Perfect. Right. I think I should have done this before also for the previous example. Okay. So let me just erase a few things. Why is this happening? Why is this happening? This is happening purely because of the fixed financial cost. Sir, in this case, fixed financial cost means what? Interest and preference dividend. Let us assume the company does not have any interest or preference dividend, or in other words, the entire source of finance for them is only through the equity share capital. Now, what will happen here? I'm just erasing all of this. There will be a change. So I'm just erasing this. So 1 second. So yes, this is also smart work, leverage only, copy paste work. Now look at this. Now let's assume there is no interest in all the three situations. What will happen to my EBIT? So what EBIT is, I told you, it's 1 lakh, 1,10,000, 90,000, three scenarios. Let us assume no fixed financial cost. Fixed financial cost means what? Interest and preference dividend. So what happens in the existing case? My EBIT will be 1 lakh, and in this case it will be 90,000. In this case it's going to be 1,10,000. Correct? Yes, minus tax at the rate of 30%. So now tell me, what is your tax going to be here? The tax is going to be how much? The tax is going to be 30,000. Yes, the tax is going to be 30,000. Here the tax is going to be 30% on 90,000. It's going to be 27,000. And here it's going to be how much? 33,000. Correct or not? Yes. So now what is going to be your EAT? Here it's going to be 70,000. Here it's going to be 63,000. Yes. And then here it's going to be how much? 77,000. And now let us say there is no preference dividend also. Fine. Now what happens to my earnings for equity? It becomes 70,000 here. Yes. Here it becomes 63,000. Here it becomes how much? 77,000. Yes or no? Fine. And now what happens to my EPS, guys? So what happens to my EPS? Now let's do this. Let's do this. So what happens to my EPS? So now EPS here in this case, it becomes how much? It becomes so let's see, it becomes how much? 70,000 divided by 10,000, it's going to be how much? 7, right? Yes, in this case, it becomes how much? 7.70. So here it's 7.00. It's 7.70. That is 77,000 divided by 10,000. Here it becomes 63,000 divided by 10,000. It becomes 6.30. Now you tell me. Now, if I increase my sales by how much? 10%. Correct? 10,000 upon 1 lakh is going to be 10%. Now, what happens to my EPS? What happens to my EPS? What happens to my EPS? My EPS is going to be how much? My EPS is increasing by how much? From 7, it became 7.7. Now, what is the change? Change is going to be 0.7 divided by the base 7. into 100. So how much is this going to be? 0.7 divided by 7 is going to be what? 0.7 divided by 7 is going to be 10%. Are you clear with this? Are you clear with this? So here what happens? If I increase my EBIT by 10%, my EPS is also exactly changing by 10%. If I decrease my EBIT by 10%, from 1 lakh it became 90,000. That is, it fell by 10%. What happens here? It's going to be how much? From 7, this falls by how much? Falls to 6.3. That is, it falls by minus 0.70. Correct? 7 minus 0.7 is only going to be 6.3. Minus 0.7 divided by 7 into 100. It means what? My EPS falls by how much? 10%. Or in other words, there is no magnifying effect. Correct? If my EBIT increases or decreases by 10%, my EPS is also moving, that is increasing or decreasing by exactly 10%. Or in other words, can I say in this case, the financial leverage is equal to percentage change in EPS divided by percentage change in EBIT. Here it's going to be EBIT. Here it's going to be plus or minus 10% upon plus or minus 10%. That gives you a leverage of 1, no magnifying effect, and hence it is proved. What is proved is that this magnifying effect is happening only because of the presence of these two guys. That is the interest and the preference dividend. Are you clear with this? These two are nothing but fixed financial cost. Are you clear with this? That's why I said tax is not a fixed financial cost. Because look, proportion to your EBIT, your tax will also change. Correct or not? So everything moves in proportion. What makes this entire statement disproportionate is only these two guys. That is these two components of fixed financial cost, interest and preference dividend. So only because of the fixed and only because of the interest and preference dividend, in this case, you are having what? You are having a magnifying effect on the financial component of your income statement, and hence the name financial leverage. Are you clear with this? And why is this happening? Because of the presence of fixed financial cost, or in other words, fixed financial cost is nothing but interest and preference dividend. And this is also being proved. So what is the formula for financial leverage? The financial leverage formula is percentage change in EPS divided by percentage change in EBIT. Now there is one more formula for this, direct formula. Again, it's a mathematically derived formula, and I'm not getting into the derivation right now, but it can definitely be proven. I can prove it, but yes, it's not required for the exam, so I'm not doing it in a marathon, right? So now, what is the other formula for financial leverage? Now, financial leverage, the same concept of the sandwich or burger example only. Financial leverage can be called as EBIT divided by EBIT minus interest minus preference dividend upon 1 minus T. Right? Now, sir, why all these formulas? Why is it coming like this? As I told you, it has to be mathematically proven. Mathematically, definitely we can prove it. That shouldn't be a problem. But in exam, you should know, like you should have something in your mind to remember why we have this formula. And it is not like memory technique and all, but you should have some logic that is attached to this formula, a directly applicable logic. Yes, derivation is one part, but you can't remember the entire derivation, or you can't do the derivation in exam. So logically, sir, can you tell me a quick way to remember this formula? Yes, I will tell you. Simple, guys. What was the operating leverage formula? Operating leverage was what? The operating leverage was contribution divided by EBIT. So EBIT means what? Contribution minus fixed cost, fixed operating cost. Correct or not? That is contribution, correct, divided by contribution minus fixed cost. That is, from the contribution you remove whatever is the fixed operating cost that is inside it, so that you will get your what? You will get your EBIT. That's what we did there. Operating leverage. I'm not talking about financial leverage. I'm talking about operating leverage. Correct? Contribution divided by EBIT. So what is EBIT? EBIT is nothing but contribution minus fixed cost. Correct or not? So can we say it is nothing but contribution divided by contribution minus fixed operating costs? Correct? Similarly, here it is going to be what? It is going to be EBIT divided by EBIT minus the two fixed financial costs. Are you clear with this? That is EBIT divided by EBIT minus interest minus preference dividend by 1 minus T. Are you clear with this? That is EBIT divided by EBIT minus the two fixed financial costs. Only because of the two fixed financial costs you are having this leverage, financial leverage. Correct or not? Yes. Now I can hear your doubt. One more thing. Sir, why for preference dividend alone you have put 1 minus T? Mathematically, it is coming like that. But I can give you one more logic for it. Now, you tell me here what we are doing. EB, the denominator alone, you just see EBIT minus interest minus preference dividend upon 1 minus T. This is what we are getting. Yes. Now, you tell me EBIT, this component, this figure comes before tax or after tax? Tell me, guys, it comes before tax or after tax? It comes before tax. Tax is only here, before tax, correct? Yes. Interest is a component that comes before tax or after tax? It comes before tax. Whereas preference dividend is a component that comes after tax, correct or not? Yes. So now I am saying that EBIT, interest are all pre-tax items, correct? They are readily comparable. Whereas preference dividend is a post-tax item, correct? So what you need to do is you should convert that post-tax item into a pre-tax item. Are you clear with this? How will you do it? If there is a pre-tax item, to convert it into post-tax, what you will do? That item into 1 minus T. But if you have a post-tax item, if you want to convert it into pre-tax, what do? Divide it by 1 minus T, correct or not? So since this is a post-tax item, I'm converting it into pre-tax item to make this readily subtractable with the other two components. Are you clear with this? Logically, you just understand this, but this is mathematically proven. Beyond this, nothing can be told, but this is mathematically provable. You'll run into 2-3 pages and you can prove this. Hence proved, you will get it. But I'm telling you, easy way to remember for the exam, no memory techniques and all. Remember, EBIT divided by EBIT minus the two fixed financial costs because of which the financial leverage is happening. But in this EBIT, minus interest can be done, but minus preference dividend directly I cannot do. Why? Because fixed preference dividend is happening after tax. It is a post-tax item, correct? So divided by 1 minus T. Please don't confuse this with tax shield and all. This has nothing to do with tax shield. Preference dividend doesn't have a tax shield. This has nothing to do with tax shield. So please don't confuse this with the KD, that calculation with this. Are you clear with this? This is a mathematically proven formula, but I'm just giving you an easy way to remember. As simple as that. Are you clear with this? So what is the formula here? EBIT divided by EBIT minus interest minus preference dividend upon 1 minus T. Why for preference dividend alone you are doing divided by 1 minus T? Because it's a post-tax item. I'm converting it into a pre-tax item. Only then it can be subtracted from the other two pre-tax components. Are you clear with this? Just remember it like this. No way you can forget it in exam. Are you clear with this? Logic, guys. Every single thing is logic, and this is mathematically provable also. Now, one more thing. Suppose preference dividend is not there. So the company has not raised any money through the preference channel. Can I say this is nothing but EBIT? So financial leverage, can I say this is nothing but EBIT divided by EBIT minus interest, correct? Or can I say this is nothing but EBIT divided by EBT, correct or not? If there is no preference dividend, then financial leverage is nothing but EBIT divided by EBT, correct? That sandwich comes in. Are you clear with this, guys? Are you clear with this? Yes. Now, what happens? I will tell you the irony here. What happens? Now, look at this. Look at the formulas here. Yes. So, fixed your financial leverage, percentage change in EPS upon percentage change in EBIT. You got this? Yes. Then, financial leverage formula. EBIT, see, EBIT minus interest minus preference dividend by 1 minus T. This is the right formula, correct? And if there is no preference dividend, I can say that financial leverage is EBIT upon EBT. Are you clear with this? Are you clear with this? But now there is one small issue that I want to address. Now what happened in institute study material, in some sums, even when there is a preference dividend, they have used this formula. Or in other words, for the purpose of computing the financial leverage, they have conveniently ignored the preference dividend. Sir, is it correct? No, technically not. But globally, some people still take this formula. They ignore preference dividend completely. Some people take this formula. Sir, don't tell me all these things. For exam, what I should do? In exam, certain questions have been solved like this. Certain questions have been solved like this. So whatever you solve, please write a note, because this is an area of controversy, right? You write a note saying that, see, if there is a preference, see, when there is no preference dividend, obviously this formula only you will take. When there is a preference dividend and still you want to use this formula, that is, if you want to ignore preference dividend, maybe you write a note saying, yes, this has been done like this. But I would prefer you use this formula, not a problem at all. We will be doing it somewhere in the study material. They have, even when there is a preference dividend, they have ignored this formula and they have written it as EBIT upon EBT. So let's not question it back. This is how the situation is right now, so accept it. Are you clear with this? Fine. Are you clear with this? So now guys, tell me, what is the formula for financial leverage? Percentage change in EPS divided by percentage change in EBIT, or the other formula is what? EBIT divided by EBIT minus the two fixed financial costs, that is EBIT minus interest minus preference dividend upon 1 minus T. Why preference dividend alone upon 1 minus T? Because it's a post-tax item. I am converting into pre-tax to be readily subtractable from my EBIT. Are you clear with this? Now, in some cases, what they do, they ignore the preference dividend and they write it as EBIT upon EBT. Are you clear with this? This is the entire story about your financial leverage. Are you clear with this? Yes. Now, what do you mean by a combined leverage? Don't worry, I'll come to that operating leverage, margin of safety and all. Don't worry about that. I'll come. What do you mean by combined leverage? It is a combination of your operating leverage and your financial leverage. Or in other words, it shows combined leverage talks about the relationship between the topmost item and the bottommost item. Are you clear with this? That is, it shows the relationship between the sales and your EPS. Are you clear with this? So, operating leverage talks about the first half of the income statement. Financial leverage talks about the second half of the income statement. Combined leverage talks about the entire income statement. Are you clear with this? Or very simple. Combined leverage is nothing but operating leverage into financing leverage. Are you clear with this? Operating leverage into financial leverage. Are you clear with this? Or you can use this formula. So operating leverage, what is the formula? Contribution upon EBIT. Correct? Financial leverage, what is the formula? EBIT upon EBT. Yes, that's an alternate formula. EBIT divided by EBIT minus interest minus preference dividend upon 1 minus T. Yes, that also you can use. In this case, we have just considered this, right? I'm just giving it as given in the study material. Correct. In the study material, this is also given. Please note, don't think I'm doing something out of my own. In some sums, they have done this. In some sums, they have done this. Are you clear with this? So what you need to do is, so combined leverage is what? Nothing but operating leverage into what? Into your financing leverage. Operating leverage is contribution upon EBIT. Yes. Your financing leverage is EBIT upon EBT, or alternatively EBIT upon EBIT minus interest minus preference dividend by 1 minus T. Correct. Now EBIT anyways gets knocked off. Correct. So your combined leverage formula is what? Contribution divided by EBT. Are you clear with this? Or alternatively, the right precise, technically the right formula is contribution divided by EBIT minus interest minus preference dividend upon 1 minus T. Technically, this is how it should be. Correct? If you're ignoring preference dividend, use this formula. If you're not ignoring, if you're considering preference dividend, use this formula. As simple as that. Let me just make this very simple to you. Are you clear with this? Sir, when to use what in study material? They have used this, that. Yes, I know. That is why I am telling you very clearly, when preference dividend is that, ideally it should be considered, but in some questions, institute has not considered it. Are you clear with this? Why and all? I don't know why they have not considered, but generally they have done certain sums by considering it. Certain sums, even when preference dividend is not there, they have not considered it. So I don't know why. So what you need to do is just write a note and leave it there. Always remember, when you have some controversy, you write a note that is backing your assumption. For the given note, your answer is correct, so no one can touch your marks. Clear with this? Do that smart way. Always strategize and do it. Whichever subject you are doing, if there is a controversy, then you do it. Now you can't. You see, only when there's a controversy or when there's an ambiguity, you can use note. That will come to your rescue. Just like that, see, in this case, preference dividend is not at all there. Still, I want to use this formula that is not at all a question. So not everywhere you can write this note and you can escape. No, I'm not saying like that. When there is a controversy, yes, confusion, it can be avoided by way of writing a note. And for the note that you have written, your answer is correct. That's about it. Are you clear with this? Yes. So now that's about your combined leverage. Or in other words, combined leverage talks about the change in your EPS when there is a change in my topmost figure, sales. So percentage change in EPS divided by percentage change in sales. Or there's nothing but your operating leverage into into financial leverage. Operating leverage was EBIT, percentage change in EBIT divided by percentage change in sales. Correct. What is your financial leverage? Percentage change in EPS upon percentage change in EBIT. These two gets knocked off and you get finally percentage change in EPS divided by percentage change in sales. Are you clear with this? Or in other words, it talks about the relationship between my EPS, bottommost item, with my sales, my topmost item, and this is called as combined leverage. Are you clear with this? Now Your operating leverage is happening because of the presence of fixed operating cost. That is for the purpose of your operations. That's why operating leverage is actually an indicator of your business risk. Are you clear with this? Financial leverage, why is it happening? Because of the presence of fixed financial cost, and that's why this represents your financial risk. Are you clear? I told you fixed cost generally represents risk. Are you clear with this? And combined leverage is a combination of both business and finance risk. That's why it is called as the overall risk. Are you clear with this? Guys, learn it like this so that you will not forget this for a lifetime. Are you clear with this? And as simple as that. Sir, why are you calling this as risk? Magnifying effect is there. No, sir. Look, magnifying effect. Let's say your operating leverage is 2 times. If your profit increases by 10%, your EBIT, if your sales increases by 10%, EBIT will increase by 20%, no doubt. But if your sales decreases by just 10%, the decrease in profit will be 20%. So it can work for you, it can also work against you. This is like a seesaw, correct? If you put your, if you are favorable, you can put the other person up. But if that person is going to be favorable, now you will also go up. Are you clear with this? So basically, you can put the other person up or you can put the other person down. Automatically, it works both the ways. Are you clear with this? So this is a magnifying impact that we are talking about in this particular chapter. So the relationship between sales and EBIT, operating leverage, EBIT and EPS, that's going to be your financial leverage, and sales and your EPS is going to be your operating leverage. All the formulas we have just studied logically, conceptually, and that's about it. Are you clear with this? Now, one more thing that we need to do, this is something to do with the costing area. Yeah, so let me just quickly finish this off. So what is this? 1 second. So what do we have here? Yes, there are some relevant formulas relating to operating leverage. So let's just study this relevant formulas relating to operating leverage. Now, break-even point in units is equal to fixed cost by contribution per unit. This is actually a costing area, marginal costing, fixed cost divided by contribution per unit. Margin of safety, sales minus break-even sales divided by total sales into 100, and degree of operating leverage is 1 divided by margin of safety as a percentage. So what is all these things? Fine. I'll just give you a small background with a numerical example and we'll be done with this. I'm not getting into the technicalities because this is not costing, this is FM, right? So to the extent relevant, I will definitely explain, and I will also prove that operating leverage is 1 divided by margin of safety as a percentage. See, some students, what they say is operating leverage is equal to 1 divided by margin of safety. Please don't make that mistake. You always tell yourself operating leverage is equal to 1 divided by margin of safety as a percentage. Immediately put that, because this margin of safety has to be expressed as a percentage. It can also be expressed in amount, but if you do that in amount, you will not get operating leverage. Are you clear with this? So operating leverage is 1 by margin of safety expressed as a percentage. Always say this along so that you will never forget it. Now, what is all these things? What is a margin of safety? First of all, let me just give you an example. Let us just say this requires some basic level of costing knowledge, some very basic level of costing knowledge. Let's say this is the given data. Sales is equal to 1 lakh rupees. Just an example, guys. Yes. Now let's say the variable cost, let us say is 25%, that is 25,000 rupees. The variable cost is 25,000 rupees. So what is going to be your contribution? The contribution is going to be 75,000 rupees. Are you clear with this? So can I say the variable cost ratio, the VC ratio, can I say is nothing but 25%? That is variable cost expressed as a percentage of sales is called as VC ratio. Similarly, contribution expressed as a percentage of sales is called as PV ratio. It's called as profit volume ratio. 75,000 upon 100, 75,000 upon 1 lakh is going to be how much? 75%, right? Minus fixed cost, basically fixed operating cost. Let us say the fixed operating cost is how much? Let's say it's 60,000 rupees, right? Now, what will be your EBIT? Your EBIT is going to be how much? Your EBIT is going to be 15,000. 15,000. Are you clear with this? Yes. Now, sir, in this case, what is the operating leverage? Can you calculate? Operating leverage is equal to what? Now, here only one data is given, correct? If more than one data is given, with that percentage you can calculate. Since only one data is given, use that sandwich or that burger formula, contribution divided by EBIT, correct? So it's going to be contribution upon EBIT. Yes or no? So contribution is going to be how much? 75,000. EBIT is going to be how much? 15,000. So 75,000 upon 15,000. can I say my operating leverage is 5 times? Or in other words, when my sales increase by 1%, my EBIT increases by 5%. The magnifying effect is 5 times. Are you clear with this? Yes. Now, fine. This is about it. This is what we've already seen. Now let us go back to a little bit of costing. First, calculate the break-even point. Sir, what do you mean by break-even point? The point of sale that makes my EBIT 0 is called as the break-even point. Correct? Yes. So what do you mean by the break-even point in this case? Sales minus variable cost gives you contribution minus fixed cost gives you your EBIT. Correct? Now let's reverse work. Now, EBIT. So I should calculate the break-even point. Break-even point means what? The point of sale where I'm earning exactly a zero profit, zero loss, no profit, no loss scenario. So first I will start from here. So for me to earn zero EBIT, now fixed cost, will it change? No, fixed cost remains to be 60,000. It means that I should be earning a contribution of exactly 60,000, correct? Or in other words, my contribution should be able to recover exactly my fixed cost, correct or not? Only then I will be making a zero EBIT, correct? And now we know that contribution is what? 75% of the sales. Yes or no? That is the PV ratio, correct? Yes, if 75% has to be 60,000, how much should be 100%? 60,000 divided by 75 into 100. So can I say, so your sales should be 80,000, correct or not? Or in other words, if this is 80,000, 25% of this will go off. That is 20,000 will go towards your variable cost. So you will make a contribution of how much? You will make a contribution of 60,000, and exactly your fixed cost will be recovered, and you will end up in a no profit, no loss scenario. Are you clear with this, guys? Are you clear with this? Or in other words, break-even point I can find out directly. How can I find out? It is nothing but fixed cost divided by PV ratio, right? This is actually subject matter of discussion in your costing. But anyways, if you want the break-even point to be expressed in value, the sales at which I earn a zero profit, zero loss is called as the break-even point. Are you clear with this? Yes, are you all clear with this? Suppose you want the break-even point in units, it's called as fixed cost divided by contribution per unit. So this is how it happens. Now, you tell me, what is the total sales that the company has made actually? 1 lakh rupees, correct? The company has made a total sales of worth how much? 1 lakh rupees, correct? Now, the break-even point happens at how much? 80,000 rupees, correct or not? Yes, which means if you make sales up to exactly at 80,000 rupees, no profit, no loss for you. Are you clear with this? So if you make sales beyond this 80,000 rupees, then you will start earning profit. And that is the reason why for a 1 lakh rupees sale, it is reporting a profit, EBIT. Are you clear with this? Or in other words, how much rupees of sales has been made in excess of the break-even point? Can we say beyond the break-even point, the company has made 20,000 rupees worth of sale, correct? And this is called as margin of safety. In costing, we call this as margin of safety. Technically, this is not even an FM area. This is called as margin of safety. It's in costing, marginal costing. Now, margin of safety is what? The sales made beyond the excess, beyond the break-even sales, correct? Now, this margin of safety is how much? 20,000 rupees. Now, this can also be expressed as a percentage of the total sales. So, if I'm asking, so I want to know margin of safety as a percentage of total sales. Can I say margin of safety as a percentage of total sales is nothing but 20,000 divided by 1 lakh. How much is that? 20,000 divided by 1 lakh. How much is that? Can I say 20,000 divided by 1 lakh? It's going to be how much? 0.2, right? Can I say this is nothing but 0.2? Yes or no? Yes or no? So, can I say 20% or my margin of safety is 0.2? 0.2% of my or 20% of my overall sales. Are you clear with this? So you now got to know how to compute this margin of safety as a percentage. Now what they have given, operating leverage is equal to 1 divided by margin of safety as a percentage. Now you try to apply this formula and see if you are getting the same answer. 1 divided by 0.2. How much is 1 divided by 0.2? 1 divided by 0.2 gives you how much? 5 times. So this is the exact answer that we got here also in the beginning. Yes, contribution divided by EBIT, if you do that, you are getting 5 times. If you use this formula, 1 divided by margin of safety as a percentage, you are getting the same answer as 5 times. Are you clear with this? So these are also mathematical equations that can only be proven. So always remember this, operating leverage is equal to 1 by margin of safety as a percentage. And what do you mean by margin of safety? Margin of safety means what? The sales made in excess of the break-even sales. And if you want to express this margin of safety as a percentage of total sales, what will I call this as? How will I do it? Total sales minus break-even sales, correct? That is your margin of safety divided by total sales. Are you clear with this? That is the margin of safety as percentage, and that is what they have given here. Margin of safety as a percentage is going to be what? Total sales minus break-even sales divided by total sales. In this case, it was 100,000 minus 80,000 divided by 100,000. Correct? That is 20,000 divided by 100,000 or 1 lakh. That's going to be how much? 0.2. And 1 divided by 0.2, you get how much? Exactly 5 times. Are you clear with this? There is an alternate formula that you can use for calculating the operating leverage. These are purely mathematical, nothing conceptual here. Are you clear with this? Now, with this, we have seen all the formulas that are covered in this particular chapter. So now let's quickly summarize this before we get into the problems. So now tell me, so leverages in this chapter, there are how many types of leverages? 3 types of leverages: operating leverage, financial leverage, and combined leverage. Correct? Operating leverage. What is the formula for calculating? Logical formula for operating leverage: percentage change in EBIT divided by percentage change in what? Percentage change in sales. Correct? Or there is another formula here. What is this other formula? Sandwich formula, that is contribution divided by EBIT. Are you clear with this? Then, or one more formula is there. I'm putting it here. Just now we saw 1 divided by margin of safety as a percentage. This is one more formula that we saw right now. Next, financial leverage. Financial leverage talks about relationship between what and what? The second half, EPS and EBIT. So percentage change in EPS divided by percentage change in EBIT. Are you clear with this? Yes. Or this formula, what you can use here is EBIT divided by EBIT minus interest minus preference dividend upon 1 minus T. And I told you in some cases the preference dividend is being ignored and they are just writing it as EBIT upon EBIT minus interest, or in other words EBIT upon EBT. That's another way that can be written. Combined leverage. What is the formula here? Combined leverage, it talks about the relationship between the bottommost and the topmost. Percentage change in EPS divided by percentage change in your sales. Are you clear with this? And the formula approach, what is it? Very simple. The formula approach, what will you do? So it is nothing but operating leverage into financial leverage. Yes, that is another formula. Operating leverage into financial leverage, or this into this. You just cancel it out. You get contribution divided by EBIT minus interest minus preference dividend upon 1 minus T. Are you clear with this? The entire chapter summarized in this particular chart. Very, very simple, provided you know this conceptually. What is the difficulty in this area? Very, very simple. And any kind of questions in this area you can tackle. Are you clear with this? So with this, let us get into the practical problems in this particular chapter. So now let's solve the first question, the question number 1. So let me read out the question for you. The capital structure of RST Limited is as follows. Equity share of 10 each, the value is 8 lakhs. 10% preference shares of rupees 100 each, the value is 5 lakhs. 12% debentures of 100 each, the value is 7 lakhs. The total is going to be 20 lakhs. Additional information. Profit after tax with a tax rate of 30%, the profit after tax is 2,80,000. Operating expenses, including depreciation of 96,800, are 1.5 times of EBIT. What is operating expenses? This is nothing but your variable cost plus your fixed cost. That is the variable cost plus fixed operating cost put together. Be very careful. They have not mentioned the fixed operating cost. No. They have just mentioned operating expenses, meaning what? What are all the expenses that you consider in costing? That is your variable cost plus fixed cost. Those two put together is 1.5 times your EBIT, and this includes what? Depreciation of 96,800. Then equity dividend paid is 15%. The market price of equity shares is 23 rupees. Now, what have they asked? What is the required part in the question? So they have asked calculate what? The operating leverage. 1 second. Yes, calculate the operating and financial leverage. Perfect. Cover for preference and equity dividend. That is preference dividend coverage ratio, equity dividend coverage ratio. Then the yield earnings yield ratio, price earnings ratio, net fund flow. Note all the operating expenses excluding depreciation are variable. So basically this overall this operating expenses is 1.5 times the EBIT, correct? So out of this they are saying only this 96,800 is fixed. So whatever is the balance, it is going to be variable cost. Now one more thing, sir, what are these three things? These three things are ideally a part of ratio analysis chapter, but in exams what they do is they mix that along with this particular chapter, leverages. So anyways, these are also very practical, guys. Please don't mug up anything in ratio analysis. I will give you the logics also. We will do this. I will logically explain whatever these these ratios stand for along with the formula, and we can get it done. Fine. So shall we get started? Yes. Now, how do we get started with this? The first thing that you need to do for all these leverage sums is that you need to prepare that statement, that is the profitability statement you need to prepare. So let me just put it here. So this is the first question that we're solving in this chapter. So what is the profit statement? Sales minus variable cost gives you contribution minus fixed cost, that is fixed operating cost, gives you EBIT, correct? So minus interest gives you what? EBT, earnings before tax. Then minus tax, in this question they have given at the rate 30%, right? So tax is 30%. Yes, tax the rate of 30%. So EBT, earnings before tax minus tax, gives you what? EAT, earnings after tax, correct? Yes. And then so from earnings after tax minus what? Preference dividend, you get what? You get net profit available for equity shareholders, or we will call this as EFE, that is earnings for equity shareholders. Correct? EFE, you'll just call it like this. Fine. And then have they asked for EPS and all? I don't think so. So they have not asked for EPS, so we can stop it here. Are you clear with this? Now let us plug the data given in that question. Profit after tax is how much? 2,80,000. So profit after tax, so this figure is how much? 2,80,000. So this figure they have given. So see, when you are doing this in exam, immediately what you do, you open three columns. That is, the first column should be for, the first column, second column, and the third column. The first column is for all these line items. The second column is for the amount. And the third column, you just put it as workings. So instead of writing a working note for everything, that is working note 1, coming down and writing, parallelly if you give the calculation, that is also accepted by the institute. Are you clear with this? Now against every figure, you should write how you got the figure. Now in this case, what is this figure? Earnings after tax, 2,80,000. How did we know? Given. Correct? Yes, we will put it as given. Then what else have they given? Now tax rate is given. Okay, so 10% preference shares, 12% debentures. So all these data is given. Now tax rate is how much? 30%. So we know that if the EBIT is 100%, the tax is 30, and obviously the earnings after tax is how much? 70. Correct or not? So now if 2,80,000 is 70, how much is 30? We can reverse work and calculate. Yes. So what is that going to be? 2,80,000. So into 30 upon 70. So if 2,80,000 is 70, how much will be 30? So 2,80,000 into 30 upon 70. So that's going to be how much? 1,20,000. Are you clear with this? So this is going to be 1,20,000. So now with this, you can calculate what? You can calculate the EBT figure. Yes, you can calculate the EBT figure. EBT figure is nothing but EAT plus tax. So you can reverse work. So how much is this? 2,80,000 plus 1,20,000. So 2,80,000. So 2.8 lakhs plus 1.2 lakhs. So how much is this going to be? This is going to be 4 lakhs. Are you clear with this? Yes. So we have reversed worked and we have computed this particular area. Now next, do we have the interest figure with us? Yes, we can calculate interest. So how do we know the interest figure? Now, in this question they have given, it is 12% debentures. The value of the debentures is 7 lakhs. So 7 lakhs into 12%. So you can just write down here against interest 7 lakhs into 12%. So how much is 7 lakhs into 12%? So 7 lakhs into 0.12, that gives you 84,000, right? That gives you 84,000, right? So EBIT minus interest is EBT. So what is EBIT? EBT plus interest. So EBIT is going to be how much? The balancing figure, that is 4 lakhs plus 84,000. 4 lakhs plus 84,000. It is going to be how much? 4 lakh 84,000. 4 lakh 84,000. Yes, right? And of course, preference dividend also we have got in the question. 10% on 5 lakhs. So preference dividend figure is also available. So it is going to be 10% on 5 lakhs. So 5 lakhs into 10%. So how much is that? 50,000 rupees. Correct. It's going to be 50,000 rupees. So what is the amount of earnings available to equity shareholders? It is going to be 2,30,000. Yes or no? So this is going to be 2,30,000. Right? Are you clear with this? So the second half of the second half of the P&L we have finished. So it's going to be how much? 2,30,000. Am I right? So this is 10% on 5 lakhs. That's right. Fine. Are you clear with this? Yes. Now, let's go above. Now, sir, beyond this, how do we crack this question? Now, look at this hint given. Operating expenses, that is variable cost plus fixed costs put together is how much? 1.5 times the EBIT, correct or not? And they have also given very clearly in the question that all the operating expenses excluding depreciation are variable, which means what? The only fixed operating cost that you have is this 96,800, correct or not? Yes. So can we say 96,800? This 96,800 is the only fixed operating cost. Yes. So how do we know? It is given in the question. So this 96,800 is the only fixed operating cost. It is the only fixed operating cost. Yes or not? Yes. Now, so remaining components, how can we find out? Very simple. The total of variable plus fixed cost is 1.5 times the EBIT given in the question. So how much is the EBIT? The EBIT is 4,84,000. Correct? So operating expenses is equal to 1.5 times of EBIT. How do we know? This data is given in the question. Operating expenses is nothing but variable cost plus fixed cost. And this is equal to how much? 1.5 times the EBIT. What is the EBIT? It is 4,84,000. Correct? It's going to be 4,84,000. Now 4,84,000 into 1.5, how much is this? So this is going to be 7,26,000. So 7,26,000 is equal to variable cost plus fixed cost. How much is the fixed cost? We know the fixed cost here. It is given in the question as 96,800. Correct? So 96,800. So the total operating expenses is 7,26,000, out of which 96,800 is your fixed cost. So the remaining is going to be your variable cost. So your variable cost is equal to 7,26,000 minus 96,800. Are you clear with this? So this is going to be how much? So this is going to be, so variable cost is going to be 6,29,200, right? So variable cost is going to be 6 lakhs. Yes, so 6,29,200. Maybe you can give this a working note reference, 6,29,200. So we can put it here as 6,29,200, and you can use this working note reference, right? Now, what is the contribution we know? So you have the EBIT, you have the fixed cost. So EBIT plus fixed cost gives you contribution, correct? Reverse working. So how much is that? 4,84,000 plus 96,800. That gives you how much? That gives you 5,80,800. Yes. So that gives you 5,80,800. So this gives you how much? 5,80,800. So 5,80,800. And how did we get this? It is 4,84,000 plus 96,800, right? So now what is going to be the sales? Sales minus variable cost is your contribution, or sales is equal to contribution plus variable cost. Or in other words, this is going to be 5,80,800 plus 6,29,200. So 5,80,800 plus 6,29,200. So how much is this? So plus 6,29,200. So it is going to be 12,10,000. So this is going to be how much? 12,10,000. Are you clear with this? See how beautifully we can solve this. It is all about the reverse working. So in for our explanation, all these black ink items are actually given data. Fine, or it is directly calculatable data. The reverse worked figures, I have put it in blue ink. Now in exam, you don't have this luxury because you can only use a black color ballpoint pen. So in exam, you don't have this luxury. So don't do all these things in exam. But right now I'm doing it so that you can understand it much better. So now we have the entire income statement with this. Let us just proceed and answer whatever is the data that is being asked for in the question. Now, first, what have they asked? Operating leverage and financial leverage. Guys, very simple, very simple. What is the operating leverage formula? Operating leverage is contribution upon EBIT, correct? So how much is my contribution? So contribution is going to be 5,80,800. 5,80,800 upon EBIT, sandwich, remember that. 4,84,000, correct? So 5,80,000. So this is 5,80,800 divided by 4,84,000. So contribution, they have written it as 12,10,000 minus 629,200. This is nothing but what? 12,10,000 minus 629,200 is nothing but 5,88,800. Are you clear with this? Sales minus variable cost is only contribution. So you get operating leverage. These two figures you have, you get operating leverage is 1.2 times. What is your financial leverage? Financial leverage, I told you, yes. So when preference dividend is there, technically it has to be EBIT divided by EBIT minus interest minus your preference dividend upon 1 minus T, correct? So financial leverage will be EBIT on the numerator. EBIT is going to be how much? 4,84,000. So 4,84,000 divided by EBIT minus interest, that is nothing but EBT, correct? EBT, that is 4 lakhs, EBT, that is 4 lakhs minus preference dividend upon 1 minus T. How much is preference dividend? 50,000. So minus 50,000 divided by 1 minus 0.3. If you do this, you will get the answer as how much? 1.47 times. Are you clear with this? Just a matter of plugging the figures. The main thing here is about preparing this income statement using the data given in the question. Are you clear with this? Right? Now I told you, alternatively, even when preference dividend is available, sometimes institute is taking this formula, that is EBIT divided by EBIT minus interest, or in other words, EBIT upon EBT, correct? So EBIT is how much? 4,84,000. How much is your EBT? That's going to be 4 lakhs. So if you use this formula, you will get a financial leverage of 1.21. Obviously, the answer will change. So, sir, financial leverage, is it 1.21 or is it 1.47? Look at this. That's why I've written out. For financial leverage, both the equations can be used in exams as per ICAI. Are you clear with this? So you can use any one of these two, or preferably if you want, you can, to play it safe, you can write both these formulas and put it there. Are you clear with this? So because here there is not much of a clarity at times, even when preference dividend is given, institute has ignored the preference dividend. Technically speaking, you should consider it. At times ignoring, and also they have done it. So anyways, let us not take the chance. You can write both the methods. It's just a matter of few more seconds. Are you clear with this? Yes. So with this, we have finished the first part of the question, that is operating financial leverage. Suppose in this question they had asked for combined leverage. What will you do? Operating leverage into financial leverage is your combined leverage. Are you clear with this? As simple as that. Next, cover for preference dividend and equity dividend. What is the meaning of this? Cover for preference dividend, this is called as, this comes in ratio analysis, this comes under something called as coverage ratio. Coverage ratio. Preference dividend coverage ratio, equity dividend coverage ratio. This is what they have asked in this particular question. So what is this, sir? I'll tell you. Now look at this. Preference dividend coverage ratio is profit after tax divided by preference dividend. Fine. You have the figures. Profit after tax, that is earnings after tax, is how much? It is going to be 2,80,000 divided by preference dividend is how much? 50,000. So 2,80,000 divided by 50, it's going to be 5.6 times. Very simple. Now, sir, for the preference dividend coverage ratio, why is the formula profit after tax, that is earnings after tax divided by preference share dividend? This is the question that you need to know. That is, this is the concept that you need to know. Very simple. What is the meaning of this? Preference dividend coverage ratio. Let us say you want to buy the preference shares of a particular company, right? Yes, they are saying that every year they will pay 10% dividend and all they are saying. But You want to know whether the company has the capacity to actually honor its commitment, correct or not? Just because they say they will pay, it is not necessary that they will have to pay, correct? What if they default? Yes, maybe then I will go to court. Yes, you will go to court, but you don't have time for all that. Yes, so basically, when you want to invest in preference shares of company, the most important thing that you look for is whether the company actually has the capacity to pay my preference dividend, correct or not? Now you tell me, how much is the preference dividend? 50,000 rupees. Now preference dividend is paid out of what? It is paid out of earnings after tax, correct or not? See, out of earnings after tax only preference dividend is paid. That is before this I need to pay interest and my taxes and all, and out of the earnings after tax, this is the amount available out of which the preference dividend will be paid. So what we are doing is we are actually finding out the coverage ratio, preference dividend coverage ratio. The formula is earnings after tax divided by preference dividend. That is 2,80,000 divided by 50,000. How much is it coming out to? It is coming out to 5.6 times. What is the meaning of this? The meaning is the earnings after tax, that is the profit out of which I am going to be paid my preference dividend, is 5.6 times the preference dividend amount, which means what? It is more. They have a lot of coverage, so I will definitely get my amount. This is the meaning. More the coverage ratio, better it is. Better it is for the company, better it is for the shareholder also. Are you clear with this? So I am calculating this EAT, that is the earnings after tax, upon preference dividend. Why are we doing this? We are trying to find out this earnings after tax is how many times the preference dividend. In this case, we saw that it was 5.6 times, which means what? The company definitely has, the company is earning 5.6 times the dividend amount they will have to pay, so they can easily honor that commitment. This is the meaning of coverage ratio. Are you clear with this? Sir, then cover for equity dividend, or in other words, equity dividend coverage ratio. What is the formula? Very simple. Very simple. Now look at this here. Now earnings, your equity shareholders, correct? So equity shareholders will be paid out of which amount? From their earnings for equity, correct or not? If at all the company has to pay dividend, they will pay it only out of this 2,30,000 to the equity shareholders. I'm not talking about preference, I'm talking about equity shareholders, correct or not? So if you want to further extend this, you will say earnings for equity minus your equity dividend, balance whatever you have is your retained earnings, correct or not? That's how it is going to be. Yes, guys. Yes. So now out of this earnings for equity only, the dividend will be paid to the equity shareholders. So now what is the dividend amount payable to the equity shareholders? So to the equity shareholders, what is the dividend amount? Now have they given anything in this question? Yes. Equity dividend paid is 15%. 15% on the equity value, 8 lakh. So 8 lakhs into 0.15. How much is your equity dividend? The equity dividend is going to be 1,20,000. Are you clear with this? And this equity dividend will be paid out of what? Earnings for equity, that is 2,30,000. So we are trying to calculate the coverage ratio for the particular equity dividend. So for equity dividend, what will be the coverage ratio formula? The profit out of which I am paying equity dividend divided by equity dividend. The profit out of which I am paying equity dividend is nothing but earnings for equity, or in other words, you can say earnings after tax minus preference dividend, that is 2,30,000. Correct? That is what they have also mentioned here. PAT or EAT minus preference dividend, 2,30,000 divided by what? Divided by 1,20,000, 1.92 times. Or in other words, what it means is, yes, the company has earned 1.92 times the amount of dividend that is payable to the equity shareholders. So will they be in a position to honor the commitment? Yes, they can also pay the dividend, and even after that they will be having some excess amount. This is the meaning of coverage ratios. Are you clear with this? Guys, please learn the subject logically. You need not mug up anything. Are you clear with this? This is what they have mentioned here. Next, what is the next one they have asked? Earnings yield ratio and price earnings ratio. First, let us see price earnings ratio. What do you mean by price earnings ratio? Popularly known as P ratio. Price ratio is nothing but price divided by earnings for equity share. Or in other words, price stands for what? Market price per share. Earnings stands for what? Earnings price per share. Are you clear with this? MPS divided by EPS. Are you clear with this? Now in this case, MPS is how much? 23 rupees. Yes. What is the EPS? What is the EPS? Can you find out the EPS? Yes. The earnings for equity is how much? 2,30,000. Correct or not? Yes. So EPS, can I say, is nothing but 2,30,000. This is the earnings available to the equity shareholders divided by divided by, how much is the number of equity shares? 8 lakhs divided by 10. That's going to be 80,000, correct? Divided by 80,000. So what is your EPS going to be? So 2,30,000 divided by 80,000. It's going to be how much? 2.875. Are you clear with this? So 2.875 is going to be your EPS. Yes. So look at this. Look at this. Your price earnings ratio is going to be 23 divided by 2.875. Price earnings ratio, as the name suggests, price divided by earnings, that is MPS, market price per share, divided by EPS, earnings price per share. So MPS divided by EPS, 23 divided by 2.875, it is 8 times. What is the meaning of this? What is the meaning of this? It means that if the price, earnings price per share, the earnings per share is 2.875, generally the market price is 8 times your earnings. So the meaning of this, the price earnings ratio is, so in this case, it means that, let's say my EPS is 10 rupees, then it means my market price of the share is going to be 80 rupees. So generally, my market price is 8 times the earnings per share. Are you clear with this? This is the meaning of EPS in this case. Sorry, this is the meaning of price earnings ratio. In this case, it is 8 times. It can be any number of times. This is basically a multiplier. That is, it expresses a relationship between the market price and the earnings per share. Are you clear with this? Market price per share and the earnings per share. Are you clear with this? This is called as price earnings ratio. Some people even call it as price earnings multiple. Now, what do you mean by earnings yield ratio? It is the inverse of price earnings ratio. Here it is nothing but EPS divided by MPS into 100. Are you clear with this? This is nothing but it is the ulta. It is the ulta of price earnings ratio. So earnings per share divided by market price per share into 100. So 2.875 divided by 23 into 100, that gives you 12.5%. Or in other words, you are expressing your earnings as a percentage of your market price. So generally my earnings is 12.5% of the market price. This is the meaning. So this is earnings expressed as a percentage of the market price, whereas this is a multiplier of the market price in terms of your earnings per share. Are you clear with this? That's about it. Nothing great here. Next, finally, what are they asked? Yes, the net fund flow they have asked. Now, guys, you tell me, earnings after tax, how much does the company have? 2,80,000. Now you tell me, out of this 2,80,000, not all the expenses are cash expenses, correct? So ideally speaking, this fixed cost of 96,800 is a depreciation. So net fund flow means what? Fine. All these things are fine. So what is the amount of cash that you have? The profit that is realized in cash. How much is it? Very simple. Just see, it is logical. You can just answer this logically. Look at this. Net profit after tax, correct? Plus depreciation minus the total dividend. Or in other words, they are starting from here. Profit after tax is how much? 2,80,000. Now, this 2,80,000 is arrived after deducting this 96,800. So add it back. Plus 96,800. Yes, minus all the dividends that you have paid. You have paid 2 dividends, that is preference dividend and equity dividend. So here preference dividend is 50,000, equity dividend we saw is 1,20,000, correct? So basically your earnings after tax, add back the depreciation which has already been reduced, fine, so add it back, and now minus the dividend. Why dividend should be subtracted? Because till now we have not subtracted. The base from which we have started is only profit after tax. So the dividends will have to be now subtracted, and finally you get this answer as 2,06,800, or this is nothing but the profit that is realized in cash. Are you clear with this? That is called as net fund flow. Are you clear with it? Net funds flow. Are you clear with this? So this is a cash realized profit. That is the meaning of this 2,06,800. And with this, we have finished this entire question, just question number 1. Are you clear with this? So now let's move to the next question. So the next question, question number 2. So let's read the question. A firm has sales of 75 lakhs, variable cost of 25 lakhs, fixed cost of 6 lakhs. So fixed cost is 66 lakhs they have given, which means what? This is going to be, if nothing is mentioned, you should assume fixed cost as fixed operating cost. Don't say that the total fixed cost, that is fixed operating cost plus fixed financial cost is 6 lakhs. No. If they have just mentioned as fixed cost, assume it to be fixed operating cost. Are you clear with this? 6 lakhs. Then it has a debt of 45 lakhs at 9%, that is the debentures interest rate is 9%, and the equity has a value of 55 lakhs. Now they've asked a few questions. What is the firm's ROI or ROCE? ROI stands for return on investment. ROCE stands for return on capital employed. Both are same. Does it have favorable financial leverage? If the firm belongs to an industry whose asset turnover is 3, does it have high or low asset leverage? What are the operating financial combined leverages of the firm? If the sales drop to 50 lakhs, what will be the new EBIT, and at what sales level the EBT of the firm will be equal to 0? 6 subdivisions they have asked. Maybe if they ask this, it could be a 10-mark question. Now, yes, this is also again the first part. Let us go one by one. The first part of the question, there is ROI calculation. It's basically your ratio analysis chapter, but anyways, it is logical. Let us crack that here. Now, before that, what we need to first do, remember always, in case of leverage chapters, the first thing that you need to do is what? You need to prepare that profit statement. So, profit statement, sales minus variable cost gives you contribution, minus fixed cost gives you what? EBIT, minus 9% interest gives you EBT. Correct? In this question, they have not asked, they have not given any tax rate. So, EBT is also equal to EAT in this question. Correct? There is no preference dividend here. So how do you know so there is no preference dividend? Because they have not raised any funds through preference only. So this is also my EFP. Are you clear with this? All bypass. This is like a bus route. All bypass. They have bypassed everything. Are you clear with this? Sir, how can we say this? Because no tax is there. So EBT is equal to EAT. Then no preference dividend is there. So EAT is equal to EFP. So everything is the same in this question. Are you clear with this? And all these data is given. There is no computation. This entire data is given in the question. So this interest is alone computable. So it's easy to compute. 9% on 45 lakhs. That gives you how much? 4,05,000. So overall, your EBT or EAT or EFP is going to be 22,95,000. Now you have the figures with this. Now let's get started. What is the firm's ROI, also known as return on capital employed? So return on investment, also known as return on capital employed. Very simple. Logically think, guys. Just logically think. What do you mean by this? As the name suggests, it means return on investment. Return divided by investment. Yes or no? Now, simple. In this company, what is the total amount that has been invested? 45 lakhs plus 55 lakhs. Correct or not? Yes. How much is that? That is going to be 100 lakhs. Correct? Now, how much has the company earned? How much the company has earned? How much the company has earned, that is the earnings which is available for both these sources of finance. So what is the earnings that is available for both these sources of finance? Now, sir, what do you mean by this? Now, basically what I'm asking is, now you're saying this is returns upon investment, correct? Now, returns means what? How much the company has earned, that is earnings. So there are so many earnings. We have EBIT, correct? Then we have EBT, then we have EAT, then we have EFE. Sir, out of this, which one should I take in the numerator? You have this doubt, correct? Very simple. In the denominator, what we are taking? In the denominator, we are taking the total capital employed. That is the total investment from all the sources, correct? Debt, preference, equity, everything, correct? That is the investment. So in the numerator, logically, what you should have that earnings which is available for all the stakeholders of the company, all the investors. Now you tell me what is the earnings that is available for all the stakeholders of the company? EBIT. Why? Because from EBIT only interest will be paid, and after that your tax will be paid, after that preference dividend, equity dividend. So the EBIT is the actual earnings out of which all the sources of finance will be funded, or all the sources of finance will be serviced. Are you clear with this? So obviously, return upon investment, in the denominator the investment is total capital employed, then in the numerator it has to be EBIT. Why EBIT? Because this is the earnings out of which I'm going to pay all the sources of finance. Are you clear with this? Yes. So what is the formula here? You have both the figures. So EBIT upon total investment. Total investment is nothing but debt plus equity. So if preference is given, that also needs to be added. Are you clear with this? That's going to be 27%. Now, what is the meaning of this? What is the meaning of this? That is, every rupee invested in this particular company is generating a return of 27%. Are you clear with this? Yes. Now, look at this. Very beautifully worded is the second part. Does it have a favorable financial leverage or not? They are asking whether this company is having a favorable financial leverage or not. EBIT is how much? 27 percentage. That is for every rupee invested in this company from whatever source of finance, the company is actually doing business by generating 27 percentage of returns, correct? But actually seeing to the debt holders, you tell me leverage, why does it happen? Because of the presence of fixed financial cost. Now in this case, the fixed financial cost is what? Debt channel, correct? Debt mode. This debentures, what is the rate of interest that I need to pay? 9% only. But the company is earning 27%, but they need to pay 9% only to the debenture holders. The balance, whatever it is, the equity shareholders can enjoy. Or in other words, this is the reason for the magnifying effect. Does this company have a favorable financial leverage? Yes, this company has a favorable financial leverage. Sir, how can you say that? Because your return on investment is greater than your cost of debt. Are you clear with this? Look at this. Since the return on investment is higher than the interest payable on debt, 9%, the firm has a favorable financial leverage. So always understand, in case they are asking for this type of questions, what you need to do. So favorable or unfavorable financial leverage, what and what you will compare? The return on investment should be compared with the cost of debt. Are you clear with this? Sir, in this question, they have compared it with the interest payable. Tax is not given. Suppose tax is given, what you need to do? You need to calculate the post-tax cost of debt, that is KD. So compare your return on investment with KD and arrive at the conclusion. Are you clear with this, guys? Is everyone able to understand this? Yes. Next, what have they given here? Now, if the firm belongs to an industry whose asset turnover is 3, does it have a high or low asset leverage? Asset leverage means asset turnover. So what do you mean by asset turnover? Asset turnover ratio. What is it? Turnover means what? Total sales, correct? So asset is total assets. The formula is total sales, that is net sales divided by total assets. Are you clear with this? Now in this case, total assets is not given. So you can take, when total assets is not given, total assets means what? Fixed assets plus current assets. In case the total assets is not given, take this as equal to the total investment. As simple as that. Are you clear with this? So now what is the total investment? 100 lakhs. What is the total sales? 75 lakhs. Now what is this? The entire asset turnover ratio is how much? 0.75. It is expressed in times, 0.75 times. What is the meaning of this? Basically they are saying for every 1 rupee invested in this company, for every 1 rupee of asset put in this company, the company is able to generate how much? 0.75 rupees worth of sale. For every 1 rupee of asset deployed in the company is able to generate a sale of 75 paise. But actually seeing what is the industry average, for every rupee of asset invested, the industry average is what? They are able to generate 3 rupees of turnover. But our company is not at all efficient. For every rupee of asset that has been actually invested in the company, deployed in the company is generating a sale of only 75 paise. So now you tell me, does this company have a high or a low asset leverage or high or low asset turnover ratio? Obviously the company has a low asset turnover ratio. What it means? The company is inefficient basically. Are you clear with this? Yes. So now see, look at this. This is a favorable financial leverage. From a leverage perspective, it is favorable. From an efficiency perspective, there is still a scope of improvement. This is the meaning of that, right? So look at this. So asset turnover ratio is 0.75 times. The industry average is 3. Hence the firm has a low asset leverage. Are you clear with this? Very, very simple. Next. What are the operating, financial and combined leverages of the firm? Very simple. So in this case, there is no preference dividend. So there is no confusion. Operating leverage, contribution divided by EBIT. Then financial leverage, EBIT divided by EBT. And your combined leverage, multiply the two, or you can write it down as contribution divided by EBT. As simple as that. Look at this. Contribution divided by EBIT. There is your operating leverage. 33 lakhs divided by 27 lakhs. It's 1.222222. Correct? So there is a magnifying effect. Yes. Why is there a magnifying effect? Because operating leverage, magnifying effect happens because of the fixed operating cost. Then financial leverage, EBIT divided by EBT. The figures are already there. You can just put it. So what is it? This is happening because of what? This is happening because of the presence of the debt interest. Are you clear with this? And combined leverage is contribution divided by EBT. The combined leverage is going to be 1.438. We have all these figures on the top. It's just a matter of plugging the figures and doing it. Are you clear with this? That is a direct answer. Are you clear with this? Or combined leverage can also be done as operating leverage into financial leverage. You get the same thing. Are you clear with this? Now, the last two parts of the question are very, very interesting. This is where we need to, you need to understand this. This is very, very important parts because these two are the core of leverage. Now, look at this. If the sales drop to 50 lakhs, what will be the new EBIT? Now, carefully listen. Carefully listen. What have they asked? If my sales drop or reduce to 50 lakh rupees, then what will be the new EBIT? There are two ways of calculating this. What you can do, you can once again, for 50 lakhs, you can once again prepare this income statement. Correct? How can you prepare? So variable costs currently 42 lakhs for 75 lakhs, which means you can arrive at VC ratio. You will have PV ratio. With that for 50 lakhs of sales, you can arrive at all the entire income statement. You can prepare and arrive at the EBIT. Fine. Now, there is one more way to do this. There is one more way to do this. What is the way to do this, sir? Now, you look at this. What have they asked for? Look at this. What have they asked for here? If my sales drop to 50%, what will be the new EBIT? Now, imagine this income statement. Now, whatever I taught you in operating leverage talks about what? The relationship between the sales and EBIT, correct? Or in other words, can we say operating leverage is equal to percentage change in EBIT upon percentage change in sales, correct or not? Yes. Now you tell me, do we have the operating leverage with us? Yes, operating leverage is 1.22222. Yes, operating leverage is 1.2222 is equal to percentage change in EBIT that we don't know, we need to compute. Percentage change in EBIT divided by percentage change in sales. Now, what is the percentage change in sales? From 75, it is being reduced to 50. Or in other words, sales is dropping by how much? 25%. Correct. Sorry, sales is dropping by how much? 25 lakhs. Correct or not? Yes. So 25 lakhs upon the base 75. How much is this? 25 upon 75. Can we say this is nothing but minus 33.33%? The sales is reducing by 33.3333%. 33.3333%. Correct or not? Or in other words, can we now calculate what is the percentage change in EBIT? This cross multiply this. So percentage change in EBIT will be how much? The percentage change in EBIT will be 1.222222. It goes on into minus 33.333333%. So how much is this? 0.333333. Retain the entire decimals into 1.22222222. Keep all the decimals. So it's going to be how much? The percentage change in EBIT is going to be so 40.740 and it just goes on percentage. Are you clear with this? This is what? This is going to be the change in your EBIT. So if your sales fall by 33.33%, your EBIT will fall by how much? 40.740740%. Are you clear with this? Now, what is the present EBIT? 27 lakhs, correct? So 27 lakhs is the present EBIT, correct? So what will be the reduction in EBIT? 0.407407 into 27 lakhs, correct? Into 27 lakhs. So how much is that going to be? That's going to be what? So that is going to be, one second. Yes, so that's going to be 11 lakhs. Yes, that's going to be 11 lakhs exactly. That's going to be 11 lakhs. So how much you get? The balance is going to be 16 lakhs. So the revised EBIT is going to be 16 lakhs. Basically, the present EBIT is 27 lakhs. The fall, change in EBIT, how did we get this 11 lakhs? 40.74 percentage approximately into what? 27 lakhs. This is the fall in your EBIT. So original EBIT minus the change in EBIT gives you the revised EBIT. So revised EBIT will be how much? 16 lakh rupees. Are you clear with this? Use the concept of leverage to crack this question. Look at this. This is what they have done. It is going to be 16 lakhs. If the sales drop to 50 lakhs from 75 lakhs, it falls by 33.33%. How did you get 33.33? So the difference between this is 25 lakhs. 25 lakhs divided by the base 75 lakhs is 33.33. Hence, the EBIT will drop by 40.73%. They have rounded off. I have not rounded off. That's why I got the perfect answer of 16 lakhs. Since they have rounded off here, they got 60 lakh and 290. Are you clear with this? And then further, they just said it is going to be 16 lakhs. But yes, this is the way you can do it. Are you clear with this? So percentage fall in sales into operating leverage, and you will arrive at this answer. That is what they have mentioned here also. Are you clear with this, guys? Very, very simple. Now, finally, at what sales level the EBT of the firm will be equal to 0? The EBT of the firm will be equal to 0. At what sales level the EBT, earnings before tax, of the firm will be equal to 0? This is the question they have asked here. Now, what is the format? What is the format of your income statement here? So it's sales minus variable cost gives you contribution, minus fixed cost gives you EBIT, minus interest gives you EBT, minus tax gives you EAT, minus preference dividend, if any, gives you what? Earnings for equity. Correct? Yes. Divided by number of equity shares, you get what? You get your EPS. This is what you get. Correct? Now, what they are saying, now they are saying at what sales level the EBT of the company will be equal to 0. Now, you tell me, when the EBT is 0, obviously the tax will be 0. Correct? Why? No earnings, no tax. Obviously, tax is a percentage on EBT. So, earnings after tax will be 0. In this question, there is no preference dividend. So, basically, your EFE will be 0. Correct? Your equity shares can be anything. Fine, let's say 10,000 or whatever it is. Fine. So basically your EPS will be 0. Are you clear with this? Or in other words, if your EBT becomes 0, it basically means your EPS becomes 0. Are you clear with this? If your EBT becomes 0, your EPS becomes 0 in this case. Correct? Sir, can EPS be negative? Yes. If there is a preference dividend needs to be paid even when you don't have your sufficient earnings. Correct? In that case, yes, EPS can become negative also, but we are not talking about this. In this question, there is no preference dividend. So basically, when your EBT becomes 0, there's nothing but your EPS becomes 0. Yes or no? Now look at this. Now, can I say, what have they asked? At what sales level of the firm will the EBT be equal to 0? This is what they have asked. At what sales level the EBT be equal to 0? Currently, EBT is how much? 22,95,000, right? Accordingly, you would have computed the EPS. Now, you tell me, a fall in EBT, the percentage change in EBT is same as the percentage change in EPS, correct or not? In this case, yes, because there is no preference dividend. In between only if you have a fixed financial cost, the leverage effect will be there, the magnifying effect will be there. If not, it will exactly be equal to 1. The leverage will be equal to 1, correct or not? So in this case, can I say the change in EBIT is the change in EBT is equal to the change in EPS? Yes or no? Yes. And what have they asked? What is the sales level at which my EBT will be equal to 0? Are you clear with this? Now, between sales and EPS, what is the relationship between sales and EPS? That is basically your combined leverage. So what is the combined leverage formula? Percentage change in EPS divided by percentage change in sales. Correct or not? Now in this question, the percentage change in EPS and the percentage change in EBT are the same. Why? Because there is no preference dividend in between. Correct? So can I rewrite this? In this question, can I rewrite this as combined leverage is equal to percentage change in EBT divided by percentage change in sales? Yes, guys, are you clear with this? Now, what they are saying, do we have the combined leverage? Do we have the combined leverage with us? Yes, we do have the combined leverage. How much is combined leverage? 1.438. Correct? So, can I say 1.438 is equal to percentage change in EBT? What is the percentage change in EBT? Minus 100%. Sir, how do you know minus 100%, sir? Currently, EBT is how much? 22,95,000. They are saying at what sales level the EBT will be equal to 0. So, if I want my EBT to be equal to 0, it has to reduce by the entire 22,95,000. Or in other words, the change will be minus 100%. Correct? So, minus 100% divided by percentage change in sales. Are you clear with this? Are you able to understand this equation? With this, if you cross multiply, you can arrive at the percentage change in sales. The percentage change in sales is equal to minus 100% divided by 1.438. So tell me, how much is this? Minus 100 divided by 1.438. That gives you how much? It gives you minus 69.5410% approximately. Are you clear with this? Are you clear with this? So now what will be the sales level, the revised sales level? So this is what they have given. Are you clear with this? So this is going to be 69.54%, correct? 69.54%. So the revised sales level will be how much? So the revised sales level will be original sales minus 69.54% of that. Or in other words, can we say original sales is 75 lakhs. So the revised sale will be 75 lakhs into 1 minus 0.6954, correct or not? Yes, so you will get the revised sales as 22,84,500. What is this revised sale? This is the sales required to make your EPS 0. So when it makes your EPS 0, obviously your EBT will be 0 in this case. Are you clear with this? Using the leverage formula, we have actually calculated the required change. Or if you want, you can do the reverse working. You can prepare the statement, do the reverse working, and also arrive at the answer. That way is also fine. That is easy method. But I mean, that is easy, but it's time consuming. Whereas this is actually more strategic. But if you're doing it in exam, it will take lesser time. Are you clear with this? So this way you can do it and you can arrive at the answer. So with this, we have finished this entire chapter. So please revise this entire chapter thoroughly. Fine. And now we will move to the next one. So now let's start with the revision of the third chapter in this marathon, which is capital structure decisions. Now, what is this chapter all about? Now, in financial management, as we already know, this subject has 3 objectives. What are the 3 objectives of our subject? Financing decisions, then investment decisions, and then dividend decisions, right? Financing decision means what? Taking decisions with respect to the fundraising activity, correct? Yes. Investment decision means what? Taking decisions with respect to where the funds need to be invested, whether I should put it in project A or in project B or in project C and so on. And dividend decision stands for what? It stands for how much of my profit needs to be paid as dividend and how much needs to be retained with the company, right? Now, this chapter, capital structure, comes under the first category, that is financing decision. Now, sir, before that, first, what do you mean by a capital structure? What do you mean by a capital structure? Capital structure is nothing but the components of every single source of finance. So capital structure is nothing but the components of different sources of finance. For example, let us say in situation 1, okay, so equity share capital, preference share capital, and debentures. Just an example. Let's say the first scenario, or let us say this is A Limited. Okay, let's take this as A Limited. I'm taking this as A Limited. A Limited has raised a total of how much? Let us say 100 crores. Okay, and the entire 100 crores they have raised from equity share capital. Are you clear with this? No preference, no debt. Let's say B Limited is there. They have also raised a total of 100 crores. But for B Limited, if you see, they have raised 60 crores from equity share capital, then 30 crores from preference share capital, 10 crores from debenture mode. Let us take C Limited. C Limited, what they have done? C Limited, they have raised 50 crores from equity, nothing from preference, and 50 crores from debentures. So overall, they have also raised 100 crores. Or in other words, so how much of equity, how much of preference, and how much of debentures are present inside this capital is called as capital structure. So for A Limited, I will say the capital structure is 100 crores entirely from equity. Whereas for B Limited, I will say 60 from equity, 30 from preference, 10 from debentures. And for C Limited, it will be 50, nil, and 50, and so on. So the capital structure means the manner or the source from which I have raised funds. So how have I raised this funds? This entire 100 crores, give me the breakup from where, which source we have raised what, that is called as capital structure. And in this chapter, we are going to see which is the best source of capital structure, which is the optimum capital structure. That is, I want 100 crores. Money is money. Yes, I want 100 crores. But should I raise this entire money from equity, or should I raise 60 from equity, 30 from preference, 10 from debt, or 50 from equity, 50 from debt? Sir, which is beneficial for me? How do I find out? So this decision is called as capital structure decision. Are you clear with this? And this is what we are going to see in this particular chapter. This is number one. Number two, one very important thing that we need to see in this chapter is that the first part of this chapter talks about general areas. It says, how do I choose the best capital structure? Capital structure means what? The mix or the proportions of different sources of capital, which is beneficial entirely from equity, or partly from equity, partly from preference, partly from debt, or equity and debt. Which mix is best? If so, how much should be that mix? All this is what we are going to take the decision here. Now, how do we choose which is the best source of finance? How do we select which is the best source of finance? So the decision of selecting the best source of finance can be taken on the basis of following. You can take this decision on the basis of return on equity. You can take this on the basis of market price per share. You can take this on the basis of earnings price per share. So what is this? What are you saying? Now, broadly, there are three parameters. It goes on, right? So what we have seen here, what are the three parameters that we have seen here? So first, you can take it on the basis of return on equity. Fine. The second was from the basis of what? Market price per share. And the third was on the basis of earnings price per share. Sir, what is it? Now, for each of these three capital structures, okay, for these three capital structures, overall, what is the fund raised? 100 crores. But because of where I am raising these funds, because of this, my overall return on equity can change. Yes or no? Return on equity is nothing but what? Earnings for equity divided by equity shareholders funds. Correct or not? Yes, equity shareholders funds. So basically, this is nothing but how much amount is earned by the equity shareholders divided by how much they have given you as a capital. Correct? So now, if you are going as per this method, so for each of these three capital structures, calculate the return on equity and go for that alternative that gives you the maximum return on equity. That is called as return on equity approach. No, sir, I want to look at it from the perspective of market price per share. Then what you can do is, for each of these three capital structures, calculate the market price per share and go for that alternative that gives the maximum price per share. No, sir, I want to go based on EPS. Compute the EPS for each of these three alternatives and go for that alternative that gives you the maximum EPS. Now, you might be having a doubt. Sir, if I go based on return on equity, they are saying, just an example, I'm just giving you an example. Fine. If I go based on return on equity, they are saying, this is the ranking that I'm getting, 1, 2, and 3. That is, return on equity is maximum for A Limited. Correct? And number 2, it is next comes B Limited and next comes C Limited. Sir, but if I go as per market price per share, so what is happening? So C Limited, that is the third alternative, gives the maximum price per share, followed by let us say A Limited, and finally this B Limited comes in. Are you clear with this? Now, if you go as per EPS, if you see as per EPS, what happens? The first alternative gives the least EPS, correct? The second alternative gives the topmost EPS, and the third alternative gives the second EPS. Or in other words, if you go as per return on equity, the best source of finance is all equity. Whereas if I go based on market price per share, it says that the third alternative is the best capital structure. Whereas if I go based on EPS, then the second alternative seems to be the best alternative. Sir, there is a conflict in rankings. So of these three methods, which is the best? So there is nothing like which is the best. It is just three different parameters based on which you can judge. I will give you one small example. Now, is share market, investing in share market, is it good or bad? Is investing in share market good or bad? Now, let us say I am asking you this question. Investing in share market, is it good or bad? You are saying it is, sir, very good, sir. Why? Because if you invest in share market, you will get more returns. Fine. Now I'm going and asking the same question to your grandfather. Okay, assume I'm asking the same question to your grandfather. I'm asking him, is investing in share market good or bad? He says it is definitely bad. I would rather put all my money in my FD. I will not invest in share market. If you ask him why, he will say because in share market the risk is more, whereas in FD and all there is not much of risk. Or in other words, from a risk perspective, FD seems to be good. From a return perspective, share market seems to be good. Now, you tell me, FD is better or your market is better, share market is better. There is no one conclusion to this. If you look at it from the perspective of risk, FD seems better. If you look at it from the perspective of your return, then your share market seems to be better. Similarly, there can be conflict in rankings based on the method that you pick. If you pick based on return on equity, maybe one alternative will be the best. Based on MPS, market price per share, it might give another alternative as the best result. Are you clear with this? So don't compare these three. Don't compare these three methods of finding out which is the best structure, capital structure. Are you clear with this? Yes. So you just leave it there. So that's why the subject is open-ended with respect to this. If you go as per return on equity, I will choose the first alternative in this example, just an example. If you go as per the market price per share, I will go with the third alternative. If you go as per EPS, I will go with the second alternative. And that's all. You should leave it there. You cannot say of these three, overall, only the first alternative is better or second alternative better. No. From the perspective of return on equity, maybe one alternative is better. From the perspective of market price per share, another alternative may be better. And from the perspective of EPS, another alternative may be better. We don't know. Maybe it might even match. All the three might even show that the alternative one is better. We don't know. But what I'm trying to say is, please don't compare between these three methods, because these are three different perspectives of looking at the same situation. Are you clear with this? This is exactly same as what I was telling you. Is share market good or bad? From a risk perspective, it is bad. From a return perspective, it is good. Now you decide. If you are a risk-taking person, that is, I am not bothered about risk, sir, I am only focused on return, then you will go for share market. You are a person who feels, no, I don't want more money. My objective is to not lose the money that I currently have. Then you are a risk-averse person. You don't want to take risk. From the perspective of risk, you will say share market is bad and you will go for FD. So there is no one single answer. Sir, is share market good or bad? No, it is good as well as bad. It depends on the perspective from which you look at it. Are you clear with this? This is again a place where many students get confused. So of these three capital structures, which is better, sir? No, there is no one size fits for all answer here. There is no ready-made answer. You should look at from the perspective of return on equity, one might be better, and from the perspective of MPS, one might be better, and from the perspective of EPS, another may be better. Are you clear with this? Yes. So this is what we will be discussing in the general part of the discussion. Then there is the second part to this particular chapter, which is the most important part and supposedly the complicated part for many students. In my past interaction with students, I've seen that they struggle in this particular part of this chapter, which is called as capital structure theories. It is called as capital structure theories. In capital structure theories, we will be seeing that a total of 4 theories we will be seeing. So now, please don't think that theory means what? Don't think that theory means, now law paper is theory, FM paper is practical. So theory means what? Basically what we think is, now theory means if there are only words without any practical numbers and all, we call it as a theory area. No. Theory is not that. Theory is basically, the real meaning of theory is idea or one person's perspective. So capital structure theory means what? There are 4 people. There are 4 different people, human beings. There are 4 different economists. They have given their perspectives. On choosing the best capital structure, and we are going to read it. For example, net income approach was given by a guy called David Durant. Okay. So from his perspective, what he says is what we are going to read. So this is fully a practical area. There will be numerical problems. So don't think we are going to see some theory area. That's why I'm saying there's a misunderstanding. Theory doesn't mean only words. No, that is what generally CA students generally think. Theory subject, practical subject. That theory you don't apply here. Are you clear with this? Theory means a perspective. So here, net income approach. This particular approach is given by one guy, and we will be seeing what is his approach. He will be saying that, see, these are the assumptions based on which I am choosing the best capital structure. Fine. Net operating income is another approach which is given by another person. Traditional approach is given by another person, and Modigliani and Miller approach, this is also given by one more individual. Are you clear with this? So broadly, we will be seeing what each of these 4 capital structure theories are saying. They are quite distinctive, and what they are is what we'll be seeing in the second part of the discussion in this particular chapter. So this is the overview of this particular chapter. So let's get started with the first part of it. So the first part of it, in this segment, we'll find out the best alternative source to fund a business. Alternative source could be what? Equity, or equity plus debt, or equity plus debt plus preference, maybe in different mix, different proportions. And this is called as capital structure. Which is the best capital structure? That is what we need to find out from different perspectives. We can find out. The following are the various sources of finance for an entity: equity share capital, retained earnings, preference share capital, debentures, long-term loans. Money or funds can be raised from one or more sources, and it requires careful decision making. And how will you take the decision? The decision of selecting the best source of finance can be taken on the basis of return on equity, MPS, EPS, etc. Are you clear with this? So from each perspective, there could be a different ranking. That is fine. That's why I said the subject is open-ended. You cannot say of all these things, only one is better. No, nothing of that sort is there. Are you clear with this? From the perspective of ROE, maybe one particular capital structure might be better, or one alternative might be better. As simple as that. Now, one more thing. Now, in this case, what happens? Look, A Limited. So let me just take this up. 1 second. So I'll just rewrite it here. Right. So now we have 3 sources, or we have, let us say, 3 alternative sources of funding our business. Okay, I will call this as alternative 1. I will call this as alternative number 2. I will call this as alternative number 3. See, basically the company needs how much? 100 crores. Money is money. Correct? I need it for what? To invest in my multiple projects. Which project to invest? That comes under investment decisions. Fine. That is the next chapter that we are going to see. But right now, I need 100 crores. Yes, fine. I will arrange. But that 100 crores, from where I should raise, is the decision that we are taking in this chapter. It could be entirely from equity, or partly from equity, partly from preference, partly from debt, or partly from equity and partly from debt. In whichever manner you want, you can do it. Correct or not? Maybe there could be an alternative 4. Partly from equity and partly from preference, 50-50, and 0 from debt. It could be anything, right? Now, of these 3 alternatives, in this case, I'm giving you 3 alternatives. Don't think that there are only 3 alternatives. There could be any number of alternatives. So now, out of these 3 alternatives, which is the best? That decision we will be taking based on multiple parameters like ROC, return on equity, your market price per share, and earnings per share. Now, but before that, you should understand one thing. EBIT stands for what? EBIT stands for earnings before interest and tax. And earnings before interest and tax will be the same for all these 3 alternatives. Sir, what you are saying, or in other words, EBIT will not change because of the capital structure. Or in other words, this overall is 100 crore rupees. For 100 crore rupees, the EBIT will be the same, irrespective of where you have raised this 100 crore rupees from. Sir, 100 crores, I have raised it from equity, or partly from equity, debt, and preference. Still, EBIT will be the same. Why, sir? Because EBIT is nothing but what? Operating profit. How did you arrive at EBIT? Recall our income statement. Sales minus variable cost gives you what? Contribution, minus fixed operating cost gives you EBIT. Correct? And from here, minus interest gives you EBT. Then minus tax gives you EAT. Correct? Minus preference dividend gives you earnings for equity. Correct? Yes, earnings for equity, and divide by number of equity shares, you get what? You get your EPS. Correct or not? Yes. So basically, now overall in all these 3 scenarios, how much amount I have invested into the business? 100 crores. And till my EBIT level, it is all relating to my operating activities. There is nothing concerning my financing activities, correct? Or in other words, this is the costing area, correct? Overall in this business, I have invested how much? 100 crore rupees. So using this 100 crore rupees, whatever sales minus variable cost, minus fixed cost, whatever I get, that is the EBIT. Or in other words, EBIT for all the alternatives having an overall same capital will be the same. Only after EBIT, things will change because of your capital structure. Are you clear with this? So basically, now in this case, in the first alternative, if you see, there is only equity, correct? So in this case, there will not be any interest, there will not be any preference dividend, correct? Whereas if you see in the second case, you have both the preference as well as debentures. So the second alternative, there will be interest, there will be preference dividend. So finally, the earnings per equity and the EPS might change. Are you clear with this? And similarly, the third one, you have only equity and debentures. So basically what you have, you will be having only interest, but you will not be having any kind of preference dividend. So basically your capital structure, that is the source of finance, will affect your profit only after your EBIT, or till your EBIT, there is no change in your capital, there is no change in your profit because of the source of finance. Are you clear with this? So your source of finance will not impact your EBIT. Your source of finance will impact only the items that are coming after the EBIT. Are you clear with this? In these three scenarios, overall in my business, I have deployed 100 crore rupees. Using that, I've generated sales and I've made operations. So all the three sources will start with the same EBIT. Are you clear with this? From there only things might change. In alternative 1, there is no interest dividend. In alternative 2, interest dividend both are there. In alternative 3, only interest is there. There is no preference dividend. So this can change only after the EBIT. Are you clear with this? So first thing to understand is that EBIT will not change based on your source of finance. That is, capital structure, which is the source of finance, will not impact your EBIT. It will only impact your components that come after the EBIT. Fine. This is a very, very important thing that you need to understand. Now, with this, let's directly jump into one question and let's quickly finish it off. So please take the first question. Now, a company needs 31,25,000 rupees for construction of a new plant. The following three plans are feasible. The company may issue 3,12,500 equity shares of 10 rupees per share, or the company may issue 1,56,250 ordinary equity shares at 10 rupees per share and 15,625 debentures of 100 rupees denomination bearing an interest rate of 8%. Or third alternative, the company may issue 156,250 equity shares of 10 and 15,625 preference shares of 100 each bearing a dividend of 8%, right? So basically what they are saying, let me go to this question number 1. So in this first question, what they are saying, overall the company wants how much? 31,25,000, and they are proposing three alternatives. What are the three alternatives? Equity share capital, yes, preference share capital, and your debentures. In all the three cases, what they are suggesting is the amount they need is 31.25 lakhs, correct? Lakhs of crores. It is 31 lakh 25,000, 31.25 lakhs, 31.25 lakhs. In all these three scenarios, overall amount that they are raising is 31.25 lakhs. There is no change in this. But the first alternative says it is entirely raised through the equity channel. That is, the entire 31.25 lakhs comes from equity, zero preference and zero debentures. Next. The second alternative says 1,56,250 shares at the rate of 10 each, or in other words, 1,15,000. So this is going to be 1,56,250, right? So this is going to be 15,62,500. So 15,62,500 rupees should be raised from equity, and then what they are saying, the balance 15,625 debentures with 100 denomination into 100. So the balance 62,500 rupees should be raised by way of what? Should be raised by way of debt mode. So they are saying 8% debt, you raise the remaining amount of 15,62,500, and nothing should be raised from preference. And the third alternative, what they are saying, balance 50-50 from equity and preference. That is 15,62,500 from from equity, 15,62,500 from debt, from preference, and 0 from debt. Are you clear with this? So overall, the company wants to raise how much? 31,25,000. Here, the question is not about how much amount to raise. The question is about how to raise this amount. Are you clear with this? So whether to entirely raise it from the equity channel or equity and debt channel or equity and preference channel, which is the best? That is what they are asking. Are you clear with this? Yes, and here they've said preference is also 8%, right? So preference is also 8%. That's what they have given. Yes. Now look at this. Required. If the company's earnings before interest tax are 62,500, 125,000, 2,50,000, 3,75,000, 6,25,000, what are the earnings per share under each of the three financial plans? Assume a corporate income tax of 40%. Which alternative would you recommend and why? So in this question, they are just asking you to calculate EPS. That is, you should decide which is the best source of finance through what? Through EPS. So you will compute the EPS and you will say you will go for that alternative which gives you the maximum EPS. Are you clear with this? But wait, what they have given 1, 2, 3, 4 and 5 EBIT. If the company's EBIT is 62,500, 1,25,000, 2,50,000, 3,75,000, 6,25,000, what are all these things? Basically, what they are saying is, assume the EBIT is 62,500 rupees. If EBIT is 62,500 rupees, calculate the EPS under each of these three plans. Are you clear with this? Then, if your EBIT is 1,25,000 rupees, then once again you recompute the EPS for these three plans. If your EBIT is 2,50,000, once again recompute the EPS for these three plans. So basically, what you need to do is you need to compute the EPS for each of these three alternatives under 5 scenarios. So they have given 5 different EBITs. Assume EBIT 62,500 for all the 3 cases, then compute the EPS for 3. Now suppose EBIT is 1,25,000, compute the EPS for 3. So you have 5 scenarios and each has 3 alternatives. Overall, you need to compute EPS 15 times. Are you clear with this? Are you clear with this? It's a very, very comprehensive thing, but it's fairly a simple part, but you should understand what this is. See, the EBIT is not changing because of the alternatives. They are giving you multiple situations. This is like they are giving 5 different questions. Are you clear? Fine. If your EBIT is 62,500, compute the EPS for all 3 alternatives. When my EBIT changes to something else, once again recompute the EPS under all the 3 alternatives. Are you clear with this? And overall, you should give your observation, recommend and why. Which one would you recommend and why? Are you clear with this? Now, fairly a simple task. So what we need to do is plan wise we will go. That is, let's say first entirely I'm going 100% equity. I'm going fine. I'm going for 100% equity. So now list down all the 5 alternatives. What are the 5 alternatives that we've got? So 62,500, yes, 1,25,000, 2,50,000, 3,75,000 and 6,25,000. Correct? Now what we are trying to do is alternative wise we are going. Now for this alternative, for alternative 1, what will be the EPS under the 5 different situations mentioned in the question? Similarly, we'll once again do for second. Similarly, once again, we'll do for third. Are you clear with this? That's what we need to do. Now, what is the format of your income statement? Now, I told you, your financing decisions actually impact only, your capital structure decisions impact only after the EBIT, or in other words, your EBIT, till your EBIT, there is no problem. After EBIT only, technically the FM part starts. So EBIT minus interest gives you EBT, minus tax gives you EAT, divided by number of equity shares gives you EPS. Correct or not? In this question, they have asked for EPS. Now, in each of these parameters, this data is given. EBIT. Minus interest. What is the first alternative? Entire source of finance is through equity. So is there any interest? No. So minus 0,0000. Clear? So you get the EBT, right? Now less taxes at the rate of 40% on EBT. These figures also you will get. Clear with this? So EBT minus taxes gives you what? Earnings after tax. Correct? Now, is there a preference dividend in this area? No preference dividend, because in the first alternative, there is no money raised to the preference channel. So this EAT also becomes what? Earnings for equity. Yes or no? Since the preference dividend is 0. Yes, if you want, you can add one more line. Minus preference dividend 0,0000. And then again, you can put earnings for equity, right? Now, divided by number of equity shares. In the first alternative, how many equity shares are there? Now look at the first alternative here. 3,12,500 equity shares, correct? So divided by 3,12,500 equity shares. So you will get EPS for each of the 5 different EBITs. Are you clear with this? So for the 5 alternatives, for each of the 5 alternatives, if I am entirely financing it through my equity channel, what will be the EPS? This is what we have found out in the first situation, correct? Let's not conclude anything. Let's go and see the next one. Let's do the next 2 also, and then finally we will come to a conclusion. Are you clear with this? This is too much of computation driven, not much of it is not challenging your intellect. Okay, so this is basically very simple to do, but when you're doing it in an exam, it takes some time for you to do all these things. You should be careful with the calculations. So generally students make a mistake in calculations in this area. Beyond that, there is nothing great. Now second, debt equity mix. So what is the second part? Debt equity mix. That is 15,62,500 comes from equity, 15,62,500 comes from 8% debt, correct? So now what is the format? What is the format of your income statement? So EBIT minus interest gives you EBT, minus taxes gives you EAT, correct? Now is there a preference dividend here? No. So EAT also is your EFP divided by number of equities give you what? Gives you your EPS, correct or not? Yes. So now each of these 5 EBIT is given in the question. So under the 5 situations we need to compute this, but remember we are doing it for debt plus equity mix minus interest. So how much will be the interest? So 15,62,500 is the debenture amount, debt amount, and 8% is the cost, interest respect to debt. So 15,62,500 into 0.08 gives you 1,25,000, and that's how we've got this figure of 1,25,000 in all the 5 cases. Are you clear with this? So these are 5 different EBITs for the same plan. This is plan number 2. Are you clear with this? So how much is your EBT? So how much is your EBT? So in this case, 62,500 rupees is your EBIT, correct? Minus 1,25,000 is going to be your interest. So EBT will be what? Minus 62,500. Can EBT be negative? Yes, it can be negative. You have made a profit of 62,500 only. So then 1,25,000 is my interest, sir. Where from the company will pay? Maybe previous year's retained earnings you pay, or you once again borrow to pay this. We don't know. But interest needs to be obligated. It is an obligation that needs to be paid, correct? So this makes your EBT negative, correct or not? Now, very, very important. Very, very important. Now, when I have a loss, should I pay any tax? No. Income tax is a percentage on EBT, correct? Sir, when there is a loss, will I pay any income tax? No. Correct? But remember one thing, if you have losses, I can set this off in the future years, correct or not? Or in other words, let's say this company is doing many business. From one particular business, they are making this loss. Can it be set off against the profit made by the same company from another business? Yes. Or in other words, because of this loss, there can be a tax saving, yes or no? Why? Because the losses can be set off against the profits from another business of the same company, or it can be set off in the future years also. Or in other words, because of this loss, there is actually some tax saving for me. There is a benefit for me, correct? This is a pain, correct? I'm incurring a loss, but in that pain, there is a gain for me. Yes, there is actually some tax saved here. Are you clear with this? Understand? So this reduces minus 62,500 plus 25,000 becomes minus 37,500 is your earnings after tax. Are you clear with this? So basically your loss will reduce because of the tax saving component. In this case, taxes will be added. It is not tax paid, it is tax saved. Are you clear with this? And this is where they have written a note here. The company will be able to set off the losses against other profits. Are you clear with this? So this is an income tax concept. Yes, there is something called as Chapter 6 of the Income Tax Act, not the Chapter 6 of whatever material that you follow. No, the income tax itself has many chapters. Law is divided into chapters and sections. So there is Chapter 6 called a set off and carry forward of losses that talks about this. So a loss of a particular entity, a loss of a particular business can be set off against the profit of another business of the same assessee, of the same company, correct? Or maybe if you don't have any other business, this is the only business, you can carry it forward, and in the next year if you are making a profit, you can set off, correct? And only to that extent you need to pay tax. So basically to the extent of this loss, you need not pay taxes, correct? So there is a tax saving because of the loss. So there is a pain, in that there is a gain. Are you clear with this? That's why we are adding it back and making it as. So now our earnings after tax will actually show a lesser loss. Are you clear with this? So this is a better off situation. Are you clear with this? Very, very, very important. Students miss this out. What they do is they blindly do. So this is 62,500. Some students, what they do, they think they are very smart. They put it as 0. No, negative loss only. No, sir. No tax. Some students, what they do, they calculate 40% on 62,500. This also they make it as negative and they increase the loss further. No, no, no. Like that you should not do. This is a tax saving. Are you clear with this? Fine. Similarly, in the other cases, what they have done, EBT is 0. So obviously tax will be 0. So earnings for equity is also 0. Similarly, in all these three cases, here there is a profit. Earnings before tax is a profit. So add. So you need to subtract 40% of that to arrive at your earnings after tax, which is also your AFP, divided by the number of equity shares. So how many equity shares have been issued here? So look at this, 1,56,250 ordinary equity shares have been issued. So earnings for equity divided by equity shares gives you what? EPS, correct? So in the first scenario, you have a negative EPS. How much? Minus 0.24. Can there be a negative EPS? Yes, absolutely there can be a negative EPS. When your earnings for equity is negative, yes, you can have it. Clear? In the second scenario, it's 0. The third scenario, it's 0.48. Fourth scenario, it's 0.96. And the fifth scenario is going to be 1.92. Are you clear with this? Yes. Now, once again, we need to recompute all these things for the third plan, which is what? Equity plus preference mix. What is this equity plus preference mix? This is 15,62,500 from equity, 15,62,500 from preference, and there's going to be 8% preference. Remember that. So now, EBIT. So 5 different scenarios. How do we know these figures? It is given in the question. Correct? Less interest, no amount from debt, 0 only. So directly you get your EBT. From this, you less your taxes, you get what? Your EAT. Correct? From that, you less your preference dividend. Preference dividend, how much is it? So it is going to be 8% on 15,62,500. That is going to be 1,25,000. You reduce it, you get how much? You get your profit after tax, that is earnings after tax, or it is also known as earnings per equity shareholders. So you get minus 87,500, minus 50,000, 25,000, 1 lakh, and 2,50,000. Divide this by number of equity shares. So how much is the number of equity shares with the third alternative? Third alternative has how many equity shares? So 1,56,250 equity shares. So divided by 1,56,000, respective EFE, earnings for equity, divided by 1,56,250, you get the EPS for each of these alternatives, which is 0.56, 0.32, 1.16, 0.64, and 1.6. Are you clear with this? Are you clear with this? Yes. So now what we have done? So for each plan, for 5 different alternatives, we have calculated 5 different scenarios. We have calculated the EPS. Now, let us come to a conclusion. What are they saying? The choice of financing will depend on the state of economic affairs. I'm telling you, this is an open-ended area. Don't say this is the best or this is not good. This is very good. No. Depending on the perspective, things will differ. If the company's sales are increasing, EPS will be maximum under the second plan debt equity mix. You look at this. If I have maximum sales, that is more the sales, more will be your EBIT, correct? So now tell me, in this case, what happens? Your first alternative has an EPS of 1.2. Second alternative has a whopping 1.92. The third alternative has only 1.6. So of the lot, which is better? If I have more sales, then I would go for the second alternative, that is debt and equity mix. And why is this alternative showing more EPS? Because I have debt plus equity, correct? Because of debt, there is some tax saving. Leverage effect is happening. Can you connect the two? Are you clear with this? So now leverage is working in my favor, and that is the reason as my sales increases, the magnifying effect is more, and so I am going for my EPS, the earnings per share of the equity shareholders are more in this case. Are you clear with this? Look at this. So under favorable economic conditions means what? You have more sales. So debt financing gives more benefit due to the tax shield or tax saving availability than the equity or preference financing. Also, its EPS is increasing at a rate higher as compared to the other plans. Are you clear with this? So here, look at the rate at which it's increasing. Negative, slowly it's increasing from 0.16, 0.64, 1.6. If you look at the first one, 0.12, slowly 0.24, then 0.48, 0.72, and then 1.2. But if you look at this, yes, the first part is negative, but from here on, look at the rate at which it increases. From till this, it is almost the same with the first plan. Look at this. From here onwards, the first plan gives 0.72. This gives 0.96. From that, this jumps to 1.2. Here it jumps to 1.92. So what they are saying, if the economic conditions are favorable, as you are getting more sales, it is better to. It looks better that the plan number 2 is better. Why? The reason is that your EPS is increasing. And why is the EPS increasing? Because of the leverage effect that happens because of tax savings. Are you clear with this? Yes. So this is the conclusion that you can give. Open-ended conclusion. Don't say this is always the best. Fine. For a favorable economic condition, yes, looks like this is what is the best. Are you clear with this? You just leave it there. Fine, guys. Are you all clear with this? Yes. So now that's about this particular question. Calculation of EPS for 3 plans. Under that, 5 different EBITs were given, and we did that. Are you clear with this? So with this part of the easier part of this chapter is actually over. We have revised the easier part of this chapter. Now let's move into the next part, which is the capital structure theories. Now let's go to the second part of this chapter, where things get little tricky. Now, capital structure theories. Now, in this segment, we will find out the optimum capital structure. Optimum means what? Best alternative of capital structure. Capital structure is source of finance. Which alternative is best? Now, we will find out the best capital structure under the multiple methods or theories of capital structure. That is, we will not look at it from EPS perspective, MPS perspective, return on equity. No, we will look at it from the perspective of 4 different people who have given their own ideas, their own viewpoints. So strictly, these 4 theories, capital structure theories that we are going to study, are proposed by 4 different people with their different perspectives. So now, please don't extend your logic here. We are just going to study what these 4 people have said. That's all we are going to study. And that is what the segment says. Sir, of these 4 methods or theories of capital structure, which is the best? Nothing of that sort. These are just 4 different perspectives that people have given. 4 different people have given. Now, you cannot say one is superior, the other one is inferior, because each of them make their own logic. In fact, all these things will have their own flaws also. They have the downside also. So please, again, don't compare and say, so there are 4 methods that we are going to see here. Net income, net operating income, traditional approach, Modigliani-Miller approach. Of these 4, which is the best method, sir? No, nothing of that sort. Net income approach, it says, these are the assumptions that I am making. And based on these assumptions, I am saying, this is what will happen. Are you clear with this? And based on this, you can decide. Whereas net operating income says, I am putting some more assumptions, different assumptions. And for my assumptions, I am saying this is the way to choose the best capital structure. So these are completely different. Can you say which is better, monkey or donkey? No, you cannot compare. You can say monkey A or monkey B is better. Yes, you can compare. How can you say whether you like monkey, whether monkey is good or donkey is good, or which is better? These are not at all comparable. Similarly, these 4 are different theories given by 4 different people. They have said, we have listed some assumptions, and for our assumptions, we are saying, we have done some analysis, some research, and we are giving our hypothesis. We are saying that this is what we have found out in our research. Basically, we are studying 4 different researches. Are you clear with this? Sir, out of this, which is better? There is no comparison here. Clear with this? Students tend to compare. Please don't compare it. So now, sir, why are we studying this? Honestly, we are studying this because it's a part of your syllabus. That's about it. Because there are multiple ways to gauge it. I just told you how to choose the best capital structure from the perspective of return on equity, or from the perspective of EPS, or from the perspective of MPS. You can do it anyways. It's an open-ended area. Now we are studying what these 4 different theories are stated by 4 different people. We are just studying what these guys have researched. As simple as that. So please don't bring your logic into this. We are just seeing whatever is the logic they have given for the assumption that they have given, and whatever is the findings that they have made. That's all we are going to see. Are you clear with this? Students generally make a mistake here. They think, sir, this doesn't seem logical. Fine, it is not logical, but that man says that. You just need to study it. That's about it. Are you clear with this? Are you clear with this? So don't extend your logic. We are just going to see what these 4 people have said in their own researches. Are you clear with this? And that is called as theory, their research, their perspective, their viewpoint. So these are some alternative words. Don't think it's theory means writing something in words. No, that is not theory. Are you clear with this? Yes. Now, there are certain things in common. There are certain things in common that all these 4 methods say. Optimum capital structure must have the following features. So first, let us see all the commonalities in this area, and then we will enter into one by one. Now, what they are saying is the optimum capital structure, that is the best capital structure, must have the following features. Number one, the value of the firm. Firm means what? Company. The value of the company should be maximum. And the cost of capital should be minimum. This is something that all these people are saying. What they are saying, the best capital structure is the one that has the maximum value and minimum cost. Value of firm is popularly known as VF, correct? And cost of capital is known as KO. We have seen it in a previous chapter, correct or not? Yes. So they are saying the best alternative course of source of finance is the one that gives you the highest value of firm and gives you the least cost of capital. Are you clear with this? Yes. Now, for the purpose of this 4 capital structure theories that we are going to study, now there are a few assumptions. Now we are going to study. Now, don't question these assumptions, please. Please don't question these assumptions. These are the assumptions based on which they have done the research. That's all. Sir, why they have assumed like this, I don't know. We should only dig their grave and ask these people, because these guys are like, they are no more. Fine. They are like elderly people. So they have done this so many years back. So we cannot do anything about it. For the assumptions, they have given their research. What we are doing, we are studying. Why we are doing it? Because it's a part of our syllabus. As simple as that. As simple as that. So we can just learn their line of thinking. That's about it. That's about it. Don't extend the logic. What they are saying. In this segment, for the purpose of capital structure theories, there is no preference share capital. There are only 2 sources of finance, which is equity and debt. Please don't ask me why, sir. Just now we read preference shares is there. These guys are assuming like that, okay? They have done their research based on the assumption that there are only 2 sources of finance, which is equity and debt. Number 2, tax rate is assumed to be 0 unless otherwise mentioned. Clear? Only in one place we will see a tax rate, which is actually this approach with the tax. Only there we will be seeing a tax. In all other approaches, we will be seeing tax. There's not at all there. Now you tell me, in today's world, is there any country without a tax? Yes, there could be very few countries, like these are tax havens, but for that, generally a country has to run predominantly based on the revenue that is generated from a government needs to run based on the revenue generated from the tax. So might not be relevant in today's sense. Sir, then why they are saying it? As I told you, these are the assumptions that these people have taken. Maybe when they were doing the research, taxes were not there. Maybe it could have been. So that is why they have done it like this. Then KD will always be less than KE. KD will always be less than KE. Why? The cost of debt will be less than cost of equity. Why? Because of tax saving. Correct? So they are saying in all the cases, debt is a cheaper source of finance. Are you clear with this? All the 4 people are agreeing to this. All the 4 people, that is all the 4 theories are agreeing to this. Then there is no concept of retained earnings. That is, whatever the company earns, it will pay to the shareholders as dividend. There is a 100% dividend payout. That is, DPS is equal to EPS. Dividend per share is equal to earnings per share. And then the life of the company is perpetual. Are you clear with this? These are the basic assumptions. So broadly, what are the assumptions? Main assumptions: no preference source of finance. Yes, tax rate is 0, and always remember KD is less than KE. That is, the cost of debt is cheaper than the cost of equity. Always. Are you clear with this? Yes. Now, the general formulas that we will be using in this particular segment, capital structure theories. Value of the firm, VF is the short form, is equal to value of equity plus value of debt. Are you clear with this? Why, sir? The value of the firm basically is nothing but the overall value pertaining to all the sources of finance. And in this segment, I told you there are only 2 sources of finance, equity and debt. So it is not just the value of equity, you should also consider the value of debt. So value of the firm, VF, is equal to VE plus VD. Does it make sense? Should you mug up anything? Absolutely not. Are you clear with this? Yes. The second part. Value of equity per share is equal to EPS divided by KE. So what is this? Time value of money concept. EPS is what? Annual cash flow. Annual cash flow divided by discount rate. For equity, what is the discount rate? KE. Annual cash flow divided by discount rate. And just now we saw there is no retained earnings. So whatever they earn, they will be giving it to the shareholders. So basically every year they will get what? The EPS itself will be the DPS, dividend per share. Correct? So annual cash flow divided by the discount rate KE, EPS divided by KE will give you the value of equity per share. Does it make sense? Yes. Should you mug up anything? Absolutely not. Logic. This is pure logic. Correct? Then value of debt, what they are saying, same logic from the perspective of debentures, from the perspective of debt holders. Let's say you have invested in debentures in this company. Now annual cash flow that you will receive is what? The interest amount, correct, divided by the discount rate. For debentures, what is the relevant discount rate? It is called as KD. So the value of debt, can I say, is nothing but the total interest divided by KD. Are you clear with this? Time value of money concept, annual cash flow divided by discount rate. Guys, are you clear with this? So what is the value of equity per share? EPS divided by KE. Or if you can say the total value of equity will be what? Earnings for equity divided by KE. Like that also you can say. Or EPS divided by KE, you will get the price per share. You multiply this with number of shares, you will get the value of equity. Or if you want to do it in total directly, earnings for equity, this is the amount pertaining to equity shareholders, divided by what? Divided by KE, you get the entire value of equity. Are you clear with this? If you want to use this formula per share, you can use it. If you want to get the total value of equity, you can directly use this formula. Are you clear with this? Yes. Now, interesting part, the fourth one they are saying, EBIT, value of the firm is equal to EBIT divided by KO. Same logic. Annual cash flow divided by the discount rate. Sir, what are you saying? EBIT, correct? EBIT minus interest gives you what? EBT, correct? In this segment, there is no taxes and all. Fine. So minus whatever is there. So let's say tax is also there. In this case, it's 0. Gives you what? EAT. Correct. So minus no preference dividend here. So minus what? Minus your equity dividend. You will be left with what? You will be left with this. You will be left with what? Your retained earnings. So in this case, basically the interest and the equity dividend are paid out of what? Out of EBIT, correct? Or in other words, in this case, whatever interest I pay and the balance I have, the entire amount is retained. The entire amount is being paid to the shareholders. Nothing is getting retained. Or in other words, EBIT is fully being paid to whom? To the debt holders as well as to the equity shareholders, correct? Or in other words, EBIT is the amount available to whom? To both the sources of finance. So what is the cost of both the sources of finance? KO, that is cost of equity plus cost of debt. If you weighted average based on their weights, you will get it as KO. Or in other words, in this case for EBIT, the relevant discount rate is going to be KO. Does it make sense? Are you clear with this, guys? Yes? Fine. So now annual cash flow divided by discount rate, here you get what? EBIT divided by KO. You get the value of the firm directly. Are you clear with this? Now what is KO formula? We've already seen it, no? Cost of equity into weight of equity plus cost of debt into weight of debt. Yes or no? We have already seen this formula. Sir, no KP and all, because in this segment, we told that there is no preference shares. So there is no question of preference. Are you clear with this? So the overall cost of capital, KO, is nothing but KE, cost of equity into weight of equity plus cost of debt into weight of debt. Are you clear with this? Yes. Now let me just take a small example in calculating this. With this, we will enter into this area and see how interesting it is. Guys, you need not mug up even a single thing. You just understand this concept. It will be so beautiful. It will be so beautiful, and you will thank yourself for a lifetime for understanding this concept. Clear? Just spend little time in this marathon itself. You will get crystal clear clarity in all the 4 capital structure theories. Fine, I can guarantee for that. Now, let's get started. Now, let me just give you an example. Example 1. Let us say KE is equal to 10%, right? Then KD is equal to 5%. Then let us say equity capital is equal to 1 lakh rupees. So 1 lakh rupees is raised from equity, and from debentures, from debt, rupees 50,000 has been raised. Correct? 50,000 has been raised. Now, what will be my KO? We need to calculate KO. Now, can we calculate this? Yes, definitely. It's very easy to calculate. What is it? So, KO is equal to KE into weight of equity plus KD into weight of debt. Correct? So, in this case, what is KE? 10%. into weight of equity. How much is this? So 1 lakh plus 50,000. 1 lakh 50,000 is the total amount raised. Out of this, 1 lakh is coming from equity, correct? So can I say this is nothing but 1 lakh divided by 1 lakh 50,000? Yes, this is the weight of equity plus for debt, what will it be? KD is 5% into what is the weight of debt? Weight of debt is going to be 50,000 divided by 1 lakh 50,000. Correct, guys? Yes, fine. So, or in other words, so you can just do the calculation. You get how much? You get 8.33% as your overall cost of capital. Are you clear with this? You get 8.33% as your overall cost of capital. Now, why did I show this? Why did I do this and show it to you? Not to tell you how this calculation, how to do this calculation, all that you know it better than me. Now, the reason why I told this is to make a small observation. Now, you tell me, in this question, what was my KE, cost of equity, 10%? What was my KD, 5%? Correct? So, cost of equity is 10%. Cost of debt is 5%. Correct, guys? Yes. Now, what is my overall cost of capital? KO. Now, KO, you tell me, will it be greater than 10%? Will it be less than 10%? Or what will it be? Generally, what students think is KO means what? Overall cost. So, overall cost should be more only. So, it will be more than 10%. No, guys. No, it is not like that. Simple mathematics. Look, 1 lakh rupees, I am raising it by 1 lakh. To the extent of 1 lakh rupees, the cost is 10%. To the extent of 50,000 rupees, the cost is 5%. Now, for this entire 1 lakh 50,000, you tell me what will be the cost. I am averaging out. It will definitely be less than 10%. Are you clear with this? Why, sir? Because 1 lakh, for 1 lakh, I am paying 10%. For the remaining 50,000, I am paying only 5%. So overall, 1 lakh 50,000, it averages out. It becomes less than 10%, but more than 5%. It lies somewhere in between. Are you clear with this? And that is where we are saying the cost of capital in this case is how much? 8.33. Or in other words, you can say that KE, KD, and KO. Now, in this case, what is my KD? 5%. What is my KO? 10%, right? And always remember, KO lies somewhere between this KD and KE. It cannot go beyond KE. It cannot go below KD. Why? Because what do you mean by overall KO? Overall cost of capital. There is a cost pertaining to 1 lakh 50,000. Correct? To the extent of 1 lakh only, I am paying 10%. Correct? Yes. So now for the remaining 50,000, I'm paying only 5%. Correct? So for the entire 1 lakh 50,000, it averages out. Correct? Now it cannot be greater than 10%. Why? Because for 1 lakh only, I'm paying 10%. After that, I'm paying in fact lesser than that. So it cannot exceed 10%. Correct? Can it go below 5%? No. For 50,000 only I'm paying 5%. In fact, for the remaining 1 lakh, I'm paying 10%. So it has to be more than 5% only. Are you clear with this? Or in other words, always remember this. KO lies somewhere between KE and KD. Are you clear with this? Remember this rule. Remember this as a thumb rule. Some students mug it up. Please don't mug it up. It's a trap. You don't mug it up. You just learn it by concept. Are you clear with this? Why? Simple mathematics. Law of averages. You take a weighted average, you see it for yourself. Obviously, it will be there. One source of finance is from a costly source. Another source of finance is a cheaper source. Overall finance is going to be average of the two. And average of the two can only lie in between the two. It cannot exceed or it cannot go below the other. Are you clear with the simple mathematics, guys? And this is logic, common sense. Clear? So now look at this. So can I come to a conclusion? Saying that KE, KD, KO. So can I say that KO is always greater than or equal to KD, but it is always less than or equal to KE? Yes or no? So can I say KO lies between KE and KD? It can never be more than KE. It can never be less than KD. Are you clear with this? Yes. And we already saw that KE is always greater than KD. Why? Because of its tax saving effect and all of that. We've seen it. And of course, in fact, KE means what? Cost pertaining to equity shareholders. You tell me, equity shareholders are risk takers. correct? So more the risk, they will expect a more return. They will expect more return, correct? So obviously KE will always be equal to KD. The question here is, where do we plug KO? So remember, KO lies somewhere in between this. It cannot go beyond KD. Sorry, it cannot go beyond KE. It cannot go below KD also. So your KO cannot go beyond your KE. It cannot go below your KD. It can lie somewhere in between this range. Are you clear with this? Yes. Now, let me give one more example. And with this, let us learn one more conclusion. Look, I'm actually giving you a right introduction into this area. Once you learn all these things, you will never forget it for a lifetime. You cannot miss this area at all. Are you clear? So this is in fact a core area. Whatever chapters that we've been doing, every attempt, more or less every attempt, your leverages, cost of capital and capital structure theories, these three chapters in an investment decision, more or less every attempt, it comes for 10 marks each chapter. So that makes it 40. Are you clear with this? So FM is not even a full 100-mark paper, correct? It's only half, correct? So 50 marks for new syllabus from May 2024 onwards. For the existing syllabus, November 2023, it is only for 60 marks. So out of this itself, 40 marks come from these 4 chapters. Predominantly, it's done. So this is a never miss. This is a never miss. So please have this in your mind. Now, let me just give you an example too. Let me just give you the example too. So what is this example to? Everything is the same. That is, KE is 10%, KD is 5%. So what is happening? KE is equal to 10%, no change. KD is equal to 5%, no change. But there is only one change here. Equity debt, I am changing this. So equity, I am saying, is 30,000 rupees. Now debt is going to be how much? 1,20,000 rupees. Equity is 30,000 rupees and debt is going to be 1,20,000 rupees. Clear or not? Now you tell me, what is the total amount raised? 1,50,000. Now, has this amount changed? No. In the previous example also, the overall amount raised was 1,50,000. KE standalone was 10%. KD was 5%. Are you clear with this? Now, what has changed here? The mix, capital structure has changed. The proportion of debt and equity has changed. Or in other words, the weight of equity and the weight of debt alone has changed. Now, you tell me, what is the formula to calculate the overall cost of capital? KE into weight of equity plus KD into weight of debt. Correct? Guys, logically think, please don't mug it up. Logically, you think about this. Now what is KE? KE is going to be 10% into weight of debt. It's going to be 30,000 divided by 150,000. Correct? So 30,000 divided by 150,000. I'm just writing this in short form. Okay. So let me just, 1 second. I'll erase this K, so don't get confused here. So this is just 30 by 150. This is nothing but 30,000 by 150,000 plus debt is going to be 5% into what? Into 120,000 divided by 150,000. Correct, guys? Yes, are you clear with this? Yes. So now if you do this, you do the calculation, you will get KO is equal to 6%. KO is equal to 6%. Now, what can you conclude with this? Guys, this is a very, very important observation, which is the base for us to enter into the capital structure theories. So I'm just giving you a launching pad for entering into this area. Fine. In fact, this segment alone, I'm doing it as if you have not learned it at all. In your lifetime, first time you are learning this. From this marathon also, you can learn it. Clear with this. So now, look at this. What you can see. What was initially my KO? So initially in the first case, KO was how much? 8.33%. Correct? 8.33%. Now what happened? Look at this. In the first question, KE was how much? 10%. KD was how much? 5%. Now, how much amount was raised from equity? How much amount was raised from debt? So from equity, we had raised how much? 1 lakh rupees. From debt, we had raised 50,000 rupees. Correct? So 1 lakh rupees from equity and from debt, we had raised 50,000 rupees. And the overall cost of capital came to how much? Sorry, this is KO, right? KO came to how much? The KO came to 8.33%. Yes, it came to 8.33%, right? Now, carefully listen. In the second example, what we did, KE did not change. KD did not change. Now, equity and debt alone I changed. I made this as 30 and 120, correct? So what happened here? Here 30,000 was raised from equity, but 1,20,000 was raised from debt. Now when this happened, my KO became how much? 6%. Now, what is the conclusion that you can draw? Now, why has my KO dropped from 8.33% to just 6%? Why it has dropped? Now, logically you think and tell me. Now, in the first alternative, so now we know that equity is a costlier source of finance, debt is a cheap source of finance, correct or not? Yes. Now, in the first alternative, I have raised more money, 1 lakh rupees from a costly source of finance, and only 50,000 rupees I have raised from a cheaper source of finance. Now, what happened here? I changed the mix. Overall, I got the same 1,50,000, but what I did this time, I raised more money from a cheaper source of finance and lesser money from a costlier source of finance. Because of this, in the average, when I did an average, overall cost of capital dropped from 8.33 to 6%. Why it dropped? Because in the second alternative, I have raised more money from a cheaper source of finance. Or in other words, in this case, what happened? Can we say that the weight of debt has increased? That is, if you infuse more debt, debt is what? Cheaper source of finance. If you infuse more debt, it will result in a reduction in your KO. Yes or no? Yes or no? So can we come to a conclusion that more the weight of debt, WD means what? Proportion of debt in the capital structure. More the proportion of debt in your capital structure will result in lesser cost of capital. Lesser cost of capital, that is nothing but KO. Can we come to this conclusion or not? Earlier, it was what? The average cost of capital. So now it was what? 8.33%. It was somewhere here. Now it has become 6% only. Why? Because now out of the total capital, I'm infusing more debt and lesser of equity. So more the debt percentage in the capital, obviously lesser will be your overall cost of capital, because overall cost of capital is nothing but a simple average. It is nothing but an average of your weights with your respective cost. Are you clear with this? Yes, are you all clear with this? And remember, at no point of time KO can be more than KE. It cannot be less than KD also. It has to be somewhere in between. But this we can range it. How we can range it? If you infuse more debt, your KO will fall down. Are you clear with this? Yes. So this is the overall conclusion that we can come up with. So more the proportion of debt in your capital structure, lesser will be the cost of capital. Are you clear with this? Are you clear with this? If you are clear with this, then we will move to the next illustration, where I will just connect all these things, and then we will enter into the 4 capital structure theories. We can do it very, very easily. Clear? So the next one that I want to do. Now this is example number 3 that I'm going to do. Now, let us say EBIT is, let us say 1 lakh rupees is 1 lakh rupees, and let us say KO is equal to 10%. Let's say KO is equal to 10%. Now, we need to calculate what? The value of the firm. The value of the firm, right? We need to calculate the value of the firm. So can you calculate the value of firm? Yes. So what is the value of the firm? Can we say value of firm is nothing but EBIT divided by KO. We just saw this formula, correct? EBIT is the earnings available to whom? Debt as well as the equity shareholders, correct? So the discount rate should be what? The average cost of capital, that is nothing but your KO. Yes or no? Annual cash flow divided by discount rate. Just now we saw the logic. Yes, guys, are you clear with this? This formula, value of firm, correct? So can I say this is nothing but 1 lakh divided by 10%. So what is the value of the firm? The value of the firm will be rupees 10 lakhs. Yes. Yes, guys, are you clear with this? Now, let me take one more example. Example number 4. Let's say the EBIT remains the same, 100,000, right? But now the KO changes to, let us say, 5%. The KO drops. Now calculate what the value of the firm. So now value of the firm is nothing but EBIT divided by KO, correct? Or this is nothing but 1 lakh divided by 5%. That gives you value of the firm as how much? 5 lakh rupees. Are you clear with this? So what is the conclusion that you can draw here? If your cost of capital is less, automatically the value of firm will be more. Can you accept this or not? Mathematically, if your denominator reduces, obviously the value increases. Yes, guys. Yes, let us say you have a piece of cake. You have a piece of cake, and now let us say you're the only person who is having it. Yes, now you will get the entire cake for yourself. Suppose there is one more person with whom you need to share, it becomes, your share becomes half or 0.5 only, correct? Or in other words, more the denominator, lesser will be the answer, or lesser the denominator, more will be the value, the answer. Are you clear with this? So if your KO reduces, your overall value of the firm increases. Are you clear with this simple mathematics? Simple mathematics. So can we arrive at this conclusion? If I infuse more debt into my capital structure, that is the weight of debt, that is, if I infuse more debt into my capital structure, what will happen? So more the debt in your capital structure, it will result in a lesser KO, correct? KO means what? Average cost of capital, weighted average cost of capital. Are you clear with this? And when your KO reduces, what happens? Your value of the firm increases. Are you clear with this? And what we saw here is, what are the good characteristic features of an optimum capital structure? In an optimum capital structure, the value of the firm should be maximum and the cost of capital can be minimum. Or in other words, your value of firm can be maximum only when your KO, the cost of capital, is minimum. Are you clear with this? These two are interlinked. And how can I make my cost of capital, overall cost of capital, minimum? By infusing more debt. Why, sir? Because debt is a cheaper source of finance. Are you clear with this conclusion? And if you are clear with this conclusion, now it is the right time to enter into the capital structure theories and see what each of these scholars, what each of these people have said. What are their assumptions? For their assumptions, what they have said is what we are going to study here. Guys, are you clear with this? A very, very important way to get introduced into the capital structure theories. Now, there are 4 theories: net income approach, net operating income approach, traditional approach, and approach. Approach we have without tax and with tax. Okay, let us see one by one. First, I will teach you all the concepts, and then we will be doing a few problems, and we are done with it. Clear? So now net income approach. Now, what is this net income approach? So this approach was given in the year 1952 by David Durant. If you want, you can remember the name. Fine. Then, according to this approach, capital structure decision is relevant to the value of firm. Sir, what is the meaning of this? They are saying, so capital structure, because of your capital structure is basically what? Debt equity mix, the proportion of debt equity, that is all equity or all debt, or 50-50, 30-70, 20-80, or 80-20, anything. This mix, the proportion, the source of finance will actually impact your value. That is what? Value of the firm. That is what this approach says. So that anyways we know, no sir, wait, because there are certain methods which says that your capital structure decisions will never impact the value of firm. So how is that possible? That is their assumption. We will go to that later. So that's why it is very clearly mentioned that the capital structure decision is relevant to the value of the firm. In other words, your source of finance will impact the value. Who says this? The first method, called as NI, net income approach. This theory suggests that the value of the firm can be increased by decreasing the KO, and KO can be decreased through a higher proportion of debt in the capital structure. We just saw it right now, correct? So you want to increase your value of firm? Yes. What you need to do? Reduce your overall cost of capital. So how do I reduce my overall cost of capital? Infuse more debt. Are you clear with this? That is what they are saying. So under NI approach, KE is always greater than KD. This we know. And KE and KD remain constant. Meaning what? Whether you raise, in this example we saw, whether I raised 50,000 rupees from debt or I raised 1,20,000 rupees per debt, the KD did not change, correct? So whether you want to raise 1 rupee or 1 crore rupee, in this assumption says, in this particular theory, they are saying that KD will not at all change. KD will remain the same percentage. So because you are taking more amount, I will not charge more interest percentage. As a percentage, interest your KD will remain the same. Are you clear? Similarly, KE will also not change. Here we are raising only 1 lakh rupees from equity. Here we are raising 30,000 only. Here we are raising 1 lakh rupees. Here we are raising 30,000 rupees only from equity. So now, because of the amount that you are raising from the source of finance, these individual costs will not change. That is the assumption they are saying. Are you clear with this? Why is that? That is the assumption that they are making. Clear? So because of your amount that you are raising from the different particular source of finance, its cost will not change. Are you clear? Its respective cost as a percentage will not change. Are you clear with this? Yes. Now, what they are saying is, therefore, higher the weight of debt, more debt, lower will be the KO, and more the KO, what will happen? Sorry, more the debt, more the weight of debt, what will happen? Higher the weight of debt. This will result in lower KO, and lower KO results in higher value of firm. Are you clear with this? This is the one-line summary of this particular theory, and they have given the graph like this. What is the graph that they are given? Wait, I will draw and show you. I will draw and show you. You will have crystal clear clarity here. Very simple, guys. So whatever we have seen, they have given a name called as what? Net income approach. So whatever we have learned logically, that logic is given by a name called as net income approach. Are you clear with this? And this was founded by a guy called David Durant. Now, look at this. So this is what? The first one, that is net income approach. Net income approach. Now, always remember, in a graph, you will be having x-axis and y-axis. Yes, obviously you guys know that. Yes, so now on the y-axis you have cost as a percentage, right? And on the x-axis, you have the weight of debt. You have the weight of debt, that is the proportion of debt in the capital structure. Are you clear with this? Yes. Now what they are saying is, first, in this method, what they are saying, always KE will be constant, correct? KE will be constant. This is what they are saying. So KE will be constant, correct? KD will also be constant, correct? So because I am infusing more debt, let us say this is 0% debt, that is no debt, all equity. Let's say this is 50% of the overall amount is being raised through the debt channel. Let's say 100% is coming from debt. Just an example. Okay. Now, what they are saying is, because I am starting to borrow more money from the debt channel, it will not impact my KE, it will not impact my KD. The respective cost will remain the same. Correct? That is what this is saying. But what happens to KO? Come on, tell me what happens to KO. They are saying, as you infuse more debt into your capital structure, your KO will start falling. Are you clear with this? And KO, if there is zero debt, means what? The entire source of finance is only equity, correct? If you are entirely raising the money through equity, then at this point, KO is equal to KE, correct or not? Why? Because entirely it is funded through KE. KE is the only source of finance. Are you clear with this? Yes. Or if everything is raised through debt, then overall cost of capital is equal to KD, correct? Yes. Why? Because the debt is the only source of finance. Are you clear with this? Yes. So now, as I keep increasing my proportion of debt in my capital structure, my weighted average cost of capital keeps falling, and that is what this method says, and this is the graph that they have given. Are you clear with this, guys? This is very simple to understand, and please don't mug it up. Please don't mug it up. You should know what is there in the x-axis and y-axis. These two things you should know, and then you should also look at the assumptions, and with this you are done. So the day before your exam, you give one look at this particular graph, you will get an entire understanding of whatever discussion that we have made in net income approach. That should be the power of conceptual learning. Are you clear with this? You do this and you're done with this. That's all. Any kind of sum, let them do. We can actually handle it. That should be the level of confidence you should have. Clear with this? So basically this method says what? Now your KE and KD remains constant, and KE is always greater than KD. That's why KE is above, KD is less. As you increase more component of debt into your capital structure, that is, as you infuse more debt as a percentage, if you infuse more debt into your capital, your overall cost of capital will reduce. Why and all we saw, because now you are raising more money from a cheaper source of finance. And always remember, KO lies between KE and KD. Correct? It cannot go beyond KD. It cannot go beyond KE. It cannot go below KD. So it can be. That is the reason why I said it. That is the reason. You recall this. I said this particular conclusion I made. Look at this. This particular conclusion that I made. Fine. So this conclusion. So KO. So look at this. KO can be between KE and KD. That is, KO always is more than or equal to KD, but it is less than or equal to KE. Are you clear with this? So when will KO be equal to KD? When entirely I'm raising all the funds to the debt channel. Correct? When KO will be equal to KE, when entirely you are raising it from the equity channel. Are you clear with this? And if there is a mix of equity and debt, it will lie somewhere in between. And that is what we are seeing here. Are you clear with this in this particular graph? Guys, as simple as that. What is the point to mug it up? Please don't mug up. In exam, even if they are asking you for a graph, a rough graph they are asking, you can do it. In no time you can do it. That should be your level of understanding in this particular area. Clear with this, guys? Yes. So leverage. They have mentioned leverage here, sir. Leverage means what? I told you. Leverage means what? So leverage happens, the magnifying effect, it happens because of what? The presence of fixed financial cost. When will you have the fixed financial cost? Because of debt only. Yes or no? Yes. So basically leverage means in this case, it is nothing but the proportion of debt in the capital structure. That is the indirect meaning. So you don't think exactly like a bookish definition. You don't say that, sir, leverage chapter, they are putting it here, not leverage. Think about it. They are talking about the proportion of debt here. Clear with this? Yes. So this is why they have mentioned it like this. Sir, now don't ask me exactly it will go like this or will it be a curve. You can do it like a curve also. It is not a problem. Exactly, it will not go. It is not a linear relationship. It can go in any which ways. Are you clear with this? So there is nothing of exactly it should be like this. It depends on the respective weights and the respective costs. So it can differ from the facts given in the question. Are you clear with this? So now let's go to the next approach, which is called as the NOI approach, net operating income approach, NOI. Now, what in this approach, what are they saying? Now, they are saying completely the opposite of net income approach. So net income approach was more logical. So we saw that as you increase the proportion of debt in your capital structure, so what happens to your KO reduces and automatically your value of firm increases. This is basically logical. Now, what net operating income approach is saying? This approach is exactly the opposite of NI approach. As per this approach, the capital structure decisions are irrelevant. Now, irrelevant. How is it irrelevant? They are saying your debt equity, right? Your total capital, right? Your debt and equity, the capital structure, the proportion of debt and equity and all will never impact the value of the firm. This is what they are saying. But there we saw, if you increase more of debt, what will happen? If you infuse more debt, your KO will reduce and the value of firm will increase. Here they are saying, no, it will not impact the value of firm. And they are saying, as per this approach, the value of the firm and KO will always remain constant. They are saying, because of your capital structure, you cannot increase the value of firm or you cannot reduce the KO. It will always be the same. Are you clear with this? The value of firm cannot be increased or decreased by changing the proportion of debt in the capital structure. Sir, how is this possible, sir? See, this is a particular approach. That is, a person has found this particular approach for his assumptions. For the assumptions made by that person, he is stating this is how it is. I will explain whatever it is saying. Are you clear with this? So in exam, how do you approach it? They will give you some data and they will ask you to calculate the value of the firm, or they will ask you to calculate something based on NOI approach. So they will give you. So once you give the approach, once they give you the approach, you will know what are the assumptions in it. So in short, what does this approach say? This approach is saying KE is always greater than KD, that we have seen. Cost of equity is more than debt. Why? Because equity shareholders are risk takers. More the risk, more the return they will expect. Correct. So KE is more than KD. Now look at this. KD will remain constant. Meaning what? See, just because I am raising more funds from my debt channel, it will not change my KD. So KD will be the same constant percentage. Whatever is the KD, whether I raise 1 rupee or 50 lakh rupees or 50 million rupees, KD will remain the same. That is the underlying assumption they are saying. Now they are saying, look at this here, KO will also remain the same. They are saying KO will also not change. They are saying if I increase the proportion of debt in my capital structure, he's saying it will not impact the KO. But look at this. KE will increase with increase in debt. But he's saying KE alone will increase as you increase the proportion of debt in your capital structure. Or in other words, if you infuse more debt in your capital structure, KE will increase. Sir, why KE will increase? Now, what the logic that this approach, NY approach says is, now, if you increase more debt, if you infuse more debt in the capital structure, what happens? You need to pay more interest, correct? Interest is what? A fixed financial cost. So, more the fixed financial cost, what will happen? It is actually more risky for the company. Yes or no? Yes, leverage effect is there, no doubt. But I told you it's a double-edged sword, correct? It can also go against your favor. So it is more risk, more the risk. Now the shareholders will start expecting more returns, and hence KE will also increase. That is what is the assumption that NY is saying. So NY is saying more the proportion of debt, KD will not change, KO will not change, but KE alone will change. Why? Because more the debt, more the risk, more the risk, more the return. That is the expectation of the equity shareholders. So KE will also increase. This is the underlying logic that NOI approach says. Are you clear with this? Sir, okay, sir, we understood. As your debt increases, as your proportion of debt increases, said KD remains constant, fine. KE changes, that is also fine. But sir, how can you say that KO will remain as a flat line? How does KO not change? When KE is changing, obviously the mix proportion is changing, no? So KO should also change. Now let me give you an example. And this is the example under NOI approach. Let me just give you an example under NOI approach. Now what is this example? So example number 1. Let us say KE is equal to 10%. KD is equal to 5%. Then weight of equity is equal to 0.666666. Then weight of debt is equal to, let's say, 0.333333, right? Now, let's calculate the cost of capital. So what is going to be the cost of capital here? KO is going to be, so what is this going to be? So it's going to be 10% into 0.666666, correct? 10% into 0.666666 plus KD 5% into 0.333333. So you can do the calculation. It will come to how much? 8.33%. Are you clear with this? Yes. Now, what NOI approach says is, example number 2, KE becomes 21.65%. KD will not change under NOI approach, 5%. Weight of equity is how much? Right now it is reduced 0.20, and weight of debt is 0.80. So now what happens? Earlier the debt was only comprising of 33% of my entire capital. Now I am infusing more funds to the debt channel. So now the weight of debt increases to 0.8. Now what does NOI approach say? Now KD will remain constant because of this. Because of infusing more debt, will my KD change? No, it will not change. Correct? But will my KE change? Yes, they are saying KE will increase. Correct? He's saying KE will increase from 10% to how much? 21.65%. Why, sir, KE is increasing? Because now you are infusing more debt. Correct? More the debt, more the risk, more will be the return that the equity shareholders will expect. So now you compute this, you compute the KO here. So KO will be 21.65% into 0.2 plus 5% into 0.8. If you compute, you will get exactly 8.33%. Or in other words, NOI approach says that now because of increase in the proportion of debt, what happens? Your capital, your overall cost of capital remains to be 8.33%. That is, if you infuse more debt, in your capital structure, if you infuse more debt, that is weight of debt. If you infuse more debt, 0%, 50%, 100%, right? And here it's going to be what? Cost as a percentage, right? So what they are saying is, so just because you are increasing, if you are infusing more debt in your capital structure, KD will not change, it will remain constant. He's saying KO will also not change, but what will happen? KE alone will increase. Now you tell me, when KO is not changing, obviously the value of firm will remain the same only. Yes, the value of firm will also not change. That is why they are saying the debt equity mix, or in other words, the capital structure decisions are irrelevant for with respect to the value of the firm. That is, the value of the firm will remain the same irrespective of your source of finance. That is what they are saying. Now you might have a doubt. You might have a doubt. Now, sir, then let me just take another figure here. KE, you did 10%. Now you increase the KE to 21.65%. Now, sir, why will KE exactly increase from 10% to 21.65%? Correct? Suppose I'm taking this as 20%. If you take this as 20%, then KO will not be 8.33, it will be something else. Sir, then what is this, sir? So is this cheating or not? No. What this guy says, what this method says is, look, what happens when you increase the proportion of debt? What happens when you increase the proportion of debt? There is a low cost advantage from debt. Correct? He's saying the low cost advantage of debt is exactly offset by increase in your KE. That is, the benefit that you get by low cost advantage of debt is getting offset exactly to the extent of that benefit. It gets offset by increase in equity. That is, one benefit is being offset by another negative. So automatically overall there is no change. So it makes your overall cost of capital equal. But what is the assumption he is doing here is, if you increase your proportion of your debt in your capital structure to the exact advantage, you get some advantage. Why? Debt is a low cost of low cost capital, correct? Exactly to the extent of advantage that you get, the low cost advantage of debt will be offset by increase in equity. Your equity KE will increase exactly to that level to make sure that overall that KO does not change. Are you clear with this? Sir, will exactly KE move from 10% to 21.65%? In real life, it will not happen like that. Then why are we studying this? Because this net operating income approach is stating that this is how it will happen. Are you clear with this? So please don't worry about the logic here. They are saying the net operating income approach says that this is how it will happen. Clear? And this is a part of our syllabus, so we are doing it. As simple as that. Sir, will KE exactly increase from 10% to 21.65%? In real life, it will not happen. But NOI approach says that it will happen like this only, so that overall, to ensure that overall your cost of capital remains the constant. Are you clear with this? And when KO does not change, so value of firm is nothing but what? Value of firm is nothing but EBIT divided by KO. Correct? And when KO does not change, EBIT also does not change with your capital structure. I told you, yes, EBIT will not change. It's an operating profit. It has nothing to do with your financial structure, correct? Or capital structure, correct? EBIT will not change. Now, under NOI approach, KO also will not change. Then obviously the value of firm will never change because of your change in capital structure. Are you clear with this? And this is what the net operating income approach states. Clear with this, guys? Are you all getting an understanding about this? So look at this. As per this approach, the increase in the use of debt, which is apparently cheaper, is offset by an increase in KE. So increase in WD, weight of debt, you get some advantage, correct? To the extent of disadvantage, this particular advantage, what happens? The KE also parallelly increases. If KE increases, it's a disadvantage. So what they are saying, this advantage is being offset by this advantage, and particular this disadvantage. And overall what happens? It nullifies the effect on your KO. This is what it is saying. But clearly from 10% will my KE increase exactly to 21.65%. In real life, it will not happen like that. But that is what this approach says. It says it should happen like that. But in real life, will it happen? No, that's $1 million question, which will not be the case. Are you clear with this? Are you clear with this? We are just talking about this approach, the theory, that is this particular perspective of looking at things. This happens because the equity investors seek higher compensation as they are opposed to greater risk due to the existence of fixed return securities. The capital structure, fixed return securities, nothing but debt. So more the debt, now what happens? More the risk. More the risk, they expect more return. That I accept. The logic for increase in equity KE I accept, but will the KE exactly increase from 10% to 21.65%? That is a very debatable thing. That's why we read it under capital structure theories. We are just saying what a particular person's perspective is on the capital structure. Are you clear with this? So just look at it from a third party perspective. Someone else is giving you one perspective. We are just looking at it as simple as that. Are you clear with this? Now let's go to the next one. So this is what they are saying. KD remains constant. KW, that is KO, also remains constant with increase in your degree of leverage, that is, it increase in your proportion of debt in your capital structure, KE will increase. But what they are saying is, how sir KO remains constant? The advantage that comes by way of low cost debt is being offset by the disadvantage in your increase in EKE. Are you clear with this? That's what he's saying, and it gets exactly offset to balance your KO at any given capital structure mix. This is what they are saying. Is it practical? No, it is not practical. It's just a theory that we are studying, and this NOI approach states that. Are you clear with this? Next, traditional approach. Now, what does this traditional approach say? Now, before we move into it, let me just summarize the discussion here, because these two are the base. Net income and net operating income are the base. So let me just summarize this. KD, KE, KO, KF. Sorry, not KF, it's VF, value of firm. Right? One second. See, this is actually a super summary. A super summarized version of whatever we have studied till now in this particular capital structure theories. So now, what does NI approach say? What does NOI approach says? NI approach says, net income, first approach says, KD will remain constant. That is, if I increase, with the increase in the proportion of debt in the capital structure, KD standalone will not change. KE also standalone will not change. Correct? Yes. KO will change. That is, it will decrease. As you increase your proportion of debt, KO, what will happen? Will decrease. And because KO decreases, your value of firm will increase. This is what we saw logically. Yes. Now, what are they saying in NOI approach? NOI approach, they are saying, as you introduce more debt in the capital structure, will KD affect? No. So the KD will remain constant. Correct? Now, what happens to KE? More the proportion of debt. He is saying more the debt, more the risk, more the equity shareholders return expectation. So this will increase. Correct? But what he's saying is the weight of debt, the advantage that you receive by low cost debt is offset by a disadvantage by increase in equity. So overall, he says it will not impact my KO. So KO will remain what? Constant. And because KO remains constant, the value of firm also remains constant. Sir, which is correct? That's why I said please don't compare. For the assumption, ideally speaking, this is correct, or I wouldn't say correct. This is relevant in today's life. But NOI approach has its own hypothesis. It says whenever there is a change in your debt, weight of debt, that is the proportion of debt in your capital structure, your equity, KE, will increase in exactly such a manner that to ensure that overall it balances and KO does not change. That is the hypothesis, that is the assumption for NOI approach. Are you clear with this? Let us not question back this theory. These theories are well established. They're given by people. We are just studying what these people have said. That's all. Don't say which is right or wrong. That is not what we're going to do here. Are you clear with this? Now, let's go to the third one, which is called as the traditional approach. Now, what does traditional approach say? According to this approach, capital structure decision is relevant to the value of the firm. So meaning what? So capital structure decision, the proportion of debt and equity in your capital structure will impact the value of the firm. That is what they are saying. Yes. So by a proper mix of debt and equity, KO can be reduced and VF can be increased. Yes, this is what they are saying. Sir, then what is this method saying? So this is similar to the first approach, that is net income approach. No. They are saying, but only part of difference is they are saying this approach has 3 stages. They are saying in the first stage, KE and KD will remain constant. KO will decrease with increase in the debt, and KE is always greater than KD. So what is this? Very simple. They are saying first, initially, net income approach will be happening. They are saying initially, in the initial stages, KE and KD will remain constant. Correct? KE and KD will remain constant. So let me just put it here. This is what the traditional approach. So now look at this. This is how the graph looks like. The percentage of debt in your capital structure. Let's say it's 0%, 50%, 100%. As I keep increasing the proportion of debt, and this is going to be a cost in terms of percentage, right? In terms of percentage. Now, what this traditional approach says is initially, what will happen initially? So initially, your KE and KD will not change. So as you infuse more debt into your capital structure, they are saying your KE and KD and all will not change. So he's saying, so KD will remain here, KE will remain here. Okay, so let me just use a different color. Okay, so I'm just using green ink here. So KE, so this is KD. He's saying this is KE. Okay, always KE is greater than KD. We know that because KE is a costlier source of finance, KD is a cheaper source of finance. But what he's saying is, so KE and KD will remain constant. They will not change just because you are infusing more debt in your capital structure. But what happens? Your KO will start falling. Yes, that is nothing but your net income approach. Yes, why it starts falling? Because as you increase the proportion of debt in your capital structure, so now you are raising more money through a cheaper source of finance. So now what happens? Your overall cost of capital falls, correct? Now this will happen to some extent. Then what he's saying, stage 2 will start. What is stage 2? KE will increase with an increase in the debt. Now, beyond a point, what he's saying, if you further infuse more debt, now KE will start increasing, KD will remain constant, now KO will also remain constant, and KD is always greater than KD. What is this? Nothing but NOI approach. He's saying beyond a point, now NOI approach will start. Beyond a point, NOI approach will start. So initially NI approach will be there. Then beyond a point, if you still further infuse debt, beyond certain point, NOI will start functioning. So how will NOI look like? How will NOI look like? So this is the first stage. Yes, this is how the first stage looks like. Correct? Now, in the second step, what happened? In the second phase, what happens? Now, KD remains to continue constant. Correct? But now what they are saying, KO also remains constant. Yes, because NOI approach. Correct? Now, what they are saying, slowly KE will start increasing. Are you clear with this? Are you clear with this? This is what they are saying will happen in the second phase. This is nothing but what? This is nothing but what? This is nothing but your net operating income approach. So this is basically your NI. This is basically your NOI. Are you clear with this? And if you further infuse debt, what will happen? This is what they are saying. Beyond a point, if you still keep infusing debt in your capital structure, now KE will increase. Correct? Now KD will also increase. Yes. KO will also increase and K is always greater than KD. Now what they are saying, beyond a point, if you still keep on infusing more debt, he's saying KD will also now start increasing, KO will also now start increasing, KE will also now start increasing. Sir, why sir? Now, if you further infuse beyond a point, if you still keep on infusing debt, correct? If you keep on infusing debt, so this is KE, this is KO, this is KD. What happens? What happens? Now, more the debt, what happens? So you're borrowing, you just keep on borrowing, more the risk, correct? So equity shareholders are risk takers. Now they will start demanding more return, correct? So the KE will increase. So then why KD is increasing, sir? Just imagine, there are two people, okay? One guy is actually going to a bank, okay? And he's going to the bank for the first time to get a loan. Yes. Now there is another guy who already has a lot of crores of rupees as loan. He has taken somewhere else. Now he wants to take one more loan. Now you tell me, in which of these two scenarios, among these two people, from the bank's perspective, who is more riskier? Obviously, the person who has already raised funds from, he's already raised loan and now he wants to add some more loan. This guy seems more riskier. So now this guy is more riskier. The second guy is more riskier. So obviously the bank will charge more interest for him because yes, this guy is more riskier. So for him, I will charge differently, correct? Even that happens in a debenture model. That happens in debt also. So beyond the point, even these debenture holders will be careful. They will say, look, you already have raised so much money from debt. If you're making a further issue of debt, now we want more interest because now we are also starting to take some amount of risk. Are you clear with this? So these guys will also take. Now KD also increases, KE also increases. Obviously, KO will increase. Are you clear with this, guys? Is everyone able to understand? So the third phase, where traditional method says is now all the three will start increasing. So traditional method is not a standalone method by itself. It says up to some extent. What is at some extent? It depends. It says overall the graph will happen in three phases. Phase 1, net income approach. Phase 2, net operating income approach. Phase 3, all the three will increase. Are you clear with this? So the KO will actually fall here, then it will remain constant here, and it will increase here, correct? And your value of firm is dependent upon KO, correct? Yes. So in this case, what will happen initially? In the initial phase, the value of the firm will keep on increasing as we pump in more debt. And at for certain point of time, even if you increase debt, it will remain static. The value of the firm will remain static. Yes or no? Yes or no? Now beyond a point, since KO start increasing, now value of the firm will be decreasing now, and beyond the third phase, since KO increases, the value of firm will decrease. Are you clear with this? So basically this method, traditional approach, says that now the entire capital structure decisions are relevant. Why? Because KO is changing. Whenever KO changes, your value of firm will change. Correct? And now they are saying the capital structure decisions are relevant, but how they are relevant? They are relevant in a different perspective. Are you clear with this? Initially, net income approach will happen, then net operating income approach will happen, and finally everything will increase and shoot up. So now when your KO also increases, your value of firm will come down. This is what the third method says. Are you clear with this? So as per the traditional approach, the optimum capital structure will lie between stage 1 and stage 3. So between this only, the optimum capital structure will lie. Are you clear with this? That is what they are saying. And look at this. This is the graph given in the study material. So you might not exactly know this, you may not exactly remember. So that's, you might not exactly connect with this. That's why I drew it here. So one phase is NI approach. That is, to some extent, NI will happen. NI will happen. Look at this. This is remaining constant. This is also remaining constant. And this is falling slowly. Correct? It will not go till this. Why? Because if you want your KO to be equal to KD, then this should be 100%. They are saying no, it will not even reach 100%. Are you clear with this? So it goes only to some extent. Are you clear with this? Then beyond this point, what happens? Beyond this point, what happens? KO remains constant. Correct? KD also remains constant. But now KE alone increases, and beyond the point, what happens? Everything starts to increase. KE, KD as well as KO, everything increases, and this is a three-stage approach, a three-step approach, and that is what is called as traditional model. Sir, will it exactly happen like this? This is the theory that they are giving, as simple as that. So we are just studying whatever research that these people have made. They are saying it will always happen like this. Fine, it might not happen like that. We are just studying their analysis. Are you clear with this? Yes. Now I think this okay, so this particular method, this particular traditional approach, fine, was introduced by a person called Ezra Solomon. Okay, Ezra Solomon. Now, I remember this in my regular class. I mentioned this. So once I finished this traditional approach, one student asked me a doubt. Now, okay, I was very interested to take the doubt. I asked him, yes, tell me the doubt. Now, I thought he's going to ask me something about the traditional approach. He asked me about the traditional approach only. But for a change, his doubt was interesting. He wanted to know whether Ezra Solomon is a male or female. Now, very interesting doubt. I thought this guy will ask me a real good doubt. But look what this guy is interested in. But anyways, then I did a research. I just Googled it up. And I found that this is a guy only. It's a male. Okay. But that apart, see, there are so many really interesting things to learn here. But look what our guy had a doubt in this particular area. So he wanted to know whether this founder of this particular method is a male or a female, right? Okay, fine. So that was a lighter note, but yes, that really happened. That really happened. That's why I'm sharing it. Fine. So now let's go to the next one, which is approach. So approach is called as Modigliani-Miller approach. Modigliani-Miller, yes, that same guy only. He asked me this doubt. Sir, Modigliani-Miller, is it one person or two people? Two people, pa. Okay, so two people, two people put together. Modigliani is the name of one guy. Miller is the name of another guy. Okay, if you want, you can research and Google it out and find out whatever is the full name and all. But I think this should be the surname of these two people. Then why two people came together? They gave this particular approach. I don't know, maybe they did group studies. So they did the research together. Fine, but please let us just focus more on this particular area, because I was surprised when I was taking the core of this concept, all these doubts came in between. So that's why, if at all this has crossed your mind, let me be very clear on this. Let's not bother about all these people who have founded it. Basically, let's bother more about what they're actually saying. Modigliani-Miller approach, approach, popularly known as approach. This approach was given by two people, right? Modigliani-Miller in the year 1958, and it's very similar to NOI approach. Not similar, it is same. This guy has copied, these two guys have copied this. So Modigliani-Miller without tax is equal to net operating income approach. The second approach, what is that? Capital structure decisions are irrelevant. They are saying the advantage of a low cost debt will be offset by disadvantage in increase in equity, KE. That's what they are saying. So exactly, sir, not even a single thing is changed. No, every single thing line by line is the same. approach without tax is same as net operating income approach. Are you clear with this? As per this approach, capital structure decisions are irrelevant. As per this approach, the value of the firm and KO will remain constant. Yes, the same thing only. The value of the firm cannot be increased or decreased by changing the proportion of debt in the capital structure. This is exactly the same as your net operating income approach. Are you clear with this? Now, in this approach, they have given 3 propositions. Propositions means what? Propositions means their viewpoint. They have researched and they have come up with 3 different findings. What are these findings? We will see. Now, all these things is, this is nothing new. This was already found under NY approach. Maybe they have done a lot of research and they have come up with, these propositions. They have come up with these propositions as such, but none of these are new. Every single thing is coming from your NY approach. We will just see what it is. First proposition. The total value of the firm and KO remains constant. We know that. So value of the firm is equal to EBIT upon KO. Correct or not? Yes. Value of the firm is equal to EBIT by KO. We know this. Now what he's saying is value of levered firm is equal to value of unlevered firm. What is the meaning of this? He's saying levered firm means what? A firm that has some amount of debt in its capital structure. Unlevered firm means what? All equity firm. Now, this method says just because you are infusing more debt in your capital structure, will your KO change? No. If your KO does not change, your value of the firm will not change. Yes, correct. The value will not change. Yes. So that's why he's saying the value of a levered firm is always equal to the value of unlevered firm. Or in other words, the value of firm is always the same irrespective of the source of your finance. That is the first proposition he's saying. As if we don't know this. We know this already, right? Yes. Proposition number 2. KE is equal to KO minus KD into debt upon equity. Sir, what a formula they have invented, sir. K is equal to KO plus KO minus KD into debt upon equity. This is nothing. This is not a big formula and all. Don't think this is something else. Fine. I will just derive this formula in the next 2 minutes. Fine. Just see what this formula is. Now, proposition number 2. So now, just look at this. He's saying KE is equal to KO plus KO minus KD into debt upon equity. So this is what approach says in his proposition number 2. Nothing great, guys. Nothing great. We know the formula for KO. What do you mean by KO? Overall cost of capital. What is the formula for KO? So it is KE into WE, cost of equity into weight of equity, plus cost of debt into weight of debt. Correct, guys? Yes. Now, can I rewrite this as, so K into weight of equity is nothing but, can we say this is equity divided by equity plus debt? Correct? That is equity divided by the total capital, and the total capital consists only of equity and debt. In this capital structure theory, I told you there is no preference. Correct or not? Similarly, can we say KD is nothing but, KD into weight of D is nothing but debt upon equity plus debt. Correct or not? Yes, we can rewrite it like this. Or can we say KO is equal to, so the denominator is the same here. So KE into E plus KD into D, the whole divided by E plus D. Correct or not? I'm just taking the denominator common. Correct, guys? I'm just running through this quickly because this derivation is not required. But you should not feel that this is a separate formula. That's why I'm doing it here. So now cross multiply. So KO into E plus D is equal to KE into E plus KD into D. Correct? Or can I say, keeping this in this side and taking this to the other side, can I say KE into E is equal to KO into E plus D minus KD into D. Yes? Yes, guys? Or if you take this E to the other side, can I say KE is equal to KO into E plus D minus KD into D, the whole divided by E. Correct? This E goes to the other side, denominator. Correct? Yes? Or if you further split it and write, if you further split it and write, can we write this as KE is equal to KO into E, KO into E, KO into E by E plus KO into D by E minus KD into D by E, correct? So KO into KE upon E, then KO into D upon E minus KD into D, correct or not? Here EE gets cancelled, correct? EE gets cancelled. So can I say KE is equal to KO plus KO into D by E minus KD into D by E, correct guys? Yes. Or can we say this is nothing but take this common, D upon E common, can I say KE is equal to KO plus debt by equity alone, you take it common, D by E into KO minus KD, right? And this is the formula that he has also given. This is nothing but mathematics, simple mathematics he has done, and he has just taken LHS to RHS and he has given the formula for KE. KE is equal to what? KO plus debt by equity upon KO minus KD. Look at this. That is what they have given. So KE is equal to KO plus KO minus KD into debt plus equity. Are you clear with this? This is nothing. You need not remember this directly also. This is nothing but what? That KO formula, they have just rewritten and they have arrived at it. But this formula you need to remember for a reason. Because suppose if only these data around are given, with this also directly you can calculate KE. So for that it will be useful, but this is not a big invention and all in my opinion. Are you clear with this? We just derived this formula, so simple from this overall WACC, weighted average cost of capital, we derived this formula. So don't think Modigliani, Miller, they have given some new formulas and all they have invented. Maybe they have done some hypothesis, I don't know, but this formula is like plain mathematics. This has nothing to do with big invention. Clear with this? And the third one, the proportion 3, what they say is, the structure of capital, that is financial leverage, the weight of debt does not affect the overall cost of capital. The cost of capital is affected only by business risk. So what they are saying is your finance risk is called as financial leverage. Your financial leverage or the proportion of debt and equity will never impact the firm. The firm's value is impacted only by its business operations. That is sales minus variable cost, contribution minus fixed cost is equal to profit. So only there is a change in the operation side. Costing side alone will impact the value of firm. FM side will not impact the value of firm. So is it true? That is what Modigliani Miller is saying. Are you clear with this? Are you clear with this? This is what they are saying. And this proposition is exactly ditto same as what? This is ditto same as your NOI approach. See, as you increase the proportion of debt, KD will not change, KD will not change. Yes, your KO will also not change, but your KE alone will increase. Why KE increases? More the debt, more the risk, more the equity shareholders return expectation. Are you clear with this? And he's saying the advantage of low cost debt is getting offset by an exact increase in the KE, which actually knocks off and nullifies and makes the KO constant as a flat line. This is what NOI approach was saying. This is exactly what MM approach without tax is also saying. Are you clear with this, guys? Are you clear with this? So what are the three proportions? Could be a theory question. So the first approach is what? Value of levered. The first proportion says value of levered firm is equal to value of unlevered firm. Why? KO does not change. Simple. The second one is KE is equal to KO plus KO minus KD into debt upon equity. This is nothing but the reverse working formula of your KO formula, right? Weighted average cost of capital, WACC formula. In proportion 3, what they are saying, yes, your the overall capital structure decisions are irrelevant. It does not impact the value of the firm. The value of the firm is impacted only by your business risk. This is what they are saying. Are you clear with this, guys? Just know what these things are. See, we know all these things logically. We saw, should you mug up anything, you can directly go. If there is a theory question, you can write it in exam. If there is a practical question based on this, we'll be solving a few questions. You can just get complete control over it. Are you clear with this? Yes. Now, what does MM approach with tax says? Now, MM approach with tax. Now, what happened after a few years when tax and all were introduced in many countries? Now, these guys, Modigliani Miller, they said our approach is correct, but now in our approach, we are just making one extra addition. That is, we are going to adjust our approach for taxation. So, as per MM, if tax rate is given, then the value of levered firm will be higher than the value of unlevered firm. So, he says the value of levered firm will be greater than the value of unlevered firm. Why? Because levered firm has something called as debt. Now that debt, yes, all these offset thing and all is fine, but for debt is actually a tax deductible expense. Interest on debt is a tax deductible expense. So tax will make your levered firm, that is a firm that has raised money from your debt channel, will actually be valued more because its overall cost of capital will be slightly lesser. Why? Because of the tax savings. Are you clear with this? So this approach with the tax says, after a few years when tax got introduced, fine, what they started saying is, look, now because of tax, solely because of tax, not because of any other risk parameters, only because of tax, the value of a levered firm will always be greater than the value of unlevered firm. Why? Because now the value of levered firm will have a lesser cost of capital as compared to the value of unlevered firm. Unlevered means all equity. Levered firms means it has debt in its capital, some debt in its capital structure. So why is this happening? Lesser KO, more KO. Why lesser KO here? Because of tax savings. Are you clear with this? Now he's slowly changing his proposition. Earlier he said value of a levered firm is equal to value of unlevered firm. Now he's saying value of a levered firm is equal to value of the unlevered firm plus the debt amount into tax. That is the amount raised from debt into tax rate. Are you clear with this? So what he's saying, value of a levered firm is equal to value of the unlevered firm plus debt rate into debt amount into tax rate. So what is the logic for this formula? Now this formula is also very logical. I don't want to spend time in proving this in the marathon session. So basically this is nothing but they have incorporated the concept of time value of money, right? It is derivation and all is not required for exam. So now if I do the derivation, it will take much more time. So in my regular batch, I do it and I show, so that people are convinced that actually this is a logical formula. So this is not something to be mugged up. But anyways, so you can just remember this formula because of constraint of time. So I'm just taking this up. Value of levered firm is what? Definitely more than value of unlevered firm. Fine. So value of unlevered firm. So value of levered firm is equal to value of unlevered firm plus the debt amount into tax rate. This is what approach with tax says. Are you clear? They have just changed that proportion 2 alone. They have just changed it and they have made it. So what does approach without tax says? Value of levered firm is equal to value of unlevered firm. What does approach with tax says? So here they are saying value of levered firm is equal to value of unlevered firm plus debt amount into tax rate. Are you clear with this? This is the story about all your capital structure theories. 4 capital structure theories. What did we see? Net operating income approach, net income, net operating income, traditional, and your approach. In without tax, with tax we've seen. Are you clear with this? So in this case, in the first case, net income approach, logical, things were logical. So as you keep increasing your proportion of debt in your capital structure, so KDKE will not change, but now since you are raising more funds through a cheaper source of finance, KO alone will fall down, correct? So capital structure decisions are relevant. This is what we saw here. The next one was NOI approach. He says, as you keep on increasing the proportion of debt in your capital structure, KD will not change, but KE will increase because more the risk, more the return expectation of the shareholders, and hence KE will change. But this advantage and disadvantage are exactly getting offset in such a way that your KO remains constant, unchanged. So basically, NOI approach says that your capital structure decisions are irrelevant to the value of the firm. Then traditional approach, what it says is it happens in 3 phases. Initial phase, NI approach, then the second phase, NOI approach, and the third phase, everything will shoot up, everything will increase. Are you clear with this? And approach, without tax, exactly the same of what? NOI approach. With the tax, there is only one change. The proposition alone he has changed. What is he saying? Value of levered firm is equal to value of unlevered firm plus debt amount into tax. Are you clear with this? Into tax rate. With this, we have finished all the conceptual areas in this particular capital structure theories. Now let's dive into the questions and solve a few problems here. So please take the second question, which is question number 2. So now, let me read out the second question for you. Company P and Q are identical in all aspects, including the risk factors, except for debt and equity, right? So company P having issued 10% debentures of 18 lakhs, while company Q is unlevered. Now guys, learn the jargons. What do you mean by unlevered? So it doesn't have any debt in it, which means all equity company. Now, both the companies earn 20% before interest and taxes on the total assets of 30 lakhs, which means Total capital employed is how much? 30 lakh rupees, on which both the companies are earning 20% as EBIT. I told you EBIT will not change because of your debt equity mix, correct? Because it's EBIT is something, but operating profit is not, it is not getting impacted because of your proportion of your capital structure. Next, assuming a tax rate of 50% and a capitalization rate of 15% from an all equity company. Capitalization rate means what? For an all equity company. So for the all equity company, the KE stands at how much? 15%. Now they are asking us to calculate the value of the companies P and Q using alternative number 1, net income approach, alternative number 2, net operating income approach. Okay, so this is what they are asking us. Now if you want, you can pause the question, you can pause the video once, read the question once again, and then you can continue. Right now, what is it that we need to do? What is given in this particular question? There are two companies that we have, company P, company Q, right? So equity, debt. So this is what we've got here, equity and debt, right? So now overall, the company has raised how much? 30 lakh rupees. Total assets they are giving. So in the absence of data, we'll say total asset is equal to the total capital that has been raised by the company. Now, company P, what they are saying is, it has issued 10% debentures worth about 18 lakhs, which means the balance 12 lakhs comes from the equity channel. Company Q is an unlevered company, which means zero from debt, which means all equity. The entire 30 lakhs was raised through what? The entire 30 lakhs was raised through the equity mode. Clear? Then they have also given one more thing for this company Q, assuming a tax rate of 50% for both the companies, capitalization rate of 15% from an all equity company. So for the all equity company means what? The entire amount was raised from the equity channel, which means in this case, for this Q company, can I say KE is equal to KO? Why? Entire amount was raised only through the equity channel. So whatever is KE will be KO, correct? KO is equal to KE into 1 only. The entire weight is on the equity. Are you clear with this? So this is equal to how much? 15%. This is all they have given. This is the given data. With this, what they want you to find. Calculate the value of firm. You should find the value of firm for P and Q Limited for both the companies under the first part of the question says calculate the value of firm under net income approach. Second part says calculate the value under net operating income approach. Are you clear with this? Digest the facts. Now let us get started. Now, first, EBIT for the two companies. What will be the EBIT? So overall capital employed is how much? 30 lakhs. And they have said that EBIT is 20%. So 30 lakhs into 20%. How much is that going to be? 6 lakhs for P Limited, 6 lakhs for Q Limited. This will not change. I told you your capital structure will not impact your EBIT. Are you clear with this? Less interest. Now interest, it will be there only for P Limited. 10% debentures. So 10% on 18 lakhs. How much is that? It is going to be 1,80,000. For Q Limited, entire all equity, no interest at all. So what is my EBIT? Sorry, what is my EBT? 4,20,000 and 6 lakhs. Correct? Less tax at the rate of 50%. You reduce the 50% tax, you get what? Earnings after tax. Now in this particular segment, there is no preference dividend. So obviously your earnings after tax will be equal to earnings available to equity shareholders. Correct? Yes. Now look at this. Look at what they are saying. Now for this company, what they are saying. Now first, we are following what approach? Guys, very, very, very important. This is where student approach this particular chapter without understanding the concepts. Net income approach. What does net income approach says? First approach, what they are saying. With increase in proportion of debt, what happens? KD will it change? No. KE will it change? No. KO alone changes. Correct or not? So if I increase my proportion of debt in my capital structure, so what happens? KD will not change, KE will not change, KO alone will change. Correct, guys? Yes. Now, look at this, how beautifully we can interpret. They have given for the all equity entity, for Q Limited, KE is how much? KE is 15%. Guys, yes or not? Now, P and Q Limited are identical companies. The only change is their capital structure. Correct? Now, just because the capital structure change, under the net income approach, will KE change? No. In net income approach, what is the theory that they are saying? Your KE will remain constant. It will not change because of your capital structure. So can I say for P Limited also the KE is 15 percentage? Yes or no? How do we know? They have said Q Limited the KE is how much? 15 percentage. Now under net income approach, they are saying KE will not change because of a change in capital structure. Correct? As you increase the proportion of debt, KE and all will not change. So the KE for both the companies will remain constant only because both are identical companies. The business risk and all is same. But because of financial aspects in net income approaches, because of your financial factors, your KE will not change. That's what they are saying. Correct or not? So obviously this is what it is. Are you clear with this? So can I say this 15 percentage is the KE capitalization rate for both the companies P Limited and Q Limited. Correct or not? Now earnings for equity, correct, divided by KE, can I say is the total value of equity? Yes or no? Earnings for equity divided by KE gives you the value of equity. Yes, guys. So here 2,10,000 divided by 15 percentage. How much is it? Approximately it comes to, so 2,10,000 divided by 0.15. Yes, it comes to how much? 14 lakhs. So for this company P Limited, the value of equity is how much? 14 lakhs. Yes. For Q Limited, what is the value of equity? 3 lakhs divided by 15 percentage. It's going to be 20 lakhs. Correct or not? Yes. Now, what is the value of debt? For the first company, the value of debt is how much? 18 lakhs. For the second company, there is no debt. It's an all equity company. So what is the overall value of the first firm? It is going to be value of equity plus value of debt. That was the first formula we saw. Correct? So value of firm is equal to value of equity plus value of debt. And value of debt, equity is how much? 14 lakhs. Value of debt is 18 lakhs. 14 plus 18 gives you 32. Whereas the second case is going to be 20 plus nil. It's going to be 20 lakhs. Are you clear with this? The key to this problem is what? The key to this problem is they have given the KE for Q Limited. Because we are following net income approach, you should know that the same is the KE for P Limited also. Why? Because KE will not change with a change in the capital structure. Who says this? Net income approach says this. So you should take here, and then what you need to do, earnings for equity divided by KE gives you value of equity, value of debt we already have, value of equity plus value of debt gives you the value of firm. As simple as that. Are you clear with this? Where is the problem in this case? Are you clear with this? Next. Net operating income they are asking. Now, guys, you should remember one thing. In net operating income approach that we saw, now, was there any taxes? We saw that in all the capital structure theories, there is no taxes, except in one case. Only in Modigliani-Miller case, there was tax. Now, look at this. In this question, they have asked to compute the value of the firm under NOI approach. NOI approach is same as approach, correct or not? But in this question, there is also a tax rate, yes or no? So indirectly, look how beautifully they frame this question. This is not NOI approach. This is approach with the tax. Are you clear with this? This is how you should interpret this. This is approach with the tax. And look at this, approach with tax. So in approach with tax, so what is it? What is it that we've got? Now you tell me, approach with the tax. Now, in this case, now, how do we go about with this sum? Now, for Q Limited, they have given that KE is equal to 15 percentage. Yes or no? They have given KE is equal to 15 percentage. Yes. So now, can we say that for this particular question, let's say under approach, that is basically net operating income approach they have asked, but since tax is that, we can clearly interpret that this is with tax. Are you clear with this? So, so can we say for the second company, P Limited, for that company only the data is given. Sorry, the Q Limited only data is given. Yes, for Q Limited, what happens? Tell me what is the EBIT minus interest gives you EBT minus tax gives you what? EAT, and this amount is also EFE. Correct? Yes. Now, divided by KE gives you what? Gives you the value of equity. Correct or not? Yes. Now, for this company, what is the EBIT? So, EBIT remains 30 lakhs into 20 percentage. That will not change. 6 lakh rupees. Correct? 6 lakh rupees. Is there any interest here? No interest. So, which means EBIT is equal to EBT. This is also 6 lakh rupees. Correct? Now, what is the tax rate given in the question? The tax rate is 50 percentage in this question, right? It's 50 percentage. So, which means tax is going to be 3 lakh rupees. So, what's your earnings available to equity shareholders? 3 lakh rupees. Now, what is the capitalization rate? That is the KE rate that is given in the question. So, the KE rate given in the question is how much? 15%. So, 3 lakhs divided by 0.15. So, how much is it going to be? So, can we say that the value of Q Limited is 20 lakh rupees? Yes or no? The value of Q Limited is 20 lakh rupees. Yes or no? Fine. Or in other words, for this is what unlevered company. Correct? This is unlevered company. In case of an unlevered company, there is no interest. Or can I directly say the earnings per equity is EBIT into 1 minus T? Correct or not? Yes, because there is no interest. So can I directly calculate the EFE, earnings per equity, by saying earnings per equity is nothing but EBIT into 1 minus tax rate. Why? Because EBIT is equal to EBT. Because there is no interest. Are you clear with this? That is the reason why they have used this formula here. EBIT into 1 minus T divided by KO. So why KO? Because this is an unlevered entity, all equity entity. Correct? Yes. This KE is equal to KO. Correct or not? Because the entire source of finance is only KE. So for them, the overall cost of capital is only KE. Are you clear with this? You can also put KE, or if you want, you can put KO. Anyways, you will get the same thing. Are you clear with this? So you get the value of this unlevered firm. Correct? Now recall this proposition. This is where I said you can use this formula. Value of levered firm is equal to value of unlevered firm plus the debt amount into tax rate. Yes, this was the proposition given under whom? Under approach with the tax. Are you clear with this? So we need to find out the value of value of the levered firm. Value of the levered firm is P Limited. Value of the P Limited is nothing but 20 lakhs, that is value of unlevered firm, plus debenture amount, debt amount is 18 lakhs into tax rate is 50%. He has given that formula. Yes, I told you this formula is nothing but this is time value of money concept and all. I told you let us accept this formula as such, but because the derivation is not required right now, this formula is a very logical formula, so don't worry about that. So now how much is this going to be? 20 lakhs plus 50% of 18 lakhs is going to be 9 lakhs. So it's going to be an overall value of 29 lakhs. So the value of the levered firm, that is P Limited, is going to be 29 lakhs. The value of the unlevered firm, which is Q Limited, is going to be how much? It's going to be 20 lakhs. Guys, are you clear with this? This is a very, very important understanding that you need to make in this. Somehow we have approached it. Are you clear with this? Yes. So the data was given for unlevered firm. With that, we calculated the value of the unlevered firm and we made use of that proposition. Value of the levered firm is equal to value of unlevered firm plus debt into tax rate. We used that and we calculated the value of both the firms. So under the net operating income approach with the tax, which is nothing but approach, net operating income is without tax only. So with the tax, they are asking indirectly, they mean the approach. So approach, we use this particular formula. Are you clear with this? This is how you need to approach this. Yes. So now let's go to the next question, which is question number 3. A Limited is expecting an EBIT of 3 lakh rupees. The company presently raised its entire fund requirements of 20 lakhs by issue of equity with an equity capitalization of 16%. So equity capitalization rate is nothing but KE. So the company is expecting an EBIT of 3 lakhs. It presently raised its entire capital of 20 lakhs from debt channel and the KE was 16%. The entire amount was raised from debt. Sorry, the entire amount was raised from equity, yes, which means KE is equal to KO in this case. Guys, correct or not? It's an unlevered entity. Yes. Now, the firm is now contemplating to redeem a part of its capital by introducing debt financing. The firm has two options to raise debt to the extent of 30% or 50% of the total funds. It is expected that for debt financing up to 30%, the rate of interest will be 10%. The equity rate is expected to increase to 17%. So now what they are saying, as you infuse more debt, KE will increase. That is what they are saying here. Look at this, KE will increase, right? Now, however, if the firm opts for 50% debt, then interest rate will be 12% and equity rate will be 20%. It will further increase. So look at what they have given. Yes. So now this looks like traditional approach. So they have given it in phases. Up to 30% debt. If you introduce debt up to 30% of your overall capital, that is 1 KE and KD. If it goes beyond certain level, then KE and KD also increases. You are required to compute the value of the firm and the overall cost of capital under the present situation and under the two different options if the traditional approach is held valid. Now, what they are saying, currently the company has what? Currently the company has raised how much? 20 lakh rupees. Are you clear with this? Yes. Entire 20 lakhs is raised by what? Equity share capital. Now what they are saying, they want to introduce debt. How they want to introduce debt? They are saying we will buy back our equity shares. So how they are saying is buyback equity means what? They will pay their equity shareholders some money and buy back its own shares. Now for them to pay the equity shareholders money, how will they get it? They are raising, we will raise the funds through the debenture channel, the debt channel, or in other words, to this extent, equity will reduce and debt will come in. Now what they are saying is two alternatives. Alternative 1, introduce 30% debt. Alternative 2, introduce 50% debt. Are you clear with this? So 30% of 20 lakhs gives you 6 lakhs. So the balancing figure 14 lakhs will be equity. If you go for the other alternative, 50% debt, 50% equity, 10 and 10, this will be 20. Are you clear with this? The question is, now they have also given some changes and all. They have also given a few things. With this, we should say which is the best approach, which is the best alternative. The best alternative is the one that has the least KO and highest value of the firm, correct? But what they are saying here is, look, what they are saying here, KE, KD, right? Now, look at this. KE is 16% currently. 16% currently they don't have any debt. Now 16% is the KE, right? They are saying if you raise debt up to 30%, right? If you raise debt up to 30%, the interest rate will be 10% and the equity rate will be 17%. Correct? So equity will be 17%, interest rate will be 10%. Are you clear with this? No tax is given in this question. Next. Now, if you want to raise debt for 50% or more, the interest rate will increase to 12% and even your KE will also increase to 20%. So this will be 12% and 20%. Are you clear with this? Clearly, this is a traditional model. See, beyond a point, what happens? KED also increases, KE also increases. Third phase is happening here. Are you clear with this? So they are asking us to calculate the value of the firm and the overall cost of capital under the present and the two different alternatives if traditional approaches are held valid, and suggest the best course of action. Now let's quickly do this. It's very simple. Guys. So what we need to do here, now look at this. So now first EBIT. What's your EBIT? Now EBIT is given 3 lakhs. Now will your EBIT change because of the capital structure? No. Why? It's an operating profit, basically, as simple as that. Correct? So now what is this going to be? 3 lakh, 3 lakh and 3 lakh. Less interest. Now you tell me. Interest. Now first alternative, is there any interest payout? No. All equity. Second alternative, yes. What is the interest payout? They are saying 6 lakhs is raised from debt channel. Correct? So 6 lakhs into 10%, that is going to be 60,000. Are you clear with this? Because if your debt is up to 30% of your overall capital, the interest rate is 10%. Suppose if you are raising debt to the extent of 50% of the capital, on the entire debt value, the cost, the KD, that is the interest cost, will be 12%. So in the third alternative, it's going to be 10 lakhs into 12%. That's going to be 1,20,000. Are you clear with this? So EBIT minus EBT, EBIT minus interest gives you what? EBT. 3 lakhs, 2 lakh 40 and 1,80,000. Are you clear with this? We got all these figures with us. Are you clear with this? Now what happens? Now just see what happens. Now minus tax. In this question, is there any tax? No. Nil. So you get what? Earnings after tax, or you can also call this as earnings available to equity shareholders. 3 lakh, 2 lakh 40,000 and 1,60,000. Now this is the earnings available to equity shareholders. Yes. Now, can we say the value of the firm is nothing but value of equity plus value of debt? Yes. Do we have the value of equity? Can we calculate the value of equity? Yes. How can you calculate the value of equity? Value of equity is nothing but earnings for equity divided by cost of equity. Yes or no? EFE divided by KE. Correct? EFE is how much? 3 lakhs. So 3 lakhs divided by what is your KE here? KE is going to be 16%. Yes, it's going to be divided by 16%. So calculate and tell me 3 lakhs divided by 0.16. It's going to be 18,75,000. This is the value of equity under the present proposal. In the second proposal, what will happen? 2.4 lakhs. It's earnings for equity divided by KE. What's the KE here? KE K is now increased to 17%, right? K is now increased to 17%. So it's going to be 2,40,000 divided by 0.17. It's going to be 14,11,764. For some reason, they have rounded it off to 14,12,000. So should we also round off? Not necessary. You can keep it as 14,11,764.7. You can keep it. Next. Finally, what is it going to be? Here it's going to be 1.8 lakhs divided by, I think finally the K went up to 20%, right? Divided by 20%, you get how much? 1.8 lakhs, 1,80,000 by 0.2. So that gives you how much? That gives you, one sec. Yes, that gives you 9 lakh rupees. Yes, that gives you 9 lakh. This is the value of equity. Now, how do you calculate the value of debt? Very simple. Interest divided by KD. We saw all these formulas earlier. With logic, time value of money logic. I told you. Yes, look at this. I told you these formulas in the beginning. Value of equity is per share. If you want, you can say earnings per share upon KE, or overall if you want EFE by KE. Value of debt is nothing but total interest divided by KD. Yes or no, guys? Annual cash flow divided by discount rate. Yes. Fine. So now look at this. So that's how we need to do it here. So value of debt we can find out easily. Yes, value of debt we can find out easily. The value of debt is nothing but interest divided by KD. The interest divided by KD. Yes. So the interest divided by KD. So this is nothing but, one second. Yes. So this is nothing but what do we have here? So in the first phase, there is no interest only. So there is no value of debt, correct? In the second phase, it's going to be what? 60,000 divided by 60,000. So 60,000 divided by, what is the interest rate? That is KD. What is the KD here? 10%. So 60,000 divided by 10%, it's going to be 6 lakhs. In the third phase, it's going to be what? Third phase, as in the third alternative, it's going to be 1,20,000 divided by what? 1,20,000 divided by 12%. 1,20,000 divided by 12%. That gives you 10 lakhs. Are you clear with this? So what is the value of firm? Value of firm will be value of equity plus value of debt. So it is going to be 18,75,000 plus 0, which is 18,75,000. 14,12,000 plus 6 lakh, it's going to be 20,12,000. 9 lakhs plus 10 lakhs, it's going to be 19 lakhs. Are you clear with this? Now, can we calculate KO? Yes, we can calculate KO. So KO will be what? EBIT divided by value of firm, correct? EBIT divided by value of firm. So EBIT is what? Your 3 lakh rupees. Value of firm here, for each of the cases you have different values. So if you do that, you will get 16%, 14.9% and 15.78% respectively. Are you clear with this, guys? Sir, is there another way to calculate weighted average cost of firm? Yes. What is the formula that you can use? So KE into WE plus KD into WD. Are you clear with this? Now remember, if you use this formula, you will get a different cost of capital. Yes, you will get a different cost of capital. That the reason is because of the capital structure theory assumption. Here, what assumption? We make no taxes and all these things divided by value of firm. That's what we do. But there in weighted average cost of capital, we take the respective cost with the respective weight. So if you do it under this approach, that is the weighted, the cost of capital WACC approach, obviously the answers that you will get for each of these three will be different. Don't worry about it. Sir, then how will we know which one to follow? Simple. In exam, if this question comes, if a question comes in capital structure theory, in capital structure theories, then you can use this formula. Your weighted average cost of capital is EBIT upon value of firm. And I gave you the logic as well. Are you clear with this? So with this, we have comprehensively seen all the methods and we have learned all the approaches of capital structure theories. Important, a very, very important chapter from an examination perspective. Maybe who knows, this could even be tested for 10 marks. These questions are 6 plus 4, 5 plus 5, whatever combination they could test it. But basically this chapter, the most important part is the tricky part is basically in your capital structure theories. There are 4 capital structure theories broadly: your net income approach, net operating income approach, traditional approach, and MM approach. MM approach with and without tax, MM approach with tax, MM approach without tax is same as your NOI approach. MM approach with tax is actually the only difference is value of levered firm is equal to value of unlevered firm plus debt amount into tax rate. That's the only difference. Are you clear with this? So with this, we have completely revised in detail this entire chapter. So have complete control over this, practice many problems. So with this, we are done with this particular chapter. So now we will move to the next one.